Hello friends, today we are going to start with new unit, equity. So in equity, in totality there are going to be 6 readings with a combined weightage of 10 to 12%. Okay, so now today I'm going to start with the reading overview of equity securities. Okay, so now this chapter is pretty simple. In this we will learn about what do you mean by equity and why we invest in equity shares. Okay, now let's start with my LOSA. LOSA describe the characteristics of types of equity securities. Now shares can be of two types. Number one, LOSA. Number one is known as equity share capital, and second type is preference share capital. Now preference share capital has two preferences. So preference shareholder has two preferences over equity shareholder. Now first preference, they will receive dividend, and the amount of dividend is going to be fixed in nature. So they are going to receive fixed amount of dividend, and dividend will be paid before paying anything to the equity shareholders. So fixed amount of dividend. Second, when tomorrow there is a liquidation, then first amount will be paid to preference shareholder. That means two preferences. Number one, they will receive dividends and the dividend amount is fixed. Second, tomorrow if there is a liquidation, then again preference shareholder will be paid first, and then we will proceed to equity shareholders. So can I say that the equity shareholders are having a residual claim in the company. Now whatever is left, whether they are profits or losses, whatever is left, that surplus, that residual belongs to the equity shareholder. Now whatever is happening in the company, that is happening with the consent of equity shareholders. That means equity shareholders, I understand that they have the residual claim in the company, but they are the ultimate owner of the company, and what is being done and what is being happening in the company, that is with the consent of equity shareholders. That means they have voting power. On the other hand, preference shareholders, they do not have any sort of voting power. Now voting power can be of two types. One, statutory voting. And then other one is cumulative. So we have covered under corporate governance that which one is the better corporate practice. Having a cumulative voting system is better in comparison to statutory. Now cumulative protects the rights of minority shareholders. Okay, so now this was the brief difference between equity and preferences. Preference shareholder has two preference over equity, but point to be noted, they do not have any sort of voting power in the company. Now my point is there any obligation? Now let's compare this with debt. So now paying interest over debt, there's an obligation on the company. You are earning profits, you are incurring losses, there's an obligation to pay interest. Now my point is, be it be preference or equity, paying dividend, there's an obligation over the company. Answer is no. Dividend would only be payable if there are profits. Dividends can only be paid out of profits only. So there's no obligation if you're incurring a loss. Now preference share capital can be of two types. One, cumulative. Now I'm talking about preference shareholder now. So now they can be of two types. One, cumulative preference shareholder, and non-cumulative preference share. Now what is the meaning of cumulative and non-cumulative? Meaning of cumulative. Now suppose this is year 1, and this in this year 1 you have incurred losses. So if you have incurred the losses, you are not going to pay any sort of preference dividend. Okay. Now year 2, and suppose year 1 the dividend amount is 10 rupee. So since you have incurred the loss, you have not paid anything to the preference shareholder. Now in year 2 you earned a profit of 100. This year dividend is 10, which you are anyways going to pay. Now my point is, am I going to pay the arrears which I skipped in the previous year on account of losses? So now under cumulative. So cumulative means if in any prior year, dividend payment skipped on account of insufficient profits, then skip dividends will be paid in the future. On the contrary, under non-cumulative, if any dividend is skipped on account of insufficient profits, they are not going to be paid in the future. Now my point is, which one is more risky from the point of view of investor, or which share is less risky? So now cumulative preference share are less risky in comparison to non-cumulative. Same wise, preference vis-a-vis equity, which one is less risky? Now since they are receiving dividend prior, in liquidation they are receiving the amount prior, so now preference shares are less risky in comparison to the equity shares. Now I'm proceeding further. Now preference shares can be further of two parts. One is known as participating. And second type is non-participating. Now what is the meaning of participating? So now participating preference shareholders will receive a special dividend, additional dividend, if profits are above predetermined level. Now, for example, the predetermined level is profit of 1000 crores. Now, in this particular year, company has earned a profit of 1500 crore. So, more than what is the predetermined level. Now, in this scenario, if you are earning more than 1000 crore as profits, now in 500 you are going to have some sort of share. So, they will receive the special dividends if profits are above predetermined level. On the other hand, non-participating will keep on receiving dividend at the fixed amount. So they won't be receiving any sort of special dividend. Now again, from the point of view of investor, which is less risky? Now my point is, participating preference shares are less risky in comparison to non-participating. Next, preference share can be of one more type, that is convertible preference shares. Now what is the meaning of convertible? Convertible means for the first few years, let us assume for first 3 years, they have a characteristics of preference share, and post that they will be converted into equity. Now for example, today company has issued one preference share at rupees 100, and now after 3 years it will get converted into 5 equity shares of the company. Now instead of one preference share, now you're going to get 5 equity share at the end of third year, dividend rate is 10%. Now what will happen? In this case, at time 0 as an investor, you have to invest 100 rupee. Now by the end of year 1, 10% is the dividend, you will receive 10 rupee. 2 rupees at second year, 10 rupee dividend you will receive, and third year you will receive the dividend. So you're going to get dividend for all the 3 years. Now the moment there's a third year at the maturity, now the moment there is a third year, now investor has 2 options. So option discretion is with the investor. Now investor, you're having 2 options. Number 1, to get your principal back. So whatever you have invested, to take your principal back. Now in my case, let us assume that I put in 100 rupees. Now option number 1, demand 100 rupees back. Option number 2, convert this preference into 5 equity shares. Now again 2 scenarios. Assuming that in the market currently equity share is trading at 25 rupee per share. Now my point is, if 25 rupees share is trading in the market, that means eventually I'm getting 25 multiplied by 5. So eventually I'm getting 125. Option number 1, 100. Option number 2, convert into equity and your worth will increase to 125. Which option you will prefer? In this scenario, you will prefer, yes, I want to convert preference into equity. Let us assume that in the market the price is 15 rupee per share. So collectively you are getting 15 multiplied by 5, 75. In this scenario, you will opt for option O1. That is, I don't want the conversion, I want my money back. So what do you mean by convertible preference share? For the first few years, let us assume 3 years, you will continuously receiving dividend at the fixed rate. And at the end of third year, now there's an option either to take your money back or to convert them into equity share. Now which option is beneficial, you have to evaluate and opt for that. Point to be noted, conversion is not mandatory. Converting them into equity shares, that is the discretion with the shareholder, with the investor. Now my point is, convertible preference shares, options rights is with the investor. From the point of view of investor, more risky, less risky. So now again, convertible preference shares are less risky because here you are continuously receiving the dividends, and at the end of third year there's an option whether to convert or whether to demand your principal back. Okay, so convertible preference share. Now the last one is callable versus puttable. So callable, puttable, or there are 3 ones. Okay, callable, puttable and straight. Okay, now what is the meaning of callable, puttable and straight? So now callable, puttable, this we are going to discuss in detail in the derivative chapters, but they are nothing but a rights. Okay, now they are also known as options. So one share is with callable right, so there's a callable share, there is a puttable share, and there is a straight share. Straight share means there is no right. Okay, no right with the investor or with the company. Okay, no rights. It is known as a straight share. Now callable share. See, callable, that means here the right is with the company, the issuing company. Right with company. And puttable means here there is a right with investor. So now callable. See, callable right with the company, puttable right with the investor, and under straight share there is no right with neither of the company or with an investor. Now my point is very simple. So under putable, there is a right with the investor. So if there's a right with the investor, from the point of view of investor, they are more risky or less risky. So from the point of view of investor, they are less risky. Okay. And under callable, the right is with the company. So they are more or less risky. They are going to be more risky. And if they are more risky, issuing callable shares to the investor, easy or difficult? Now raising money with the help of callable shares. Raising money with the help of callable shares is difficult because they are more risky. And raising money with the help of puttable shares, it is going to be easy. Now my point is, from the point of view of investor, which share is carry the less risk? Puttable. So now what is the meaning of callable, puttable? In detail we are going to cover in the derivative chapter. But now as of now, just imagine that there's a right with the investor. You are having some sort of right. Now puttable, there's a right with the investor. From the point of view of investor, they are less risky. Okay. And if they are less risky, it is easy to raise money with the help of puttable. Callable, right with the company, more risky from the point of view of investor, difficult to raise money. Now my point is very simple. Which category of share is beneficial to both to the investor and to the company? Now that is going to be puttable. Why? Because with the help of puttable, the risk with the investor is less. Plus it is easy to raise money with the help of puttable share. So puttable share is the one which is beneficial both to the investor and to the company. But callable is the one which is only beneficial to the company, and hence raising money is difficult. Okay, now let's conclude. Let's conclude LOS A. We started with what is the difference between preference equity. Equity, you are going to receive dividend, you are having a residual claim in the company. If there are profits, that belongs to you. If there are losses, that again belongs to the equity shareholder. Now you are controlling the company. Now you are controlling the company with the help of voting powers. Voting powers can be of two types: statutory voting, cumulative voting. Cumulative voting is considered as a good corporate practice. Okay. Now preference, you are having two preferences. Number one, you will first pay off the dividend at the fixed amount and at the fixed rate, and second, in liquidation you are going to receive your principal back before paying anything to the equity. But you don't have any sort of voting powers. Now preference can be of two types. Number one, cumulative, non-cumulative. Dividends would only be paid out of profits. If any year the dividend has not been paid on account of insufficient profits, then that will be paid in the future year. This category is known as cumulative. And if in the future the skip dividends are not being paid, that is known as non-cumulative. Again, cumulative is less risky. Then participating versus non-participating. Participating, you are going to receive extra dividend, additional dividend if the profits are above a predetermined level. Again, participating are less risky, non-participating are more risky. Then callable, non-callable. Callable means right with the company, puttable means right with the investor. If it is a right with the investor, they are less risky. Plus raising money with the help of puttable is easy, and hence it is beneficial to both investor and the company. Last one was convertible preference share. Now for the first few years you will receive the fixed amount of dividend, and eventually at the third year there is a discretion to demand your money back or to convert them into equity. Now whichever option is beneficial, you have to evaluate and opt for that. Again, from the point of view of investor, convertible preference share are less risky. So friends, this was my LOS A. So now with this we have covered LOS A, that is describe characteristics of types of equity securities. Now I'm coming to LOS B. Now in LOS B they have discussed about dual class of equity. Now for example, in case of Tata Motors. Now in case of Tata Motors, they have two types of shares. One, normal or ordinary or regular one, and second one is differential voting right. So this we discussed in corporate governance again. Now here for the normal or the regular one share is equal to one vote. In case of differential voting right, 10 shares is equal to 1 vote. The only difference is with respect to voting power. Now my point is it considered as a good corporate practices? Answer is no. Having a dual class of equity is not considered as a good corporate practice. Why? In a way now, with this we discussed corporate governance, that though you are invested money less in the company, but in a way you are controlling the company with the voting power. So now it is against the interest of minority, and considering this, it is not considered as a good corporate practices. Now LOSC. In LOSC they have discussed about private equity versus public equity, or in simple words, private equity versus listed companies. That means now we are going to make comparison between a company like Byju's versus Reliance Industries. Now my point is, one is listed and one is a private company. So which investment is illiquid? Now at any given day, the investments in private equity funds, in private equity companies are going to be illiquid. Now which company is going to have a better corporate governance, or which company is going to have a weaker corporate practices? Now comparison between Reliance versus Byju's versus TCS. Now again, second point is corporate governance may be weaker. Financial disclosures, financial statements may be limited. So these are the problems with private equity. But now what is the best part? I understand that here the investment is illiquid, corporate governance could be weaker, and financial disclosures may be limited. But the best part is when you are investing into these companies and once they become public. Now what is the objective? One or the other day, Byju's has to be listed on the stock exchange. The moment it will list on the stock exchange, there is a greater possibility for higher returns. So I understand that investing this in the private equity is a risky investment. But once if the company is successful in coming up with an IPO, then the possibility of earning multifold, there is a possibility. That means though the risk is higher, but again the possibility of generating a higher return is also an option once a company become IPO. That is why this could be an objective of investing into a private company. So now what are the disadvantages in comparison to a listed company? Investments are illiquid, corporate governance weak, financial disclosure limited. What is the best point with this? That there is a possibility of higher returns as well. Now, same wise, a company will have to, private company is subject to lesser regulations. So now, if they are subject to lesser regulations, then reporting cost will also be, reporting cost will be lower in comparison to a listed company. Now for example, there's a law in the country that every listed company has to come up with quarterly results. They have to disclose their quarterly profits. So there is no as such requirement with respect to private company. So they are subject to less regulation, and hence it will lead to lower reporting cost. So this was my LOSC. LOSC distinguish between private and public equity. Now friends, in this LOS they have discussed a concept like venture capital, leverage buyout, and private investments in public companies, in public entities, that is PIPE. Now these three concepts we covered elaboratively in alternative investments. So now let's have a basic understanding, and then I will be proceeding to next LOS. Okay, venture capital. Venture capital means investing in startups. Leverage buyout means buying a company with the help of debt. Private investments in public entities. Now there's a person or there's a group, future group. Now this company is listed over the stock exchange. This group is having number of companies. Now the promoter is Kishore Biani. Now eventually there is some problem, liquidity problem in the company. Now because of which he is selling his private stake. Okay. So now what do you mean by private investment in public entities? That means in this, there's going to be a sale of private share. Now Kishore Biryani is selling his private stake in the company. Okay. So this class we discuss elaboratively in alternative investment. So with this we have covered LOS C. Now I'm moving to my next LOS D. Describe the methods for investing in non-domestic equity securities. Now let us assume that there's a person, Mr. John, and Mr. John wants to invest in HDFC Bank. Okay, so that means a person from a developed country wants to invest in a developing country. Now first point. Now when he wants to invest in a developing country, the biggest problem with India is that relative to dollar, rupee is continuously depreciating. So rupee depreciates, and as a result, whatever the return that Mr. John will eventually realize, that is going to be lower. For example, let us assume today HDFC is trading at 70 rupees and $1 is equal to 70, and tomorrow after 1 year HDFC Bank increases by 10%. That means after 1 year HDFC is trading at 77, and now in the market hypothetically $1 is equal to 80 rupees. So when he invested $1. Now after 1 year share price is 77, but now in the market dollar has become stronger and rupee depreciated. Now $1 is equal to 80. Now my point is, will Mr. John will get $1, more than $1, less than $1? Now in this case he will get less than $1, and his actual return is negative. Now my point is, despite HDFC has delivered a return of positive 10%, from the point of view of Mr. John, return is negative. Now that negative return is on account of in the country where he invested, that means rupee, that rupee depreciate relative to dollar. So this is the one problem. Second problem is, now if I compare regulators. Now here the regulator is SEC, and India the regulator is SEBI. Okay, now which country will have the more strict rules and regulation? Now that is again going to be the developed country in comparison to developing. So one problem is that the country in which I'm investing, there the currency depreciates, and second, the rules and regulations are not that strong in comparison to my country. So this is the problem. Now to over this problem, what they have introduced, now a new product is introduced. This is known as American Depository Receipt. Now what is the meaning of ADR? American Depository Receipt. Now HDFC Bank will list the share on New York Stock Exchange, on American Stock Exchange, and now the share will trade in dollar. plus now once I'm going to list my share into the American stock exchanges, now I have to follow the rules and regulations of, now I'm going to follow the rules and regulations of the American countries. Now ADR, American Depository Receipt. That means now I'm going to list the share into the American stock exchange, and now the trading will happen in dollars. So this is known as ADR. Same wise, there is one more concept, that is GDR, Global Depository Receipt. Now Global Depository Receipt, in this case I'm going to list my share in a country other than America. Now let us assume London Stock Exchange or Luxembourg Stock Exchange. So I'm going to list my share in a country other than America. But point to be noted, here the trading again will be in dollar. So now dollar is a global currency. So in this case also trading would be in dollar. Now let's start with some practical examples. So now there's a company, that is HDFC Bank. Now HDFC Bank is having its ADR. So now that means HDFC share is listed into the American stock exchanges, and there the share is trading at $82.33. Now ADR, list your shares into the American stock exchange, and the reporting currency and the trading currency is going to be dollar. And now HDFC Bank is going to prepare its annual report in Indian rupee as well and in dollar as well. They have to follow the rules and regulations of SEBI as well as SEC. Now GDR. GDR means I'm going to list my share over Luxembourg Stock Exchange, or majority of them, other than New York, majority of them are listed over London and Luxembourg. But point to be noted, again the currency is going to be dollar. For example, there's a share Aditya Birla Capital. Now Aditya Birla Capital GDR. Now Aditya Birla Capital GDR, it is listed over Luxembourg Stock Exchange, and point to be noted, here again the currency is going to be dollar. Now my point is it possible that in the Indian currency share is trading at a different price, and in the global stock exchange it is trading at a different price? That means possibility of arbitrage. For example, now in India, Aditya Birla Capital is trading at in India it is trading at, let us assume, 100, and in Luxembourg Stock Exchange, if I convert to rupee, it is trading at 150. Means, can there be significant price differences? So answer is no, there cannot be significant price differences. Now this I can prove. Now currently my Aditya Birla Capital GDR is trading at $1.77. So if I convert this to rupee, 1.77, so now this is somewhere equal to 128.44. And if I go to money control, Aditya Birla Capital, now Aditya Birla Capital is trading at a price of 130 or 129.95. So there cannot, yes, there can be price differences, but there cannot be a significant price difference. So point to be noted. Now again, one way is that Mr. John comes to India and buy in Indian rupee. Now the second way is to buy the ADR and the GDR. What is the meaning of ADR? You are going to list your share into the American Stock Exchange, currency is dollar. GDR, you are going to list your share in any exchange other than the American ones. For example, London Stock Exchange or the Luxembourg Stock Exchange. Again, point to be noted, the currency is going to be dollar. Now you have to follow the rules and regulations of Americans as well, and in this way the reporting quality can be improved. Now ADR can be of two types. Now these are depository receipts. So depository receipts can be of two types. One is sponsored DR, and next is unsponsored DR. Now what is the meaning of sponsored and unsponsored DR? Okay, now there's a company, again let's take another company which is having an ADR GDR, that is Tata Motors. So now if I go to money control, Tata Motors ADR, so we do have ADR for Tata Motors as well. Okay, now there can be two ways. One way is that, let us assume that I want to raise $1,000 from America, additional capital in the form of ADR. Now there can be two ways. First, I will approach one of the investment bank. Let us assume that investment bank is Citi. Okay, now Tata Motors will sell shares to Citibank, and Citibank will pay the proceeds to Tata Motors. Okay, now in this case there has been transaction between Tata Motors and Citibank. Tata Motors sell the shares to Citi, and in return Citi has paid the proceeds. Now it is the responsibility of Citi to further sell these shares to other investors. Okay, but now my point is, in this particular scenario, Tata Motors knows only Citibank. In the shareholder register of Tata Motors, there is only one bank, there is only one shareholder, that is going to be Citi. And tomorrow if Tata Motors has to pay dividend, that dividend will be transferred to Citibank account, and eventually Citibank will transfer to these investors. Now this is known as unsponsored DR. So what is the meaning of unsponsored DR? Unsponsored DR means you are raising the capital with the help of investment bank in such a manner that the shareholder, that the Tata Motors knows only Citibank, and shareholding power and the voting power is with the Citibank. So that means Tata Motors is not engaging with these investors. This is known as unsponsored ADR. What is the meaning of unsponsored? I am selling to Citibank, Citibank eventually selling to these investors. Now voting power in this case remains with the depository bank. Okay, in the books of Tata Motors, who is the shareholder, that is going to be the Citibank. Voting power is with the Citibank. This is known as unsponsored, and unsponsored are subject to lesser regulation. Now one more way, that is known as sponsored. So now what will happen in case of sponsored? Tata Motors will sell the shares directly to investors with the help of Citibank, similar to IPO. Now I want to raise $1,000. Now I directly sell the share to these investors with the help of Citibank, similar to in case of IPO. Now this case is known as sponsored DR. In this case, voting power is directly with these shareholder. These name will appear in the shareholder register of Tata Motors, and this is subject to more regulations. So now if I want to conclude sponsored DR and unsponsored DR. Sponsored, voting power with actual investors. Voting power with actual investor. Unsponsored, voting power with depository bank. Point number 2. Which one is subject to? Here you are directly dealing with the retail investor. Sponsored, subject to more regulations. Now subject to lesser regulation. Okay, so this is sponsored and unsponsored DR. So now if I download Tata Motors annual report, now you have to identify whether it's a sponsored or an unsponsored one. Okay, so now they are listed over New York Stock Exchange. Okay, and the depository bank is Citibank. Okay, and now in the shareholder register, the name of Citibank is appearing. Okay, the name of Citibank is there, sponsored, unsponsored. Now this is going to be an unsponsored one. So in case of unsponsored, voting power is with the depository bank, and the name of depository bank will appear in the shareholding register, and these are subject to lesser regulation. So in case of Tata Motors, this is an unsponsored DR. Okay, now I'm proceeding further. Now LOS D. Describe the methods of investing in non-domestic equity shares. So this is with the help of ADR and GDR. Now there is one more share which are known as global registered shares. Global registered shares. Now what is the meaning of these shares? Now for example, there's a company like Google, or there's a company Microsoft, Amazon, Facebook. So these are known as multinational companies. That means globally these companies are generating revenue, and globally there's a demand for these shares. Now company does not want to raise money, but these are such shares that there is a global demand for these companies. Now what Google or Amazon will do, now they will list their shares in China, India, America, European markets. Now they are not raising money. The same share they are registering in different country. Now what could be the objective? The only objective is to promote the liquidity. Now for example, you are a vendor, okay, and you are selling clothes. Now you have two options. One, to list your product only on Flipkart. Second objective is to list your product over Flipkart, Amazon, Myntra, and Jabong, XYZ. Now what is the objective of listing the same item over different platforms? To promote the sale, to promote the liquidity. Same wise, here there's a single share. Now the single share has been listed over different markets. Now what is the objective? The only objective is to promote the liquidity. So now this is possible only for those shares where there's a global demand for a company such as Google, Amazon, and Microsoft. Same wise, there's one more concept, that is investing in basket of listed DR. Now what is the meaning of this? The meaning of this is, now we are investing in a ETF. ETF means we are investing in a mutual fund, similar to mutual fund. So we are investing in an ETF, and the only objective is to diversify the portfolio. Instead of investing into single equity, we have an exposure to multiple equities. Now basket of listed DR. Now whatever the amount you're paying to for example, you're paying this amount to a mutual fund. Now mutual fund will invest this money into number instead of investing into single company DR, it will invest into multiple DRs. This concept is known as basket of listed DR. Now I'm concluding LOSD, important from exam point of view. One way invest in ADR, GDR, whether it's ADR, GDR. The difference between ADR, GDR is ADR means in America, GDR means outside America. But in both the cases, the currency is going to be dollar. Second, sponsored, unsponsored. Sponsored, subject to more regulations, and here you are dealing directly with the retail investors. Unsponsored, you are dealing with the depository bank, and these are subject to lesser regulations. Then global register share, single share, listed over multiple exchanges. Only objective is to promote liquidity. Investing in basket of listed DR instead of investing into single share, now you are investing into group of DRs so that to create a diversified portfolio. So friends, with this we have covered LOS-D. Now I'm moving to my next LOS-E. Compare the risk and return characteristics of different types of equity security. So when you invest in a share, what is your objective? Your objective is to earn dividend and capital appreciation. Now for example, today I purchase a share for rupees 100. By the end of year 1, it turned into 140. Now 40% is capital appreciation. Further, let us assume that I receive a dividend of 10 rupee. Now in totality, my profit is I purchased for rupees 100. Share value is 140 plus 10 rupees I have received as dividend. Now in totality, I am having the investment value is 150. Now what is my profit? My profit is 50%, where 40% is on account of capital appreciation and 10% is on account of dividend. Same wise, now you have to discuss about risk. Now which one is more risky if I have to make comparison between preference and equity? Now preference is less risky, equity because of residual claim are more risky. Participating versus non-participating, participating are less risky. Cumulative versus non-cumulative, cumulative are less risky. And further, convertible preference shares are less risky because you will be continuously receiving dividends, and again you have the discretion to convert or to demand the money back. Same wise, callable versus puttable. Since in puttable there is a right with the investor, they are less risky in comparison to callable. So class, this we have already covered. LOS-E. Compare the risk return characteristics of different types of equity security. Now I'm moving to F. What is the role of equity securities in financing companies' asset? Now equity is nothing but a source of liquidity. And now what is the objective of raising money with the help of equity? Now if I prepare a balance sheet, equity is on the liability side, that is source of fund. And now my objective could be with the help of this equity to purchase productive assets, that means to purchase fixed assets, or to fund my working capital requirement. So one objective is to buy productive assets. Second is to fund your working capital requirement. Third, to meet your expenses. For example, you are having employee salaries. Fourth, to invest in another companies. So these are the objectives of equity. Why we are raising money with the help of equity? To buy productive assets, to make some investments in other companies, to meet our working capital requirement, or to meet our regular day-to-day expenses. So these are the objectives of raising the money with the help of equity. G. Distinguish between market value and book value of equity. Now what do you mean by market value? Market value means market cap of the company. Now if I talk from the point of view of Reliance. Now Reliance currently has a share price equal to 2050. This is current market price. So let's go to money control. Now it has a price of 2072. So this is the current market price. This multiplied by in totality number of shares outstanding. So multiplied by outstanding shares. This will give me market cap. So now market cap is equal to, for Reliance, market cap is equal to 13 lakh crore. Now what is the meaning of this market cap? The market cap means market value of equity as on date is equal to 13 lakh crore. Now what is the meaning of book value then? Now book value means the value computed with the help of balance sheet. Now book value of equity, alternative 1, can be computed. Simply add up equity share capital plus reserves and surplus. So this is the book value of equity. Now what is the meaning of equity share capital? This is the money that shareholders paid to company. So whatever the money that you have contributed, this is known as equity share capital. Now reserves and surplus, these are the profits belonging to equity which has been reinvested in the company. These are known as reserves and surplus. Now in simple, what is the book value of equity? Book value of equity is the money in totality contributed by the shareholders, the money which they have put in the company. This is known as book value. On the other hand, market cap means what is the current price, current value of equity in the market. Now important, book value can be computed in alternative way. The alternative way is balance sheet. You want to compute the value of equity. Now value of equity is going to be, this is your total assets, from total assets minus your liabilities. Now from total assets, if I minus the liability part, I'm left with equity. So book value of equity means the money contributed by the shareholders, and market cap means what is the value of equity as on date. Now the value of equity as on date is equal to 13 lakh crore. Same wise, let us assume that you purchase one land for 60 lakh rupees in 1990. So this is your business, and in your business there is only one piece of land for which you have invested 60 lakh rupees. Today the market value of that land is 2 crore. Now what is the market cap? Market cap is 2 crore. How much money you have contributed? This is the book value. So how much money you have contributed? That is going to be 60 lakh. Okay. So now difference between the market value and the book value of equity. Same wise, in LOSH they have compared a company's cost of equity, ROE, and investors' required rate of return. So LOSH. Now when today an investor is going to invest money, he has some return expectation. So that return expectation is known as investors required rate of return. So what do you mean by investors required rate of return? This is the minimum return requirement for investing in a company, and this we learn in a chapter KE, in a chapter cost of capital, that KE is equal to, using CAPM model, KE is equal to RF plus beta RM minus RF. Okay, now we understand that this is based upon some assumption, this formula, and eventually this computing cost of equity is the most difficult task. How much equity owner wants to earn? So this we are going to compute with the help of CAPM model. KE is equal to RF plus beta RM minus RF. Now I'm going to compare this with, for example, my KE is equal to 17%. Now I'm going to compare this with ROE. Now what is the meaning of ROE? The meaning of ROE is, suppose if ROE is 20%. Now meaning of ROE equal to 20% is, if you put in 100 rupees in a company, or on 100 rupees invested in a company is earning 20 rupees over that. Now KE. For investing in a company, I want at least 17% return. ROE. If 100 rupees is invested in a company, on that 100 rupee company is earning a return of 20%. For example, from the point of view of investor, let's compute ROE. You invest in a share for rupees 100, and now that share turned to 120. How much you have earned? 20 on an investment of 100. Your ROE is 20%. Same wise, from the company point of view, if you have given 100 rupees to the company, over that company's profitability is 20%. Now what is the formula? What is money that company has eventually received? That is the book value of equity. This I have actually received, and on that money I have earned 20%. So EAT upon book value of equity. Now one is a P&L item and denominator is a balance sheet item. So always you are going to take average of balance sheet. So always you have to take average of book value of equity. Now this would be the case if you have been provided with opening, closing value, and question is silent. So always I'm going to take average. Or in the question it is specifically written that your equity is volatile. Now if my equity is volatile, again I'm going to take average. Now for example, by the end, let us assume that I borrowed 100 rupees and by the end of year 1 it turned into 120. So in totality there is an addition of 20 rupees. Now when this 20 rupees has been borrowed, one assumption starting of the year, one assumption end of the year, another assumption uniformly over the period, that is mid of the year. Which assumption is more realistic? That is average. So if it is clearly written that the equity is volatile, then I'm going to use average of book value of equity. Now if we have not been provided with opening and closing value, in that particular scenario we are going to compute ROE with the help of opening or closing value, whichever is provided. Okay, so now again I repeat. Now in the last part I'm moving to the practice problems. So this chapter is pretty simple. In totality, how many LOS we are having? In totality there are going to be 8 LOS. Okay, now a quick revision. Okay, LOS H and G. So there were two concepts: market value, book value. Market value means the current value of equity in the market. Book value means the amount which has been contributed, including the profits which has been reinvested. So over book value we compute ROE, and while investing in the money we compute KE. As an investor, I always want that I want to earn 17%. Companies earning for 100 rupees, companies earning 20. Now point is, I always want ROE to be greater than equal to, we want ROE to be greater than equal to KE. And if ROE is less than KE, for example, your return requirement is 17 and currently company is earning only 10 rupee, then there is a hint that it is not good to invest in this particular company. That means as an investor, we always want ROE to be greater than equal to KE. Then explain the role of equity. So what is the purpose of equity? To buy productive assets, to invest in another companies, to meet your expenses, or to meet your working capital requirement. Then which one is more risky? So which one is more risky is the equity, then non-participating one, non-cumulative one, and callable one. These shares are more risky. What is the return expectation? That is the dividend plus capital appreciation or both. Methods of investing in non-domestic equity, that is with the help of ADR, GDR. Point to be noted, in both the cases the currency is going to be dollar. ADR means in America, GDR means outside America, that is mostly in Luxembourg and London stock exchanges. Then global register share, single share listed over multiple currency, only to promote liquidity. And if you want to invest into group of DRs, then you have to invest in basket of listed DRs. Then distinguish between private, public, private, illiquid, corporate governance issues, financial disclosures limited, but the possibilities of fire gain if the company goes into an IPO, plus lower reporting cost. Then voting powers, there can be dual class is not a good corporate governance. And then types of equity, this we have elaboratively covered. Point to be noted, two types of equity owners have the residual claim. They control the company with the help of voting power. Two types of voting power: statutory, cumulative. Preference, to preference, dividend, liquidation. Then cumulative, non-cumulative. Skip dividend, you will receive. Cumulative, participating, receive extra dividend if profits are above predetermined level. Convertible, right to convert at the end of third year into equity. And last, callable, puttable, straight. Callable, straight means no options. Callable, puttable. Puttable, beneficial to both of them. Callable, beneficial to the companies. So class, with this we have covered all the LOS. Now friends, I am proceeding to practice problems. Problem 1. Which of the following is not a characteristics of common equity? So it represents ownership, yes. They participate in the decision making process, yes, through voting power. The company has the obligation to make dividend payments, so there is no obligation. C is correct. Then 2. The type of equity voting power, voting right, that grants one vote for each share of equity owned, that is known as statutory. Now what is the meaning of proxy voting? Proxy voting means you are the shareholder and now you are transferring this right to someone else. Someone else is going to vote on your behalf. So this is known as proxy. Cumulative means in totality all the votes you can vote in a favor of a single person. And where you are having only one vote for each share, this is known as statutory voting. Answer is B. Now all of the following are characteristics of preference shares, except now they do not have voting right. Correct. They do not share in the operating profits, in the operating performance of the company. Yes, they receive dividend by the fixed rate. So B is the characteristic, C is the characteristics. They are either callable or puttable. Incorrect. They are either callable, puttable or straight. So straight word is missing. So answer is A. Then question number 4. What do you mean by participating preference shares? They will receive an additional dividend if the profits are above a predetermined level. Answer is C. Which of the following is correct? Is about private equity is incorrect. So they cannot be sold on secondary market. Correct. Now what do you mean by secondary market? So now first, shares are issued by the company. So shares are issued to the public with the help of IPO. IPO means now the share is traded over the exchange. So now when you sell the shares directly to the shareholders, this is known as primary market. Now once a share is listed, now investors are exchanging the shares. So that exchange is known as over secondary. So they cannot be sold on secondary market. That is correct. Private equity means in this now a company like Byju's. So now the Byju's are not traded in the secondary market. So they are not listed. So they don't have any sort of secondary market. Then they are primarily issues to institutional investors. Yes. To the big investors. Yes. So now in a fund like in a company like Byju's, so they are big corporate house, they are big equity funds which have made the investments. Same wise, Facebook has made the investment in Byju's. So they are primarily issued to institutional investors. Yes. Now they have a market determined quoted price. So this is not the characteristics. Why it is incorrect? Because they are not traded in the secondary market, so they are not going to have a market determined quoted price. So answer is B. Now venture capital. So this anyways I'm going to cover post alternative, but let's try to solve it. Venture capital. Venture capital means investing in a startups. So can be publicly traded. Incorrect. Do not require a long-term commitment of the funds. Now you're investing in a startup. Now there has to be a commitment. So they do not require. B is incorrect. So correct answer is C. Anyways, we are going to cover this in under alternative investments. Which of the following most accurately describes one difference between public and private equity? Now, one difference between the two is, in case of private, the reporting cost is less in comparison to public equity. So answer is B. A is incorrect. Why? Private equity more focused on the short-term results. Incorrect. Eventually they have to come up with the IPO, so they are more focused on the long-term results. And C that they should have more open up with the investors about governance and compensation. Incorrect. Why to open up with the investors? In this case anyways, the fund has been introduced by the private investors. Okay, so now anyways, when the governance is important, when they're publicly invested money. So in this private equity anyways, there's no public money. So C is incorrect. A is incorrect. Correct answer is B. 8. Emerging markets have benefited from recent trends in the international markets. Which of the following has not been the benefit of these trends? Okay, now for example, there's a company like HDFC. Okay, now HDFC is a company in the emerging market, and now they want a money. Suppose in India the liquidity is not sufficient. Okay, now liquidity is not sufficient, you can go to America and list your share there. So this is with the help of ADR possible. Okay, so it's promoting the liquidity. Correct. So now, which have not been one of the benefits? First part is liquidity. So if in your country there is not sufficient liquidity, that means there is not significant trading, go to America and list your share there. So this is one of the benefits. A is incorrect. Now emerging companies have found it easier to raise capital in the markets of developed countries. Answer is yes. Because of this, now it has become easier for you to raise money from America. Earlier Americans are not coming to India because there is less transparency in your country. By listing your share in the America, now that problem has been solved. So yes, it has become easier. Third is, emerging market companies have benefited from stability of foreign exchange markets. This answer is incorrect. Now what is the benefit of ADR? Number one, the first benefit is liquidity. Second, it becomes easier on account of more transparency. But in a way, now you're going to list your share into America. In a way, it is promoting that now dollar rupee will become more stable. Answer is no. So it's not promoting the stability of foreign exchange between the two currency. Definitely it is promoting liquidity. Now your share is traded in the India as well as in America. Now because of more transparency, it has become easier for the company to raise money from America. But what is not the benefit of ADR? It is promoting the stability of exchange rate between the two currency. Incorrect. So C is incorrect. 9th. So C has not been the benefit. So C is the correct answer. Okay. So correct answer is C. 9th. Which of the following, when investing in unsponsored DR, voting rights is with the Citibank, that is the depository. Answer is A. With respect to level 3 sponsored ADR, which of the following is least likely to be accurate? So class, now we have to learn one table. So there, in this we are going to learn about types of ADR. Okay, now there can be in totality 4 types. First, my focus is over level 2 and level 3. So now level 2 ADR and level 3 ADR, both of them are traded on the stock exchange, and if they are traded on the stock exchange, so listing expense is going to be high. Level 2, level 3, so they are the categories. Level 2, level 3, both of them are traded on the stock exchange, and in both the cases listing expenses are high and registration with SEC is required. Okay, but now what is the difference between level 2 and level 3? Under level 2 you cannot raise new capital, whereas under level 3 you can. Now for example HDFC. Now HDFC in India is having, in totality the company is having 10,000 shares. Okay, 10,000 shares. Now HDFC wants more money, and that they wants to raise from American market, and now they go to America and raise 2,000 additional shares. This is known as level 3. Now level 2. In level 2 you can only list these shares into the American stock exchange. That means raising additional money from America is not possible. So now level 2, level 3, both of them are traded over the stock exchange. Thus, if they are traded over the stock exchange, listing expenses is high and registration with SEC is required. But now what is the difference between the two? In level 2, under level 2 you cannot raise additional capital, but in level 3 you can raise additional capital from America as well. So under level 2, existing shares are listed over the American stock exchange. Under level 3, additional shares are issued. That means we are raising money from America. Now let's come to the fourth part. Fourth part is rule 144A. That means now you are directly issuing shares to private investors. If you are directly issuing to private investors, registration is not required and listing expenses are going to be low. And in this again you can raise an additional capital. Now what is the difference between 3 and rule 144A? In level 3 you are raising money with the help of public, from the retail clients, from the public, and in rule 144A you are directly issuing them to the private institutional clients. So now if you are directly issuing to the private institutional clients, listing expenses are going to be low and registration is not required, and here you have the ability to raise large amount. Now level 1. Now level 1, the trading location is OTC, that is over the counter. Over the counter means now the share will not be listed. OTC product means now company will directly meet the investors and issue them the shares. Now the share will not be listed over the exchanges. Now for example, if tomorrow you want to sell, you have to return back to the investment bank, and now investment bank will find the another buyer for these share. So they are not traded over the exchange. It is an OTC product. OTC product means now investment bank will meet the investors, sell them the shares. Now tomorrow again you want to sell the share. You have to come to the investment bank, and now investment bank will find for another buyer. So it is going to be an OTC product. If it is an OTC product, now listing expense are going to be low. So listing expense, since we are not listing on the exchange, so listing expense are going to be low. Registration is required, and in this case you cannot raise additional capital. So class, from exam point of view, this table is not important, but try your level best to remember. So let's revise. Level 2, level 3. Only difference between is that in level 2 you cannot raise additional capital, in level 3 you can. Now difference between level 3 and rule 144A. In one you are trading with the help, you are raising money with the help of retail investors, with the public. In second, you are raising the money with the help of private. If it is private, now listing expenses are going to be low. Registration is not required with SEC because these are constitutional investors, and yes, you can raise new capital. Now level 1, simple one, OTC, customized contract. So customized contract, again listing expenses are going to be low. You can registration is required, and in this case again you cannot raise additional capital. So directly issuing shares, so registration is required. Listing expenses low because not listed over the exchange, and again you cannot raise additional capital. Okay, So this is the table. Now on the basis of this, let's solve question number 10. With respect to level 3, which of the following is least accurate? Now they are traded over the exchange. Yes. They are used to raise capital. Yes. They have low listing fees. Incorrect. Low listing fees would only be in case of level 1 and rule 144A. 10th answer is A. 11th, basket of listed DR. What could be the advantage? Getting exposure to multiple equities. 11th answer is C. 12, you have to compute your total return. Okay. Now 12th, you purchase one share for 50 rupees and you received a dividend of 2, and now the price is 40. Now the price in the market is 42. So now earlier you invested 50, value inclusive of dividend is 44. Now what is your return? So return is equal to 44 minus 50 upon 50. So answer is negative 12%. So 12th answer is A. 13th, if a US based investor purchase a euro denominated ETF and euro depreciates in value, now investor return will be, okay, so now think from this point of view. Mr. John, earning in dollar, invested in rupee, and rupee depreciates. So if rupee depreciates, the return of the investor is going to be lower. So now question number 13, a US based investors invest in euro depreciates. So if euro depreciates, the return is going to be lower. Answer is A. 14th, which of the following is incorrect about the risk of equity security? The risk of equity security is based upon uncertainty of cash flow. Yes. Uncertainty of future prices. Yes. Is measured using the standard deviation of dividend. Incorrect. So this we will learn in quants how to compute the risk. Now Reliance is risky. So how to compute the risk? So with the help of standard deviation of the prices, not with the standard deviation of dividend, because there are number of companies which are not paying dividend, and dividend is one of the events. Volatility in dividend is less, so it is not computed using the standard deviation of dividend. It is computed using the standard deviation of prices of Reliance Industry. So there is uncertainty with respect to future prices. There is uncertainty with respect to cash flows. Yes, but it is computed with the help of standard deviation of dividends. Answer is no. It is computed with the help of standard deviation of share prices. Okay. From the point of view of investor, which one is least risky? So least risky is going to be putable. Then 16th, which of the following is least likely to be the reason for a company to issue equity share capital? So now to raise capital, to increase liquidity, yes. To increase ROE. Now because of issuing additional capital, your ROE will reduce eventually. No, initially. Why? Now question number 16. Now for example, your profit for the year is 50 rupees and your equity was 100. Now you plan to raise additional equity 20 rupees. Now earlier your ROE is 50 upon 100 and now you plan to raise additional 20 rupees. Now your ROE is going to be 50 upon 120. So in that particular year your ROE will reduce. So objective is not to increase ROE, objective is to raise capital, to increase liquidity, and C, to increase return on equity. So return on equity is incorrect answer. Your ROE in the first year will reduce. 17. Which of the following is not the main goal of raising equity capital? To purchase long-lived asset, yes. To finance companies' revenue generating activity, yes. To meet your working capital, yes. To ensure that company continues as a going concern, incorrect. So this is not the role of raising capital. Role of raising capital is to meet your working capital requirement, to buy productive assets, to make investments, and to meet your expenses. So it is not to ensure that the company continue as a going concern. C is incorrect. C is the correct answer. 18th, which of the following is most accurate in describing book value? Now, book value increases when company retain its net income. Now, book value has two parts. 17. Book value has two parts: equity share capital and reserves and surplus. Now, if you keep on retaining your dividends, you keep on retaining your net income, you're not paying dividends, this will eventually increase book value. Answer is yes. So book value increases when a company retain its net income. Answer is A. Now you have to compute the book value. So book value is nothing but total assets minus liability. Now my assets is 12 million, liability is 7.5 million. So equity is 4.5 million. Answer is A. Which of the following is least accurate in describing company's market value? Management decisions do not influence market value. Incorrect. They do influence the market cap. Now, for example, tomorrow, Reliance says that we are going to make a company debt free. The moment this announcement was made, share was up by 10%. So management decisions do influence the company's market value. Answer is A. 21. Now you have to compute ROE. Okay, now we have not been provided with closing values. Okay, so now we will be computing using opening book value. Now what is the profit that you have earned? 2 million. And now what is your opening? This is your total asset, liability. So what is your equity? 50 minus 35. That means you're having an equity of 15. Over that you have earned 2. So ROE is 13.3. Now one more hint. One more practice is to compute ROE. Now if it is written stable means during the period company have not raised any new equity. Now you have earned, in this case you have earned 2 million. So now this 2 million is earned over opening book value. Okay, so the moment word written stable, that means you have to compute ROE on opening book value. If it is written volatile, that means you have to compute using average values. Okay, so question number 21, answer is B. 22, holding all other factors constant, which of the following will lead to increase in the ROE? Which of the following will lead to increase in ROE? Market price of the company share increases, no impact on the ROE. Net income increases at a lower rate than shareholders' equity. Now numerator is increasing at a lower rate, denominator increasing at a higher rate. This will lead to a lower ROE. Company issues debt to repurchase outstanding shares. So answer is C. How come C? Now let us assume that now my EBIT is 1000, interest 100, EBT is 900, tax 0, so EAT is 900. Okay, and now equity, debt. Now equity is, let us assume, now equity is this is 1000, and equity is, let us assume equity is 1800. Okay, now what company does? Now company repays the equity with the help of debt. So debt you have borrowed at, your debt is at 10%. Now company decided that we want to buy back shares rupees 100. Now if you want to buy back share rupees 100, what is going to be revised equity? 900 and revised debt 1100. Okay. Now 1000. Now how much interest you have to pay? 110. You are left with 890. Now what was your earlier ROE? Your earlier ROE was 900 upon 1800. That means 50%. But now what is your revised ROE? Now revised ROE is 52.35. Now how? With the help of increasing the debt, we have increased ROE. Now important. Debt was at 10% rate of interest. Debt was at 10% and over ROE you are earning 50. Now you decided that we are going to pay off some equity holders. Now if you pay off some equity holders and to repay them you borrowed at 10%. Profitability of your business is 50. Now whatever is left, whatever the shoulders left, now their ROE has been boosted. So how we have improved the ROE? In this case, debt was at 10%, but equity holders eventually earning 50. Now I decided that from these equity which are earning 50, let's repay some of them with the help of debt. So debt you have borrowed at 10%. You borrowed at 10% and you repay them. Now in this manner the remaining promoters ROE is boosted. So now let's go through 22 again. Holding all other factors to be constant, which of the following will most likely lead to increase in ROE? A. Market price. Market price has no impact over ROE. Second, your numerator increases at a lower rate than the denominator. So if denominator is increasing at a higher rate, your ROE will reduce. Now which one can lead to the higher ROE? If you repay the debt, so if you repay the equity with the help of debt. Now one more example. Let us assume that you invest in a share. There are two possibilities. So 100 rupees share, there are two possibilities. So you invest in a share with the possibility of that share will turn 120. What is your ROE? Your ROE is 20%. Okay. Now let us assume that you can borrow the money. Now 100 you are introducing 60 rupees as equity, 40 rupees as debt. And now in totality you have an expectation that the ROE, the profits are going to be 20%. So you borrowed at 10%. Now share turned to 120. Now 120 you have to repay the debt along with interest. So now you have to repay 44. You are left with 76. This 76 you have earned. So how much you have earned? 16 rupees. So you put 60. You have the investment value 76. So you have earned 16 over a capital of 60. Your ROE, earlier ROE was 20, revised ROE is 26.67%. That means debt is acting as an enhancing factor. Debt in a way boosted your ROE, but this scenario is true only if there is a profit. Same way, if there is a losses, then your losses will be, your ROE, your losses in percentage terms will enhance. So debt is acting as an enhancing factor. So answer is C. Which of the following most difficult to calculate? That is cost of equity. CAPM, it is based upon lot many assumptions. This we eventually learn. The company's cost of equity is often referred to as investors' minimum required rate of return. 25th. The advantage to an investor owning a convertible preference share is, the advantage is that he is not participating in the volatility. So most likely include less price volatility than the underlying common shares. Why? Because for the first 3 years anyways you are receiving the fixed dividend, and in the end of third year it is your it is your discretion whether to buy the share or to demand your money back. So you are not participating in the volatility. So answer is A. B is incorrect because it is in case of participating preference shares, and C is incorrect. There is no contractual obligation. So dividends would only be paid if there are profits. So B is incorrect, C is incorrect. Now 26, which of the following is most correct? So putable are beneficial both to the company and to the investor. Answer is A. 27th, if an analyst estimates that the market value of investment is 115% of their reported book value, you have to compute price to adjusted book value ratio. So 27th, price to adjusted book value. Now price is 15. Now revised book value per share. Revised book value per share. So this is equal to 15 divided by. Now what do you mean by book value? Book value means value of assets minus liability. Now asset is 0.4 plus 1.2 plus 40, now 6. So instead of 6 we will take 6 multiplied by 115 divided by 100. So instead of 6 we are going to take 6.9 plus 30 minus 1 minus 61. How many shares there are? In totality there are 1 million share. So divided by 1. So if I solve, 0.4 plus 1.2 plus 40 plus 6.9 plus 30 minus 1 minus 61. So this is 16.5. 15 divided by 16.5. Answer is 0.91. Answer is A. 28. Assuming the company experience volatile year-end. Volatile year-end means you have to use average. You have to compute ROE for 2012. So this value divided by average of this. So 11550 plus 15015 divided by 2. Your average ROE is 13282500. Now your profits are 1980300. So this is equal to 14.91%. Answer is B. So friends, with this we have covered first chapter of equity, a pretty simple one. Okay, so now you have to revise your hand notes, solve these 28 questions before proceeding to next part. Thank you. Hello friends, today we are going to start with reading equity valuation concepts and basic tools. Okay, so let's have a broad understanding of what we are going to learn in this reading. Okay, now what is the meaning of valuation? So valuation means you have to find out the fair value of a share, and whatever the fair value is going to be as per analyst, that fair value is known as intrinsic value. Okay, now for example, if we watch in the news channel, they used to say that JB Morgan has a target of 2200 for Reliance with a buy recommendation, or let us assume that Motilal Oswal has a buy recommendation on Airtel with a target of 700. Now what is the meaning of this? So now Here the analyst is Motilal Oswal, and as per Motilal Oswal, Airtel has an intrinsic value of 700, where let us assume that the current market price is 600. So as per Motilal Oswal, intrinsic value is more than current market price. That is, share is undervalued and they have a recommendation to buy the stock. So if you buy the stock, eventually you will earn 100 rupees over an investment of 600. Now this value which analyst has computed, this is known as intrinsic value. Now let's discuss what are the techniques to find out the intrinsic value. Okay, now valuations are broadly divided into two parts. One valuation is known as absolute technique, and second is relative. Within relative we have two parts: net asset value, that is NAV approach, discounted cash flow, that is DCF. Within DCF again there are two parts: dividend discount model and free cash flow to equity model. Okay, so this is a broad overview with respect to valuations. Okay, one relative, absolute. Absolute has two parts: NAV, DCF. DCF again has two parts, that is DDM and free cash flow to equity. Now my question is, let us assume that you have your property, you're staying in your house, and this property, now I ask you that what is the proper value of this property. Okay, now you have one house. Okay, so this house belongs to your parents and you are staying here for last, let us assume for last 10 years. And now I want you to compute the value of this particular house. So typically how we compute the value? Now let us assume that one of the students says that, sir, the value of my house is 2 crore. Now how he has computed the value of 2 crore? So now what is the rationale that student used to give? Okay, now the rationale is, sir, recently there has been a transaction in my locality. Okay, recently there has been a transaction in my locality. That transaction happened at 2 crore. So based upon that benchmark, the value of my house is 2 crore. Now let us assume that my house number is 1913, sector 16, Faridabad. Okay, and my house is 250 square yard. And recently there has been transaction of house number 1912, sector 16, Faridabad. Okay, just the house just next to me, my house, and it also has same area, that is 250 square yard, same locality, same area. Can we say that based upon this multiple, based upon this transaction, the value of my house is 250, the value of my house is 2 crore? Now this valuation is known as relative. Now what is the meaning of relative? Now in relative we are going to find out the comparable companies, and based upon the value of comparable companies we are going to find out the value of target company. Now for example, now suppose I want to find out the company of the value of suppose Nestle. So a company in FMCG domain. So now what are the comparable companies? Now the comparable company is Hindustan Unilever Limited, Tata Consumers. So these are the comparable one. Now based upon at which multiple these companies are trading, based upon the valuation of comparable companies, I'm going to find out the value of target company. Okay, now before I jump to the main example, now let us assume that you get admission into ISB or you get admission into IIM Ahmedabad. Now my question is, after completing your MBA, what is the package you are anticipating? Okay, so this is my question. Now the answer is, So once I complete my MBA, my average package is going to be 16 lakh per annum. For example, this is the value. Now how you computed this value? Again, sir, the rationale is, the benchmark is, based upon the last year placement report, a student get an average package of 16 lakh. So based upon that assumption, my value is equal to, or my package is going to be 16 lakh per annum. So technique is relative. Relative means you have to find out comparable companies, and based upon that comparable companies, you are going to find out the value of target company. For example, finding the value of Nestle with the help of HUL and Tata consumers. Okay, so this was a broad overview with respect to relative. Now absolute. Absolute means here we are not going to make any sort of comparison. So now biggest disadvantage of relative is, to find out the exact comparable company. Exact comparable. Now for example, in practical life, do we have a exact comparable to Reliance? Answer is no. Now Reliance is a conglomerate where they are present into refinery business, oil business, retail, petrochemicals, telecom. So finding an exact comparable to a company like ITC, Reliance, it is a difficult task. So the biggest problem with relative is to find the exact comparable, which may not be possible in real life scenarios. Now absolute. So this we eventually learn that how to deal with this particular limitation. Okay. Now absolute. Absolute means now here we are not going to make any sort of comparison. So first is NAV technique. Now when we should use NAV. So NAV technique is used when you are not interested in the business. As an investor, you are not interested in the business, but you are more interested into the assets of the company. So you are more interested into the assets of the company. Now, for example, you always want to open up a restaurant, and in your locality there's a restaurant by the name Agarwal Sweets. Okay, so this Agarwal Sweets has a very good location. Okay, but eventually the food is not of good quality, because of which finally the store is getting shut down. Okay, so they finally decided that we want to close this particular store. Now you visit the store. Okay, and now you want to open up your restaurant at this particular location only. Okay, so it's a corner shop with a good footfall, and you want to open your shop here only. Now point is, whenever you're going to open up the store here, will you use the same name, that is the Agarwal Sweets, or you're going to change the name of your store? So at any given day, you're not going to use the same name, that is Agarwal Sweets. Why? Because the shop is getting closed because the food is not of good quality. Okay, now suppose you want to acquire this. Now whenever you want to acquire this, you will value the business, or value assets. Now what is the meaning of value business or value assets? Now for example, in this store they have a kitchen, ready-made kitchen, utensils, furniture, AC. So one way is to find out the fair values of these assets and pay this much to Agarwal Sweet, to owner of Agarwal Sweets. One way. Second is to compute the value of the business, and pay that much amount. Now for example, instead of Agarwal Sweets, the store name is Haldiram. Now if you want to take a franchisee of Haldiram, or if you want to buy Haldiram, will Haldiram charge only the prices of assets, or the Haldiram owner is going to charge a premium? Now Haldiram will not charge the value of asset. He will charge the value of business, the goodwill of the business. Now my point is, when NAV is used, NAV techniques is used when we are more interested in the asset of the business and not interested in the business. Now, one more example. There's a company by the name Jet Airways. So this company is having a huge debt and company is now bankrupt. So the company name is Jet Airways. Now this company is into the aviation sector, and where the compatible companies are Indigo and SpiceJet. Now my point is, this company is getting bankrupt with huge debt, and now company like Indigo and SpiceJet are bidding for this company. Now my point is, they want to acquire the business. Acquire the business means now going forward they are going to run this airlines business with the name of Jet Airways. So they are going to, my first question, they are more interested into the business of Jet Airways, or they are more interested into the assets? Now they are more interested into the tangible assets of Jet Airways. Now what are the assets with Jet Airways? Now assets that Jet Airways is having, that is going to be fleet of their aircrafts. So in this particular case, what is going to be, how you're going to value, you simply find out the fair value of you're going to find out the fair value of aircrafts, and that is the amount that you're going to pay to Jet Airways. So technique name is NAV. What is the meaning of NAV? When an investor is more interested into the assets and not into the business. So he will only find out the fair value of assets. In case of Jet Airways, the fair value of aircrafts, and we are going to pay you that much amount. So this technique is typically used when we are more interested into the assets and not the business. Now the technique is DCF. Now DCF, again, two types. So now when I invest in a stock, I have two objectives. One, to earn dividend. Second, to earn capital appreciation. Now your objective is only to earn dividend. Then that is the technique we are going to use, DDM. Now this dividend you will receive till infinity. Now how to find out the value of cash flows if you are going to receive till infinity? There will be two ways. If recall from TVM chapter, if cash flows are constant, then cash flow upon discount rate, and if cash flows are growing, then formula is going to be CF1 upon discount rate minus growth rate, where growth rate is equal to ROE multiplied by retention ratio. So DDM. And second approach is free cash flow to equity. This technique we used when we are more interested into the capital appreciation part. Okay, so which technique we extensively use? So in India, means stocks are not having huge dividend yield. That means our purpose is not to earn dividend, but our objective is to have capital appreciation. So which technique in the practical life we extensively use? That is DCF, and within DCF that is going to be free cash flow to equity. So objective is to earn dividend, DDM approach. Objective is the capital appreciation. Then you have to find out fair value, intrinsic value, using free cash flow to equity approach. Now when we compute the value of Reliance, HUL, Tata Consumer, so brokering house like Motilal Oswal, so which technique they extensively use? That is going to be free cash flow to equity. Okay, so friends, this was the broad overview. Again, I'm going to just revise the entire concept. Okay, what do you mean by valuation? Valuation means finding out the true value of an asset. Now true value means intrinsic value as per the analyst. There are going to be two techniques: absolute, relative. Relative means finding out the values with the help of comparable companies. Absolute, NAV, DCF. NAV technique is used when we are more interested into the assets and not the business. DCF means when your objective is to earn dividend or capital appreciation. If objective is to earn only dividend, then DDM approach, and if your objective is capital appreciation, then free cash flow to equity. Now point to be noted, under DCF technique, what we are going to do, we are going to project the future cash flows and discount that using our required rate of return, where required rate of return is going to be computed as per the CAPM approach. So this was the broad overview with respect to this particular chapter. Okay, Now I'm starting with my first LOS. Now evaluate. So this is LOS A. Evaluate whether a security, given its current market price and value estimate, is overvalued, fairly valued, and undervalued. Okay. Now let us assume that LOS A. So let us assume that currently the current market price of Reliance is 2100. Okay. And as per Motilal Oswal, the intrinsic value of the company is 2400, or intrinsic value of the company is 3000. Okay. So now currently stock has a price of 2100, but as per your estimates, the intrinsic value of the company is equal to 3000. Now point is very simple. You are going to buy the share or sell the share. So your recommendation would be buy. And if you are buying the share, that means currently share is undervalued, overvalued. So if you are buying, that means currently it is undervalued. Fair value is 3000, currently selling in the market for 2100. And when a share is undervalued, when intrinsic value is greater than CMP. So now when a share is undervalued, the share is going to be undervalued when intrinsic value is more than CMP, and the recommendation is to buy the stock. Same wise, let us assume that there is a stock Airtel with a CMP of current market price of 500 and intrinsic value of 400. So will you buy or will you sell? Assuming that you already have Airtel, so will you buy more or you're going to sell your holdings? So now as per your analysis, value in the future will reduce to 400. So now today you are going to sell this share. And if you decided that I want to sell, that means share is overvalued. And when a share is overvalued, when intrinsic value is less than CMP. And last, let us assume the company name is Tata Consumers. As per Motilal Oswal, intrinsic value is 600. Currently stock is trading at 600. Now your recommendation is to hold the stock. Stock is fairly valued, and fairly valued when intrinsic value is equal to CMP. So now when a stock is undervalued, when intrinsic value is more, when a stock is overvalued, when intrinsic value is less, and when a stock is fairly valued, when intrinsic value is equal to CMP. Now my point is, there are two stocks. Okay, one, a stock like Reliance. It is the company with the largest market cap in the country, and it is the share with the largest weight in the Nifty 50. And on the other hand, there's a company, and this company has a market cap of around 14 lakh crore. On the other hand, there's a share like Bata India with a market cap of 15,000 crore. Now my point is, in which share it is difficult to earn an extraordinary return? In which share? Now assuming that, before I jump to this part, now assume that I'm into the teaching business, and in one scenario there are numerous teachers available in the market. Number of teachers are available in the market. Scenario 1. And in scenario 2, there are only few teachers, 1 or 2 teachers is available in the market. Now my point is, in which scenario it is easy or in which scenario it is difficult to make more money? Now, if there are large number of teachers in the market, then it becomes difficult to earn money. Okay. Same wise, my question is, there are two stocks, Reliance, Bata. Now, majority of the investment banks, majority of the people will observe, they keep on monitoring which stock. So in the stock market, we keep on monitoring Reliance. So it is a stock which is followed by many analysts, and in comparison to Reliance, a stock like Bata may be followed by few analysts. Now my point is where it is possible to earn money. Now if it is followed by many analysts, then the possibility of mispricing in case of Reliance. Now when you can make money, either it's going to be overvalued, undervalued. That means there is some mispricing. If it is fairly valued, then you cannot make money. Now my point is, where do you think that a share is going to be fairly valued? Which category of share? Reliance or Bata? Now Reliance is followed by many analysts. So possibilities of mispricing, high or low? Possibility of mispricing is going to be low because it is followed by many analysts. On the other hand, a share which is followed by few analysts, possibilities of mispricing is high, and eventually you want to make money. And eventually, if you want to make money, for example, this is the target for Bata, and eventually if you want to make money, then current market price should converge to, then this current market price should converge or should convert to, eventually it should arrive the value of 3,000 to make profits. So important point, in which case do you think the mispricing could be higher? So mispricing is higher. Mispricing is higher in case of stocks which is followed by few analysts. And when eventually you will realize the gain, when CMP, current market price, converges to intrinsic value, plus you are confident with respect to your estimates. In this way, you will be earning profits. So first, to make the profits in the share market, mispricing is required. Where there is a possibility of high mispricing, this is going to be a case with a share like which is followed by few analysts. For example, Bata. Now whatever your target is, for example, your target for the Bata is 3,000. Now CMP should converge to intrinsic value in the future in order to make the profits. So this was your LOSA. So now a quick revision. When a share is undervalued, so when intrinsic value is more than CMP, fairly valued when intrinsic value is equal to CMP, and overvalued when intrinsic value is less than CMP. A recommendation: buy, hold and sell. And in order to make the money, there should be mispricing, and mispricing would be observed more in case of shares which are followed by few analysts, and eventually it should converge to CMP to make the profits. It should converge to intrinsic value to make the profits. So this was LOSA. LOSB, you have to describe the major categories of valuation model. So this we have covered. Valuation has two techniques. One absolute, second relative. Absolute has two parts, NAV, DCF. DCF has two parts, DDM and free cash flow to equity. Okay. So elaboratively, with the help of examples, we are going to discuss each of technique. Okay. Later on with the help of examples. Now LOSC. You have to describe regular cash dividend, extra dividend, stock dividend, stock splits, reverse stock splits and share repurchase. So LOSC. Now if I talk about a company like ITC, okay. Now a company like ITC suppose has a profit of around 14,000 crore. Okay. So this company has a history of paying a good dividend. Okay. So now let us assume that in their case the dividend payout ratio is close to 50%. Now dividend payout ratio equal to 50% means every year this company declares a dividend of 7,000 crore in totality. Okay. Now this is the regular dividends. What do you mean by regular dividends? Regular dividends means out of your regular profits, you are distributing dividends to the shareholder. regular, from your regular business, regular earnings. Second word is extra dividend. Extra dividend means special dividend. Now for example, ITC is present into different business segment, that is tobacco business, then paper, hotel, FMCG. So there are a number of business in which ITC is present. And tomorrow let us assume that ITC decides that we want to sell hotel division to Oberoi Hotel. Okay, so they are entering into a transaction and they finally decided that we want to sell hotel division to Oberoi, because of which they earn some special profits, one-time profit, and that one-time profit is equal to 20,000 crore on account of sale of their hotel division to Oberoi Hotel. Now company decided that this profit we want to distribute as dividend. Now it would be termed as special. Now what is the difference between special and regular? Regular means out of my regular earnings, out of my regular profits, whereas special means it is a one-time event. So shareholders do not anticipate these profits, these dividends we are going to distribute in the future as well. It is one-time event on account of a one-time. It is a special dividend on account of event like where we have sell one division on profit and we want to distribute that. That means regular dividend is the one. Regular dividend is the one that company distributes on regular basis, year on year. So how this dividend works, this dividend system works. So first of all, dividend is proposed by the management. So let us assume management decide that we want to distribute 50% of the profit as dividends. Now this is proposed to shareholders in the AGM. Now by the voting power, shareholders will decide whether to declare the dividend yes or no as proposed by the management. So now if management has proposed 50% of profits to be distributed as dividends, so the discretion with shareholder is whether say yes or no. That means they cannot change or alter this particular amount. So either to say yes or no, whether we should pay a dividend of 50% yes or no. This is only the discretion with management. And which resolution is required? Ordinary resolution is required. It is an ordinary business. That means 50% vote, more than 50% vote, if it is in favor, then the company is going to declare and pay a dividend of 50% of profits. So this is the way dividend works. Regular. Special means, so it is regular means recurring as well, every year. Profits are stable, company will keep on distributing this dividends. Special, on account of one of special events, one-time event, such as sale of division, you earn some profits and you want to distribute that. This is going to be of non-recurring in nature. Then the word is stock dividend, stock splits. Okay, so now what is stock dividend? Stock split or bonus shares. Okay, so now from the finance point of view, all these words have the same meaning. Okay, now let's understand what will be the impact of this particular by giving the stock dividend or bonus share. What is going to be the impact? Okay, now my point is, in our country, the largest the share which is having the largest price, that is MRF. Okay, so this is the share with the largest price in the country. So now if I go to money control, I type here Reliance. I type here MRF. Now MRF has a price of 87,000. So this company is in the tire domain, and if I take another company in the tire domain, that is JK Tire. So let's observe the price of JK Tire as well. Now JK Tire has a price of 120. Now my point is, which share do you think that will have more volume? Now what is the meaning of volume? That means quantity bought and sold on regular basis. So now compare this with their two cars. One car is Alto. Alto have a value of close to 3 lakh, and then there is a BMW where one car is equal to 50 lakh. Which on regular basis, which in quantity terms, which car sold more? Now my point is the one which is cheaper. That means in India, the quantity sold, the volume sold of Alto is way more than BMW because Alto is cheaper. Same wise, now there are two stocks, MRF and JK Tire. Both of them are in the same sector, that is the tire. Now my point is, which one will have the more volume? Now look at the volume of JK Tire. Now in the entire, now in the entire day, volume is 1 million or volume is 10 lakh. That means in the entire day, this share has been, in totality, has been brought and sold 10 lakh times. Okay, so volume is 10 lakh. If I compare this to MRF, MRF has a volume of 22,000. Now my point is, which share is more liquid? Now for example, I'm having 50,000 share of MRF and 50,000 share of JK Tire. In both the case, I'm having 50,000. Now which one is having more liquidity? That means which one is easier to sell? Now in a single day, JK Tire has a volume of 10 lakh. MRF has a volume of 22,000 only. Now if today I want to sell this 50,000 shares in the market, is there sufficient liquidity for this 50,000? Answer is no. In a single day, maximum these shares have been bought, that is equal to 22,000. Now if I want to sell this 50,000, then there is going to be a selling pressure in the market. That means in case of MRF, liquidity is not there, and JK Tire is more liquid in comparison to, in quantity terms, in comparison to MRF. Now how to promote liquidity of the share? So now if you want to promote the liquidity, if you want to increase the volume, it is very simple. Now one share of MRF, so let us assume I'm having one share and price is 90,000. So now my net worth is 90,000 rupees. Now if I want to promote liquidity, you have to reduce this price. Okay. Now what company decides? Company says that I want to split my share. I want to split one share into two parts. Okay. Now if you split one share into two parts, so earlier I was having one share. Now you want to divide into two parts. Now how many shares I'm having? Now you will be having 2 shares. But my point is very simple. I understand that now I'm having 2 shares, but now the value of each share is going to be, now value of each share will proportionately be reduced. That means now the value of each share will reduce to 45,000 and leaving my total net worth unchanged. That means because of stock splits or bonus share, there's going to be no impact over the net worth of an investor. Only it is going to make, only you're dividing your shares. So now my share price will reduce to 45,000, but now correspondingly I'm having 2 shares. leaving my net worth unchanged. So now what is the purpose of split? The purpose of split is only to reduce the share price, number of quantity correspondingly increases, and leaving the net worth of an individual unchanged. Some ways it can be done with the help of bonus shares as well. Bonus shares or stock dividend. Now, for example, company decides that I want to give 100% stock dividend. Now, what is the meaning of stock dividend? First of all, stock dividend is a non-cash transaction. Stock dividend. I want to declare 100% stock dividend. That means whosoever is having one share is going to be provided free of cost. Now, how many shares he is going to have? Now, an investor earlier who was having one, now he will be having 2 shares. But correspondingly, the price per share will be reduced to, correspondingly per share price will reduce by 1/2. That means now my per share price is going to be 45,000. Now the question arises, what is the reasons for stock split or bonus share? Only to reduce the price so that the liquidity is going to be promoted. Else it is not having any other objective. No cash flow is coming to the company, no cash inflow, cash outflow. It is only promoting the liquidity of a share. Now, if I talk about a company like Google, Apple, Reliance, TCS, Bajaj Finance, HDFC, all these companies continuously give bonus share. Now, what is the objective of this bonus share? So that the liquidity of the share is promoted. Okay. Now, same wise, if I want to talk about a company like DHFL, PC Jewelers. So these companies have been bankrupted now. DHFL, Jet Airways, PC Jewelers. Now my point is, next concept is reverse split. Again reverse split. Objective would be to promote liquidity. Now, for example, currently the price of Jet Airways is 10 rupee. Okay. Whereas the other comparable stocks like Indigo is trading at around 1600 and SpiceJet is trading at 100 rupee. Okay, so these are the comparable companies. Now Jet Airways is trading at 10 rupee. Now prima facie it looks like that it is a cheap stock, and a cheap stock means prima facie we may assume that it is a cheap stock and maybe the stock is not of good quality. Now to change the perception of an investor, now what company does? Let us assume that I am having 10 shares and each share has a value of, each share has a value of 10 rupee. In totality, my net worth is 100. Now what company does? Now company says, I understand that you have 10 shares and now I want to plug this 10 into one part. So reverse split. Now we are combining 10 stocks and that 10 stocks will be converted to 1. Now my point is, earlier I was having 10 shares. Now I'm having 1. But correspondingly, earlier one share has a value of 10. Now one share has the value of 100, leaving my net worth unchanged. So now prices have been increased. Reverse split. Now which company does reverse split? Those companies whose share have fallen significantly in the market, they resort to they increase the price with the help of reverse split. And those companies where share price have increased a lot, to reduce the prices, they done with the help of stock splits. Now recently there have been a stock split in case of Eicher Motors. So this company share was at around 22,000 and finally company decided that we want to split one share into 10 parts, as a result of which per share value reduced to 2200. Reverse split is meant for those companies whose share price have fallen a lot, and again to increase the prices, we are combining 10 shares into one pint. Point to be noted, whether it's a stock split or reverse stock splits. Objective is only to promote the liquidity, and they will not be impacting net worth, or there's not going to be any cash inflow or outflow. Okay. Now next one is share repurchase. Now what is the meaning of share repurchase? So if I talk about a company like TCS, so now TCS has a annual profits of 35,000 crore. So this is the annual profit of TCS. Okay. And this company is debt free. Okay. And companies as of now is not planning any sort of expansion. So every year there's a profit of 35,000 crore. Company is debt free, and there is no plan of expanding further, no expansion plan as of now. Now my point is, one way is to distribute this profit as dividends, but eventually you will learn in level 2 that declaring dividends you have to pay huge amount of taxes to the government. So now first you have already paid income tax to the government, then you have to pay dividend distribution tax to the government, and again investor has to pay taxes on this dividend income. That means if you want to declare dividends, so in case of dividends you have to pay huge taxes to the government. Now the alternative way is to buy back the share. Now what is the meaning of buyback? Buyback means returning the capital of shareholder. Okay. Now for example, currently TCS is trading at 3,000 rupees in the market. So this is the current market price of TCS. Now TCS decides that I want to buy back the shares at a price of 3,200. Now whosoever is having the share of the company, return it back to the company, and company will pay 3,200. This is known as buyback. And companies like TCS, Wipro, they are continuously doing buyback. Buyback means share repurchase. You are returning the capital of your shareholder. Now why it is necessary? Now why these companies are returning the capital? So now I'm already debt free. I don't have any scope for expansion. So now in order to promote the ROE of the business, they are returning the capital. Now for example, next year, let us assume that my profits are 35,000 crore. But now ROE, but now equity has reduced on account of buyback. Eventually this will promote the ROE of the business. If you don't require the money, it's better to pay off or to return it back to the shareholders. And always share buyback will come at a price premium to the market. Now if it comes at 3,000, then instead of returning to the company, you will sell the share in the market. So always buyback will come at a premium to current market price. Now my point is, now suppose a company like TCS is coming up with a buyback of 15,000 crore. That means in totality they are going to buy back how many shares? Where one share is equal to 3,000. So 15,000 crore divided by 3,000. That means they are going to buy back 5 crore shares. Now for example, if they receive application for 120 crore shares. Now in this case company will use the software, and now computer will randomly select those 5 crore shares which are going to be repaid. Okay. So typically if company like TCS, they are coming up with a buyback, so it is more or less oversubscribed. Oversubscribed means they want to buy back 5 crore shares, they received more application, and if the company has received more application, then how we are going to proceed with the buyback? Now computer will randomly select the investors, and we are going to buy back those particular shares. So in totality, I'm going to buy back 5 crore shares. Okay, so now let's go through one of the news articles. TCS buyback. So TCS, Wipro, they continuously buy back these shares. Now there's an offer. It is on 6 January 2021. Now TCS is coming up with a buyback, and this time the buyback is of nearly 10,000 crore. So now they are going to buy 3.3 crore shares worth 10,000. Okay, and at which price the buyback is coming? So the company is offering a buyback at 3,000 per share. Okay, so all the IT companies, TCS, Wipro, they continuously come with the buyback. Okay, so now again I'm coming back to LOSC. Regular cash dividends, extra dividends, stock split, reverse stock splits, and share repurchase. Now let's quickly revise. Regular dividends will be paid from regular profits. Extra dividend, if there's some special event, for example, if you have sold one of the divisions at profit, now you want to distribute that. Now special means it is going to be non-recurring in the future. Stock dividend, stock splits. Now what will happen? Your share prices will reduce, but number of outstanding shares will increase. The only objective is to make the share cheaper to promote liquidity. Reverse stock split will make the share expensive to change the perception of an investor, again with the view to promote liquidity, leaving the net worth of an investor unchanged. And share repurchase means buy back the share. Typically it comes at a premium, and eventually in level 2 we will learn that it is the better way in comparison to dividends. Why? Because over dividends you have to pay huge taxes to the government, and here in case of repurchase taxes are less, and hence an effective way, more beneficial way from the point of view of an investor. So LOSA, LOSB, LOSC. Now I'm moving to LOSD. Now how the dividend payment systems work. Now in totality there are going to be 4 stages. LOSD. So first one is declaration date. So we just learned that the dividends are proposed by the management, and eventually resolution is passed in the AGM. So when the resolution is passed, that is known as declaration date. Now company declared that we are going to pay dividends. Now for example, that declaration date is the date on which your AGM held. That date is 1st January 2021. So this is the date on which AGM held, and finally declared that yes, we are going to pay a dividend of, let us assume, X amount to the shareholders. Now as per the Companies Act 2013, you have to pay dividends to the shareholder. Now this amount should be transferred to your shareholders account within 21 days. So this is the law in our country. This will differ from country to country. So now my point is, what is going to be the payment date? Now payment date is going to be 22 January 2021. Now what is the meaning of payment date? That means on which date you are going to transfer this amount to the shareholders. Now company says I'm going to transfer this amount on 22nd January 2021. Now payment date. Payment date is decided by law, and in our country it should be transferred within 21 days from the declaration date. Okay, so maximum by 22 Jan 2021, the dividends should be transferred to shareholders account. So one date is declaration, second is payment. So payment prescribed by the law. Now there is a date. Holder of record date. Holder of record date. Now what is the meaning of this? Now in case of companies like, now if I jump to the lines, Now in case of Reliance, in a single day there is a volume of 7.7 million or 77 lakh shares has been exchanged in a single day. Now my point is, that means in case of Reliance or in case of any listed companies, shareholders are changing on regular basis. So now in a single day there is a trading of 7.7 million shares. That means shareholders are changing on regular basis. Now my point is, which shareholder will receive this dividend? In a company, you have to decide one date. Now let us assume that that date is 15th January. Now what is the meaning of this? Again, this date has been decided by the company. Now 15 Jan means if holder of record date is 15 Jan, if this date is 15 Jan 2021, then it means that whosoever is the shareholder of the company as on 15th January 2021, he will receive dividends. So now I understand that on 21st January I am going to transfer dividend. Now to which shareholder the dividend will be transferred? Only to those shareholder who are the shareholder of the company as on 15th January 2021, only that shareholder will receive the dividend. Now my point is, this again we will learn in equity introductory chapter, that is market organization. In our country, the settlement system is T+2. Now what is the meaning of T+2? So suppose if I buy a stock today, this is the transaction date. So if I buy the stock today, and today the date is, let us assume 12th January, I will become the shareholder T+2. So I will become the shareholder. My name will be updated in the shareholder register on 14th January. So in our country, the settlement system is T+2. Now my point is, if I want to receive dividend, so now my name should be updated by 15th January. Now if I want my name to be updated in the shareholder register by 15th January, then maximum I shall purchase the stock by. Now if you purchase the stock on 14th, your name will be updated on 16th. If you purchase the share on 13th, your name will be updated by 15th January. So maximum I shall purchase the share by. Now maximum you purchase the share by 13th January. Now my point is, suppose company share is trading at 100 rupee. On 13th January, whosoever buy the stock will receive dividend. That means whosoever will purchase the share on 14th January, he will not receive the dividend. Dividend will not be received. Will not receive dividend. Now my point is, what will happen on 14th January? So 14th January is known as ex-dividend date. Typically ex-dividend date is 1 day prior to holder of record date. So in my case, ex-dividend date is 14th January. And now let us assume that by the end of 13th January, share price is 100 rupee. Now whosoever will buy on 13th, he will receive the dividend. And let us assume that company is paying a dividend of 40 rupees per share. Now my point is, what will happen on 14th January? So now think from this point of view. You have a FD in a bank. On 13th January, your investment value is 100 rupees. Your investment value is 100 rupees. and now bank decides to give you an interest of 40 rupee. What will happen to your investment value on very next day? So on very next day, when in the share market, the share will open at 60 rupees. So it is the first date when share will trade without dividend. Now why the share prices have reduced? So the prices on 13th is inclusive of dividend. So it's trading at 100 rupees. Now since whosoever will buy on 14th, he is not going to receive that dividend. So he will pay a lesser price. So he will pay in the market a price equal to 60. So important 4 dates. Number 1, declaration date. The date on which it has been declared in the AGM. For example, that date is 1st January. Now within 21 days, you have to transfer this amount to the shareholders account. That is the payment date. Okay. So 1st January, 22 January. Now which shareholder will receive this dividend? This has to be decided by the company. Now company decide that holder of record date is 15th January. Now whosoever is my shareholder as in 15th January will receive the dividend. Correct. Now that means X dividend date is 14th January. So if you want to receive the dividends, you should purchase share maximum by 13th January. Now 14th January is known as X dividend date. It is typically 1 day prior to holder of record date. In case of countries where settlement system is T+2, in some countries settlement is T+3. In that case, X dividend date is 2 days prior to holder of record date. Now what is the meaning of X dividend? X dividend means share will trade without dividend. That means share prices will reduce by the amount of dividend. Since I'm not receiving the dividend, why? Investor will pay a price of 100. So important. Again, 4 important dates. Declaration date, payment date, this is decided by law, holder of record date, decided by company, and typically 1 day prior is known as X dividend date, again decided by law. This is the date that share will trade without dividend. That means whosoever will buy will not receive the dividend. Then he is going to pay a lesser price that is equal to, for example, the last day price is, previous closing price is 100, dividend is 40. Now is going to pay 60 rupees for the stock. So whenever there is an X dividend date, share prices will reduce by the amount of dividend. So this is the order of dividend payment, LOS-D. Okay, so class, we have covered 3 LOS, LOS A, B, C, D. So now quickly I'm revising all these 4 concepts before proceeding further. First, what do you mean by intrinsic value? Intrinsic value means the fair value as per analyst. Now a share will be over or undervalued when there is going to be mispricing. Undervalued, a share will be undervalued when intrinsic value is more. Share value would be overvalued if intrinsic value is less. Okay, now I want that there should be a mispricing. Mispricing is possible in case of where the number of analysts are few analysts are observing the stock, and I eventually want that this should converge to the intrinsic value to make the profits. Okay, and I should be confident about my model. Then in totality, there are going to be how many techniques? Absolute, relative. Relative means comparison. Absolute, there's going to be no comparison. 2 techniques, NAV, DCF. NAV is used when you are more interested into the assets of the business, not into the assets of the company, not the business. DCF, if you want to receive only dividend, DDM approach. If you want to compute capital appreciation part, then that is going to be with the help of free cash flow to equity. In totality, there are going to be 4 types of dividends: cash dividends, extra dividends, stock dividends, and share repurchase. Regular dividends means out of regular business. Company has to pay lot many taxes and investor has to pay taxes as well. Extra dividend out of special event, that means non-recurring. Stock dividend, stock splits, only purpose is to reduce the price. Reverse stock split, only objective is to increase the price. Share repurchase means buyback of the share. Dividend payment chronology, in totality there are going to be 4 dates. declaration date, payment date, holder of record date decided by the company. 1 day prior to that, that is going to be ex-dividend date in case of companies where countries where settlement system is T+2, and 2 days prior in case of countries where settlement system is T+3, where the meaning of ex-dividend date is share will trade without dividend. That means now the investor has to pay a price minus the previous day price minus the dividend amount. Now friends, I'm moving to my next LOS E, F and G. So now in LOS E, F, G, you have to perform a valuation. Okay, so simple. What do you mean by value of any asset? You have to forecast the cash flow, discount that, and that will be the value of any asset. Okay, so first I'm starting with LOS F. You have to calculate the intrinsic value of a non-callable, non-convertible preference stock. Okay, now what is the meaning of callable and convertible? So as of now, please ignore this. So how you have to do it? Calculate the intrinsic value of a preferred stock. Okay, now the word callable, convertible, this we eventually covered in derivatives. So now my LOS F. You have to find out the value of a preferred stock. Now in case of preferred stock, what an investor will get? He will get a constant dividend. Now for example, company is paying a dividend of 7 rupees. Now my point is, I'm going to receive this dividend till, you will keep on receiving this dividend till infinity. Now PV of infinite constant cash flows is equal to cash flow upon discount rate, or in other words, PV of preferred stock is equal to dividend that you will be getting divided by your required rate of return. Now let us assume that dividend is 7 and my required rate of return is 15%. So what is the value? Value of this preferred stock is 46.67. So this is the case where I'm going to get constant cash flows till infinity. Now you have to find out the value of the company using Gordon growth. Now suppose you invested in a equity share, where currently company has paid dividend of 2 rupees. Now currently company has paid a dividend of 2 rupees. Now what is the meaning of this? That is D0 is given. Okay, now you estimate that this dividend will keep on growing at a rate of 3% till infinity, and as per CAPM model your KE is 9%. You have to find out the value of the company. So again I repeat, there's an example. You invest in an equity share where currently company is paying a dividend of 2. The dividend will keep on growing at a rate of 3%. Your required rate of return is 9. You have to compute the value of share. Now PV of growing cash flows is equal to cash flow at the end of year 1 divided by discount rate minus growth rate, where growth rate, recall from time value money chapter, where growth rate is equal to ROE into retention ratio is equal to ROE multiplied by 1 minus dividend payout ratio. Okay, so this is the PV of growing cash flows. Now you will be getting, so now PV of equity share. Now we are using a technique of DDM. We are discounting the dividends that we are going to receive. So PV of equity share, PV means value at time 0, is equal to dividend at the end of year 1 divided by KE minus growth rate. Now we have been provided with D0. Now how to compute D1? So D1 is equal to D0 1 plus G divided by KE minus growth rate, 2 multiply by 1.03 divided by 0.09 minus 0.03. Answer is 34.33. This formula is known as Gordon growth. Now where we use a formula of Gordon growth. So formula of Gordon growth will be used in case of mature industries. Mature industry means where your earnings are stable and your profits are continuously growing at a constant rate. There is the industry. So in these industries, we are going to find out the value using Gordon growth approach. So again I repeat, class. Now one of the techniques to value the company is absolute. Within absolute there was DCF. Now DCF has two parts. One, dividend discount model, and second is free cash flow to equity. Now if you are interested in only dividends, so whatever the dividend you are going to get, you are going to discount rate. You are going to discount that. Now if dividends are constant, our formula is dividend upon discount rate, and if the dividends are growing, formula is D1 upon discount rate minus growth rate. Okay, so one formula is in case of constant cash flow, and second when there is a growth. It is also known as the Gordon growth formula. Where we use this formula, I'm going to use this formula in case of mature industries. In case of mature industries where profits are stable and continuously growing at a constant rate. Now you have to find out the value. Now there's one more example. Assuming that you're not getting any dividend for first 3 years. So first dividend that you're getting, that is at the end of year 4, that is 20 rupees. This dividend will keep on increasing at a rate 2%. So growth rate is 2. KE as per CAPM model is 17%. Now you have to find out the value at time 0. Okay, so now again I'm going to use that formula. So D4 is given. D4 upon KE minus GR. Now discount rate is, now dividend is 20. 0.17 minus 0.02. So answer is 133.33. Now in the formula, if this is dividend at the end of year 1, you will get PV at time 0. Now dividend at the end of 4th year is given. So while computing with the help of dividend at the end of 4th year, you will be getting at the end of, now you will be getting value at the end of 3rd year. Now I want to compute, so this is the value at the end of 3rd year. So at the end of 3rd year, the value of share is 133.33. Now you want to compute value at time 0. Discounting, compounding. Now I'm going to discount this value for 3 more years. So now PV at time 0 is equal to 133.33 divided by 1 plus discount rate, that is 17 raised to the power 3. So answer is 83.24. So a small change in this question. A small change is that you are not getting any dividend for first 3 years. First payment is on the end of 4th year. So whatever the value the Gordon growth formula will give, that is at the end of 3rd. Now from 3rd you have to compute value at time 0. That means discounting by 3 more years. Now one more example. Now in this example, it's a 3-stage model. Now 3-stage model. Now what is the meaning of this? So we solved one question previously where there was a constant growth rate. So constant growth rate is used for mature industries, where the meaning of mature industries is where the profits are growing at the stable rate. Now let us assume that I want to compare a company like Hindustan Unilever, okay, a company like Hindustan Unilever with Byju's. So now Hindustan Unilever is a company which is into the FMCG business, and more or less if I see the profits growth of the company, so this is in line with the GDP growth rate of the country. So whatever the growth rate of our country is, it is growing in line with that, and it is having a very stable growth. So now to value a company which is into the FMCG where the profits are stable, to value these companies, which is going to be the correct strategy? Now that is with the help of Gordon growth formula. So Gordon growth formula is used where earnings are stable and companies are into the mature industries. Earnings are stable, growth is stable. So use Gordon growth. One of the example is FMCG sector. Now a company like Byju's. Now currently Byju's is growing at a rate of 100% per annum. Now every year this company is growing at a rate of 100% per annum. Now my point is, going forward, will the growth rate will increase or growth rate will reduce? Now for example, post clearing your CFA, you get a salary of, let us assume you get a salary of 20,000 per month. So this is your first salary. You work for first year, you work for single year, and your salary was 20,000 per month. Now my point is, you plan to switch to change the job, and next employer offer you a salary of 40k per month. Possible, not possible? Possible. But what is the growth? Now the growth is 100%. Now you will keep on growing at this particular rate. Now next employer will offer 80, then 160, and so on. The answer is no. First time you get a good growth in percentage terms because your base was low. Now same is the case with Byju's. Now Byju's is a startup where the base value is really less. So in percentage terms we are getting an inflated number. But going forward, I am confident enough that yes, growth will reduce. Now this is a very simple concept of economics. The concept is that if there is an industry where there are extraordinary profits, super profits, now what will happen in the future? The supernormal profits will attract competition, and eventually in the long run companies would be earning normal profits only. Same wise, if there's any sector with their huge losses, for example telecom, those who are unable to compete, they will finally exit, and those companies which are left over will earn the normal profits. That means the concept is very simple. In the long run, everyone is going to earn the normal profits, will grow at the normal rate. Now what is that growth rate? That growth rate is equal to the growth rate of your country, the rate at which GDP is growing. That means no doubt currently Byju's is growing at the growth rate of 100%. But eventually this growth rate will reduce, then again it will reduce, and it will become stable. Now, how many models you are going to create? So, first stage model. This is a phase where the growth is high growth phase, transitional phase, and finally your earnings will become stable. Now you have to find out the value of these companies. Three-stage model. Now, point to be noted. Simply you have to create a timeline, you have to forecast the cash flow, and whatever the cash flows you are getting, you have to discount that. Now, example. Suppose currently D1 is 10 rupee and this dividend is growing at till third year or till second year. This dividend is growing at 15% per annum. Okay, then year 3 to 4 growth is 10, and from year 5 and onwards growth reduces to 3% per annum. Okay, your KE is equal to 7%. You have to find out the value of the company. So D1 is given. This dividend will grow at, so for second year the growth rate is 15. Then for year third and fourth growth rate is 10. And finally from fifth year and onwards growth rate is 3%. You have to find out the value at time 0. So now first create the timeline. Whatever the cash flow that you're getting. Now at the end of year 1, I'm getting 10 rupee. At the end of year 2, so second year dividend will grow at 15%. 10 multiplied by 1.15, that is 11.5. Dividend for year 3, growth of 10%. This is 12.65. Then year 4, 13.915, and from fifth year onwards growth rate is 3%, that is 144.33245, and this will continue till infinity. Now you have to find out value. Okay, so this is the timeline. I just verify my numbers. 15, then 10, then 10, and then 3. Yeah, so numbers are correct. Okay, now find out the value. First I want to find out the value of this particular part. So now D5 upon KE minus growth, 14.33245 divided by 0.07 minus 0.03, that is 358.31125. Now this value you will get at the end of, this is the value of the share at the end of 4th year. Now prepare revised timeline. Now my revised timeline is going to be at the end of year 1 you are getting 10, you are getting 11.5, at the end of 3 12.65, then at the end of year 4 13.915 plus 358.31125. If I add up, answer is 372.22625. Now discount rate is 7%. You have to compute PV. Now put all these cash flows in the cash flow function. Press NPV, I is going to be 7, enter down arrow, compute. Now this is going to be the PV at time 0. So now PV is equal to 10 divided by, discounting by 1 year, divide by 1.07 raised to the power 1, 115 divided by 1.07 raised to the power 2, 12.65 divided by 1.07 raised to the power 3, plus 372.22625 divided by 1.07 raised to the power 4. Now how to solve using calculator? Cash flow second clear work. My first cash flow is 0, then 10, enter down arrow, 11.5, enter down arrow, 12.65, enter down arrow, and 372.22625, enter. Press NPV, I is 7, enter down arrow, compute. Your final answer is 313.686. So now again let's revise how to find out the value of share. So whatever the cash flows that you're going to get, you have to discount it. Now there can be two kinds of model, one stage model, three stage model. One stage model is used for those companies which are into the mature industry. They will keep on growing according to the rate of GDP growth rate of the country. Third stage model is used for those companies which are into the initial phases. Now if they're into the initial phases, so the growth rate is very high, but eventually growth rate will eventually be stabilized and it will become equal to your country's GDP. That is going to be stabilized in 3 stages. First phase is high growth, second is transitional, and third is the stable phase. Now you have to find out the value, whatever the cash flows you're going to get, forecast that. Now in this case, my earnings will stabilize from 5th year onwards. It will keep on growing at a constant rate. First, find out the value of this cash flow, this particular part. Now you will get the value at the end of year 4, add up to 4, and now finally compute the NPV from year 4, compute the NPV of the cash flow 1 to 4. Final your answer is 313.686. Now one more example. Now this example is, now let us assume that you want to buy a share and your estimation is that in totality during the period you are going to receive a dividend of 10 rupee and estimated share price at the end of year 1 is equal to 150. So now you will receive a dividend of 10 plus estimated selling price at the end of year 1 is 150. Your required rate of return, that is KE, is equal to 17%. You have to find out the value. Okay, now again timeline. So I would be receiving 10 plus by selling off the share by the end of year 1 I would be getting 150. Now how much total cash flows I'm getting at the end of year 1? 160. Now you have to discount this using KE. So value is 160 upon 1.17 raised to the power 1. So answer is 136.752. So this is going to be the fair value of the share. Now let's go through the notes. LOS F, intrinsic value of non-callable, non-convertible preference stocks. In case of preference stocks, your dividend is going to be constant. Second, you have to find out the intrinsic value based upon Gordon growth, then based upon dividend discount model, and one of the dividend discount model was multi-stage. Now multi-stage means we have solved the example of 3-stage model. Now we have to discuss one more technique, that is, so this was with respect to dividend. Now DCF has one more part, that is computation of free cash flow to equity. Now this method we will use when the company is not paying dividend, okay, and our objective is not to earn only dividend. So our focus is capital appreciation. That means I want to liquidate the holding after some period of time. So in this particular case, we are going to use the free cash flow to equity approach. Now how to find out free cash flow to equity? This we have elaboratively covered under cash flow statements. Okay, so now again I'm not repeating it, and anyways they have not explained here well. So again the computation part is covered under CFS. Okay, so but how we compute free cash flow to equity? We are going to forecast the earnings. So we will start with EAT plus depreciation. This is going to be the cash profits during the period. Now you have to make adjustment for, so I prepare a simple balance sheet: equity, debt, working capital and fixed asset. Now you're going to make adjustment for, capex, working capital and debt. Now whatever the answer, that answer is, these are the free cash flow to, equity. Now it signifies the dividend paying capacity of the company. So how much dividend paying capacity company has. So dividend discount model, how much dividend we are actually receiving, whereas free cash flow to equity signify dividend paying capacity of the firm, and using this format we compute it. Now important, this method we use when we are more interested into the capital appreciation part. It signifies the dividend paying capacity of the company. Okay, so now class, I strongly recommend that, though on this we don't have any numerical in this chapter, so but to have a better understanding, please recall or please refer your notes with respect to cash flow statement. There we have elaboratively discussed both free cash flow to firm and free cash flow to equity. Now meaning of free cash flow to equity: cash flow which belongs to equity holder only, and here we make an adjustment for capex, working capital, debt. No adjustment is required for dividend. So this is the cash flow which has been taken out by the equity. So start with EAT plus depreciation. These are the cash profits. Adjustment for capex, working capital, debt. Whatever is left, that belongs to the equity holder. Okay, so with this we have covered LOS E, LOS F, G and H. Okay, now I'm moving to relative technique. Now in relative technique you are going to compute multiples. Now what are the multiples? One multiple is price to earning, price to sales, price to book, and one more multiple that we extensively use, that is EV upon EBITDA or EBIT. Now let's start with one multiple, relative. Here we are going to compute the value of target company using comparable ones. Now let us assume that I want to find out fair value of Nestle using PE multiple of a company like HUL. Now let us assume that HUL has a PE multiple of 17x or 70x. Now what is the meaning of P multiple equal to 70? Now carefully. Now this multiple signifies that for 1 rupee of earning, currently investor is paying a price of 70 rupees. Now let's understand. So if I go to money control or type here Hindustan Unilever. Now currently the price of this company, the price of the share is, the price is 2210.85. So this is the price that investor is paying currently, divided by, now I want to find out what is the earnings. So now let us assume that if I type here Hindustan Unilever, now my focus is 31st March 20. Okay, so now in 31st March 20, company in totality earned a profit of, so these figures are in million, 67,480 million, or in other words 6748 crore. So this was the annual profit of Hindustan Unilever Limited. And now if I compute earning per share, that means divided by number of outstanding share. Now earning per share is 31 rupee 0.17. So how we compute this? 6748 crore divided by number of outstanding shares, means how many shares company is having. So if I divide by this, answer is 31.17. That means now I want to compute a multiple, PE multiple. For 1 rupee of earning, what is the price we are paying? So if I compute the multiple, this multiple is equal to, approximately equal to 70.92. Now my point is, the meaning is, for 1 rupee of earning, we are ready to pay a price of 70.92. Now assuming that this is the correct valuation, Nestle has a total profit of, or Nestle has a earning per share of 20x, earning per share of 20 rupees. Now my point is, what is the fair value of Nestle? PE is 70.92. You want to compute price where the earning of Nestle is 20. So the correct market price of Nestle is, using relative valuation, the price is 1418.57. Now this is known as relative valuation. Relative valuation means finding the value of target company using comparable ones. And in this case, we have computed the answer 1418.57. Same wise, let us assume that there are two companies. One, now if I go to the multiples, now these three companies are known for corporate governance. So they have a very strong management, good stable earnings, and good management, good corporate governance. Company name is Nestle, HUL, and Tata Consumers. Okay, now you have to find out which stock is under, which stock is overvalued based upon PE multiple. Now these three companies are listed over stock exchange. Now Hindustan Unilever Limited has a PE multiple of, so closing PE multiple, so has a PE multiple of 69.47x. So Hindustan Unilever, then Nestle, Nestle has a PE multiple of 77.93x, and Tata Consumer Tata Consumer has a P multiple of 77.12x. Now which company is under and which company is overvalued? Okay, now first compute the average multiple of industry. So average multiple of industry is 77.93 plus 69.47 plus 77.12 divided by 3, 74.84x. That means eventually this company will trade at this particular multiple. This is our assumption. Now which company is over and which company is undervalued? Now one day HUL should trade at 74.84x. Nestle should trade at 74.84x and Tata Consumer should trade at 74.84x. So this is the average multiple of the industry. That means one day, in simple words, one day a share of 69 will become 74. A share of 69 will become 74. So which one shall I buy, HUL or sell? Now one day 70 rupees share, 69 rupees share will become 74. That means our recommendation is buy, and that means that Hindustan Unilever is undervalued. Now which stock? The stock which is trading at lowest multiple, at the lower multiple, that means it is an undervalued stock. Same wise, the ones trading at a multiple higher than the average, though for those share our recommendation is sell and sell, and these are overvalued stock. These are overvalued stock. Now one day Nestle will become, Nestle, a share which is currently trading at 77 will become equal to 74. 77 will become equal to 74. So our recommendation is buy Unilever because it is trading at the lowest multiple, and sell Nestle and Tata Consumers because they are trading at a higher multiple. So buy the companies which are trading at lower multiple. So in this way we find out, first in this way we find out the value of target using comparable, and within comparable companies we identify which one is overvalued and which one is undervalued. The one trading at a lower multiple, our recommendation is buy, they are under. One trading at a high multiple, our recommendation is sell, they are overvalued stocks. Now friends, one more example on multiples. Let us assume there are two banks, HDFC trading at a PE multiple of 31x. That means for 1 rupee earning, for 1 rupee of earning, currently investor is paying a price of 31 rupee. And second one is Kotak trading at a multiple of 34x. So simply for HDFC, currently you are paying a price of 31. Kotak, you are paying a price of 34. Now my point is, which stock is under and overvalued relatively? Now this stock is trading at a lower price. Lower price means undervalued. Hence our recommendation is buy. Kotak is trading at a high multiple. That means it is an overvalued stock relative to HDFC. And hence recommendation is sell. So friends, in this way we compute the valuation of the target company using comparable ones and find out within comparables which company is over and undervalued. So now how many multiples we are having? Price to book, price to earning, price to book, price to earning, price to sale, and one more, that is EV upon EBITDA or EBIT. Okay, so now again I want to emphasize on P multiple. Now the multiple that we just computed, that is P current price upon current earning. This multiple is known as trailing PE multiple. Okay, trailing PE multiple. Trailing PE multiple means based upon historical earnings. Now, what is the price of any share? Now, price of any share is P0 is D1 divided by KE minus G. Now, I want to divide both sides by E1. Divide by E1, divide by E1. Now, this is for 1 rupee E1. What is the meaning of E1? For 1 rupee of future earning, what is the price we are ready to pay? Now, that means it is based upon future earnings, next year earning. Now, this P multiple is known as justified or leading PE multiple. So how it is different from trailing? In case of trailing, it was past year earnings. In case of justified or leading PE multiple, this is forecasted earning of next year. This is equal to now D1 upon E1. D1 upon E1 is known as dividend payout ratio upon KE minus G. Now my point is, one stock is trading at a higher multiple. Now one stock is trading at a higher multiple. What could be the reasons? The reason is maybe the stock is having higher dividend payout ratio, lower KE or higher growth rate, because of which it is trading at a higher multiple. Now a stock is trading at a higher multiple. What could be the reason? The reason is higher dividend payout ratio or required KE or greater growth prospects, because of which it is trading at a higher multiple. Now I want to emphasize a multiple which we compute very extensively, that is EV upon EBITDA or EBIT. Now what is the meaning of EV? EV means market value. This means market value of the company, market value of company's business, market value of company's business. Is it equal to? It is equal to market value of equity, market value of debt minus cash and short-term investments. So minus cash including short-term investments. Now my point is, if I prepare a simple balance sheet, so in the balance sheet we have equity, debt, okay, and equity debt is invested into, this is the sources of fund, and the money is invested into fixed asset, net working capital, and some money is in the pocket. Okay, so suppose you have introduced 100 crore. Out of 100, something is invested in fixed asset, some amount is invested in working capital, and some is kept in as cash. Now my point is, I want to find out the market value of your business. That means market value of your operating assets. Now market value of your business is equal to, now you are having fixed asset, working capital, with the help of which you create the sales, you earn profit. Now what is the market value of your business? Now market value of business is market value of equity, market value of debt minus cash. So what do you mean by EV? EV means market value of company's business. It is equal to market value of equity, market value of debt minus cash and short-term investments. This is the value of your operating assets. Now with the help of these assets, what you have earned? Profits which belongs to both debt and equity. Now the profits which belongs to both debt and equity are, that is EBITDA if you want to compute cash profits, or EBIT. Now these are the profits which belongs to both debt and equity. Now I'm going to compute a multiple, that is EV by EBITDA, and let us assume the multiple value is 20x. Now what is the interpretation? For 1 rupee of EBITDA, for 1 rupee of profit, market is ready to pay a price of 20x. Now this 20 belongs to both equity and debt. So what do you mean by EV? EV is equal to market value of equity, market value of debt. This is the total money, but one portion is lying idle. Subtract that. That means this is the market value of your business assets. Now with the help of these business assets, you have earned EBITDA. Now compute EV by EBITDA. For 1 rupee of earning, for 1 rupee of EBITDA, market is ready to pay a price of 20x. Now what is the biggest problem with EV by EBITDA multiple or EV by EBIT multiple? The biggest problem is, since we will learn eventually in fixed income, since debt market is illiquid in nature and we are dependent upon dealers for the prices, and we are dependent upon dealers for prices, computing market value of debt is difficult. So how we do practically? We practically compute book value, but again computing book value is incorrect. Using book value is incorrect. So now this we will learn eventually in fixed income that since debt market is illiquid and we are dependent upon dealers for prices, computing market value is difficult. So this is one of the disadvantages of EV by EBITDA multiple. Now again let's go to capital IQ. Now Hindustan Unilever Limited. Now Hindustan Unilever is trading at a EV by EBITDA multiple of EV by EBITDA. This is total EV, last 12 month EBITDA. So now it is trading at a EV by EBITDA multiple of 47x. Now how they have computed EV? Now EV is equal to market cap of equity, that means market value of equity, then plus debt minus cash. So this value is coming out to be negative because cash is more than borrowings. So eventually a company like Hindustan is a debt free. Okay, so answer is coming out to be negative. And then they have added a word minority. So in business, means in practical life, there are three investors. We have learned in FRA as well. That is equity, debt and minority. Now these profits, whatever the profits have been earned, that belongs to three persons. That is equity, debt and minority. Now we computed EV by EBITDA, where EV is equal to market value of equity, market value of debt plus market value of minority minus cash and short-term investments. So currently Hindustan Unilever is trading at a EV by EBITDA multiple of 47x. Same wise, there's a company for ITC. Now ITC is also a debt free. Now ITC is trading at a EV by EBITDA multiple of EV by EBITDA multiple of 40. So which company is under and which company is overvalued? HUL is overvalued and ITC is undervalued. Our recommendation is buy ITC and sell Unilever Limited. So class, a quick revision. Now we want to compute the value using multiples. How many multiples? Price to book, price to earning, price to sales, and EV by EBITDA or EV by EBIT multiple. Now what is the biggest problem with multiples? Number one biggest problem is to find the comparable companies. Now it is very difficult to find a comparable of Reliance. Now Reliance is a company which is into petrochemicals, which is into telecom, refinery business, retail business. Now it is a conglomerate. Now finding a comparable to Reliance, it is a difficult task. Same wise, finding a comparable to ITC, company in the tobacco business, FMCG business, paper business, hotel business. Now finding out exact comparable for these company is a difficult task. First problem. Second problem is, while computing multiples, it's very difficult to compute market value of debt. Third problem is, suppose if a company is having a negative earnings, for example a company like PVR, so now their business has been hampered. Now if I go to PVR, so they have booked significant losses. Okay, now for PVR, if I want to compute PE multiple, so earnings is negative. Now if earnings is negative, that means PE multiple is going to be negative. Now negative multiple means negative multiple is nothing but meaningless. We cannot conclude anything out of negative multiple. So now if I compute for PVR, now it is written P by E. So now we are unable to compute multiple because company, why? Because company is incurring the losses, and negative multiple is nothing but meaningless. Okay, so these are the biggest problem with multiple method. Now I'm moving to my last technique, that is NAV. We use NAV technique when more interested into the asset of the company, not business. Extensively used to value small and privately held companies. So where the scale of operation is not much, when sales are not much, so it is extensively used to value small and privately held companies where the value of equity is market value of assets minus market value of liability divided by, so this is the total value of equity. Now equity value per share is equal to, this is known as NAV, net asset value. Now this is going to be NAV divided by number of outstanding shares. Now for example, this is a company like Jet Airways. So in their balance sheet they have aircrafts. Okay, they have some liability of 20 crore. Okay, and finally the market value of aircraft is 70 crore. 20 crore you have to pay to the debt holders. So what is the value of equity? Value of equity is 50 crore. NAV is equal to 50 crore. This method we use when we are more interested into the assets of the company. Now what is the problem with the NAV method? NAV method can only be used when you are having significant tangible assets. Okay, now if you are having intangible, for example it is the service sector. So now in case of service sector you don't have any tangible fixed assets, so valuing that using NAV is not possible. Now for example, you want to purchase TWSS using NAV technique, so we don't have significant assets. So our company is basically a service industry. So in service industry, performing valuation using NAV is not possible. Second one, this we learn in economics, that during the period of hyperinflation, now meaning of hyperinflation is in a country where over the last 3 years cumulative inflation is greater than 100%. Now during hyperinflation we cannot use NAV method. Now why? This we elaboratively learn in the economics chapter. So 2 problems. Number 1, if you are having intangible assets, significant intangible, we cannot use NAV. During hyperinflation we cannot use NAV. But the best part with NAV is provide floor values. Floor values means it provides the minimum value for the business. What are the problems with the multiple method? Number 1, negative multiple, meaningless. Second, finding out the true comparable is again a difficult task. Now with one multiple the company may turn out to be undervalued, with other multiple overvalued. Now for example, HUL PE multiple is 70x, Tata Consumer PE multiple is 68x or 72x. So now HUL is under, Tata is overvalued. Okay, now price to sell, let us assume this is 10x and this is 10x and this is 9x. Now HUL is over and Tata is undervalued. So maybe it seems undervalued by one multiple and over multiple by another multiple. Finding out the comparable companies is a difficult task, and once the earning is negative it becomes meaningless. Now what are the problems with DCF? In DCF you have to forecast earnings. This is the biggest disadvantage. This is nothing but your estimation, and estimation may or may not be true. Second problem is it is very much sensitive to inputs. Now for example, how you find it out the value? Value is equal to D1 divided by KE minus G. Now if I increase or decrease growth by 1%, my value will change significantly. That means it is very much sensitive. It is very much sensitive to inputs. Okay, now friends, with this we have covered this chapter. Now first I'm going to quickly revise all the concepts, and then we are jumping to a practice problem. In totality there are 63 practice problems. So you have to try your level best to solve those questions. While solving this question, a point to be remember, you have to forecast what is the value of any asset, that is the future cash flows discounted using the investor's required rate of return. Okay, so now first let's revise all the concepts, and then in the last part I'm going to solve all the 63 practice problem. Okay, now my first LOS. When a share would be overvalued, fairly valued and undervalued. So now first you have to compute intrinsic value. If intrinsic value is greater than the current market price, then the share is undervalued, you are going to buy. If intrinsic value is less, then our recommendation is sell, and the stock is overvalued. In totality there are going to be how many methods to value the equity? Absolute, relative. Relative means based upon multiples. Absolute will have 2 parts. NAV when you are more interested into the assets of the company. Then DCF. DCF will have 2 parts. One, dividend discount when you are only interested in the dividend component. And finally, it's free cash flow to equity. You are going to forecast the cash flow and discount that using the KE component. Then regular dividends from regular profits that company will keep on paying. Extra dividend, non-recurring, special event. Stock dividend, stock splits. The only purpose is to reduce the prices. No impact on the net worth of the individual. Reverse stock splits. Only purpose is to increase the prices. Share repurchase means buyback. Dividend payment chronology. In totality there are going to be 4 dates. Number one, declaration date, payment date, holder of record date, and 1 day prior to holder of record date there's going to be ex-dividend date. Ex-dividend date is the date when share will trade without dividend. Holder of record date means whosoever is the holder of the company on this particular date will receive the dividend. Payment date is the date on which payment is going to be received in your accounts, and declaration then the date at which it is declared by the company. Now there are models to compute the value of constant cash flow. cash flow upon discount rate. To find out the value of growing cash flows, cash flow at the end of year 1 divided by discount rate minus growth rate, where growth rate is equal to ROE multiplied by retention ratio, where retention ratio is equal to 1 minus dividend payout ratio, where dividend payout ratio is equal to total dividend divided by total earnings. Point to be noted, preference stock dividend is constant in nature, while the dividends of equity, they are growing in nature. Then there can be one stage model, two stage model, three stage model. One stage model is used for those companies which are having a stable earnings, for example a FMCG. Three stage model is more relevant for those companies which are experiencing a higher growth. Eventually the growth will stabilize and it will become equal to the GDP growth rate of your country. Then relative, there are multiples like PE, PS, PB or EV by EBITDA. The companies which are trading at the lower multiple, that means you have to pay lower price, these are undervalued stock. The companies which are trading at a higher multiple, that means these are expensive stocks, we have to sell them. Then there are two kinds of PE multiple, one is known as leading, one is known as trailing. Trailing is computed on the basis of historical earnings. Leading is computed on the basis of forecasted earning. It is equal to dividend payout ratio upon KE minus G. Then EV by EBITDA or EV by EBIT. Now what is the meaning of EV? The market value of company's business. It is equal to market value of equity, market value of debt minus cash and short-term investment. What is the biggest problem? The biggest problem is that it is very difficult to find out the market value. Okay, then what is the problem with the relative? The problem with the relative is to find out the comparable companies. If multiples are negative, it becomes meaningless, and then it could be possible that one multiple companies seem to be undervalued, with other multiple it is coming out to be overvalued. Then NAV, it is used when you're more interested into the assets, not the business. It is used only in case of those companies with huge tangible assets. Disadvantage, we cannot use in case of companies having intangibles. Second, it cannot be used during the period of hyperinflation. What is the problem with DCF? It is based upon forecast, may or may not be true. Second, a small change, very sensitive to inputs. A small change in growth, KE, value will change substantially. So it is very much sensitive to inputs. So class, with this, we have covered all the elements. Okay, now I don't recommend that you have to go through the Schweizer. Okay, a thorough revision of your class notes would be more than sufficient. Okay, try your level best to solve all the 63 problems, and in the next part I'm going to solve them. Okay, thank you. Now friends, I'm moving to practice problem. Practice problem 1. An analyst estimate the intrinsic value to be in the range 17.85 to 21.45. Current market value is 24.34. That means in question number 1, now current price is more. If current price is more than intrinsic value, we are not going to buy, we are going to sell. That means share is overvalued. Answer is A. 2. The intrinsic value of a equity security is equal to 55. Intrinsic is 55. Current price is 47. So today we are going to buy. Buy means share is undervalued. Question number 3. In asset-based valuation, the intrinsic value of common stock is equal to market value of company's asset minus liability. Answer is C. 4th, which of the following is most likely used in PV model? PV model means discounted cash flows. A, B, C. Answer is free cash flow to equity, C. Now book value is least likely to be considered. So in multiple, yes, this is a ratio price to book. Asset based is based upon the book value. So we are not going to consider book value. That is the PV model. Under PV, you have to focus the future profitability. So we do not consider book value. Question number 6. An analyst is attempting to calculate the intrinsic value. and has gathered the following data: EBITDA, total market value of cash, short-term investments, liability, preferred stock. Now, which method he's going to use? Least likely is going to use. Now, that is going to be a discounted cash flow. Why discounted cash flow? So clearly, it is evident that he may be using relative valuation, and could be possible that he's using asset base as well. Now, no data is given with respect to discount rate or with respect to cash flows. So least likely that he's going to use discounted cash flow. So in this question number 6, we don't have anything with respect to discount rates. We have not given with the cash flow that company is going to generate or the cash flow that investor will get. So high probability is that he's least likely to use discounted cash flow. Now, an analyst who bases the calculation of intrinsic value on dividend paying capacity rather than the expected dividend. So dividend paying capacity is computed with the help of free cash flow to equity model. Now, 8th, investor expects to purchase a stock and will sell after 2 years. He is expected to receive next two dividends D1, D2 and will sell at P2. Now you have to compute the price using dividend discount model. So price is going to be whatever you're going to get in the future, you have to discount that. That means today the value is PV of expected future dividends and price, that is D1, D2 and P2. Answer is C. 9th, in free cash flow to equity model, the intrinsic value of a stock is calculated as, okay, so if you want to compute the intrinsic value of stock, question number 9, EAT plus depreciation, adjustment for capex, adjustment for working capital and adjustment for debt. Now it is calculated as, so intrinsic value of stock, it is calculated as PV of, so this is known as free cash flow to equity. You just have to discount the cash flow using KE. So the value, the intrinsic value of a stock is calculated as PV of future expected free cash flow to equity. Answer is A. 10th, with respect to PV models, which of the following statement is most accurate? Present value model can only be used if stock pays a dividend. Incorrect. You can compute this dividend discount model and we can compute using free cash flow to equity as well. So A is incorrect. PV model can be used only if stock pays a dividend or expected to pay a dividend. Again incorrect. For non-dividend paying stocks, we can compute the answer using free cash flow to equity. Third, PV model can be used for stocks that currently pays a dividend, expected to pay a dividend or are not expected to pay a dividend. Anyways, using free cash flow to equity, we are taking into consideration the capital appreciation part. So correct answer is C. Now DCF is known as PV model. Now DCF has two parts, dividend discount model and free cash flow to equity. This is used for those companies who will pay dividend, the companies who are currently paying dividend and who eventually will pay dividend. But if it is not paying dividend and we want to find out value, then using free cash flow to equity approach. So answer is C. Now question number 11th. So company has issued a preferred stock. Your required rate of return is 4.49%. You have to find out intrinsic value. Now you will be getting dividend. How much dividend company is paying? 4.8% of 25. So question number 11. So PV is equal to dividend that you are going to get, that is 0.0480 multiplied by 25 and your required rate of return is 0.0449. So if I solve, my answer is answer is 26.72. So question number 11. Then question number 11 answer is B. Question number 12. two analysts estimating the value of a preferred stock with a constant dividend, arriving at different estimated values. So now two analysts have estimated the different values in case of dividend where they are going to receive the fixed amount of dividends. The most likely reason for the differences. So how to compute the value of preferred stocks? That is dividend divided by discount rate. Now this dividend is constant. So this is, we know at time 0 that what dividend we are going to get in the future. So this is same in both the case. Why their answer is coming different? That is because of difference in required rate of return. So answer is B. Then 13th, company just paid a dividend of 1.75. So just paid a dividend of, that means D0. If the required rate of return is 12.3% per year, dividend are expected to grow infinity till infinity at 9.2%. You have to find out value. So now I'm going to solve using Gordon growth. Question number 13. PV is equal to D1 upon discount rate minus growth rate is equal to D0 1 plus G upon discount rate minus growth rate. Now D0 1.75, growth is 1.92 divided by 0.123 minus 0.092. So if I solve, my answer is 1.75 multiplied by 1.092 divided by 0.123 minus 0.092. Answer is 61.645. Answer is C. 14th, company is considering the purchase of a common stock with current 2 rupees as annual dividend. Dividend is expected to grow at 4% annually. Required rate of return is 7. You have to find out intrinsic value. So question number 14. So class, there is a misprinting with a current annual dividend of 2 rupees. Okay. So now PV0 is equal to D1 upon KE minus G. This is 2 multiplied by 1.04 divided by 0.07 minus 0.04. So if I solve, answer is 69.33. Answer is C. Question number 15. You have to compute the value using dividend discount model, where the growth for first 4 year is 9%, then post fifth year and onwards growth is 4, required rate of return is 12, and current dividend, that is D0, is 1.60. So question number 15. First you have to prepare a timeline 1, 2, 3, 4, 5 till infinity. Now your D0. So D0 is 1.60. Now growth is 9%, 9%, and eventually we reduce to 4%. So now 1.6 multiplied by 1.09. So by the end of year 1 it is 1.44, 1.9, 2.072, 2.25, 85, 2.34, 887. Now first compute the value of this particular part. Now D5 divided by KE minus G, that is 2.34887 divided by 0.12 minus 0.04. So if I divide by 0.08, you will get a value 29.36. Not D5. If it is D5, you will get a value at the end of year. At the end of year 4. Now you have to prepare revised timeline. Now my revised timeline is, so first you have computed the value of this part. Now value of this part is equal to, at the end of year 4, is equal to 29.36. Now I want to compute the value of this relevant part. Now add here 29.36. So you have to find out the value of these cash flows. Now your required rate of return is 12%. Cash flow second clear work 0, enter down arrow. 1.744, enter down arrow. 1.9, enter down arrow. 2.072, enter down arrow, and then 2.2585 plus 29.36 equal to, enter, press NPV, I is 12, enter down arrow, compute. So now if you solve this, you will get an answer as intrinsic value is equal to 24.64. Currently the stock is trading at 22.56. Intrinsic value is more. If intrinsic value is more, we are going to buy. That means stock is undervalued. So 15, answer is A. 16, analyst is attempting to value the share of a company. Company just paid a dividend of 0.58, expected to grow by 20% next year and 15% after that. From 13 onwards, dividends are expected to grow at 5.6% per year infinity. Your required rate of return is 8.3. You have to compute intrinsic value. Question number 16. Now again you have to prepare a timeline 0, 1, 2, 3. So here the growth rate is 20, 15, and finally it will reduce to 5.6%. Now dividend at D0 dividend is 0.58. So now what is going to be the dividend for next year? That is 0.696. Then 15% growth, that is 0.8004, and then a growth of 5.6%, that is 0.845222224. And now the growth is going to be constant. First find out the value of this particular part. So now D3 divided by KE minus G, that is 0.845224 divided by your required rate of return is 0.083 minus 0.056. So if I solve, so answer is 31.30. So this value you will get at the end of, this is the value at the end of year 2. Now my revised timeline. You have to find out the value of this, and revised timeline is 31.30. Now you have to discount these cash flows. Your required rate of return is 8.3%. So cash flow second clear work 0, enter down arrow. 0.696, enter down arrow, then 0.8004 plus 31.3 equal to, enter, press NPV. I is 8.3, enter, down arrow, compute. So your calculator will display intrinsic value equal to 28.01. So answer is C. 16, answer is C. 17, company just paid a dividend of 450. Annual dividends are expected to grow at 4% over the next 4 years, and at the end of 4 years, share will be sold at 9,000. Required rate of return is 12%. You have to find out the intrinsic value. Question number 17. Now 4 years. 1, 2, 3, 4. Company just paid a dividend of 450. This dividend will keep on increasing at 4% for next 4 years. 468, 486.72, 506.188, 526.47, and eventually you will sell the share for 9,000 at the end of 4th year. So these are your cash flows. Your required rate of return is 12%. You have to compute NPV. Now you have to ignore this, okay? So this anyways you are not receiving. Cash flow, second clear work, 0, enter, down arrow. 468, enter, down arrow, 486.72, enter, down arrow. 506.188, enter, down arrow. 526.47 plus 9,000 equal to, enter, NPV, I is 12, enter, down arrow, compute. Your calculator will display 7220. So my answer is B. 17, answer is B. 18, garden growth can be used for those companies which are in mature phase. Answer is B. Earnings are stable and we anticipate that growth is stable, companies mature, and we anticipate that we will keep on receiving this dividend till infinity. So answer is B. The best model to use for young companies, company like Byju's, that is going to be a 3-stage model. Question number 20. Now, an analyst has been asked to estimate the intrinsic value of the stock. Now, it is in the mature industry. Earnings are expected to grow at 3% till infinity. Mature industry, then we are going to use garden growth. Answer is A. Then 21. A price earning ratio that is derived from garden growth is inversely related to. So they are talking about 21. They are talking about the leading multiple. Now P upon E1 is equal to DPR, dividend payout ratio, upon KE minus G. So higher the dividend payout ratio, higher is going to be the multiple. Higher the growth, lower would be the denominator, higher would be the value. But higher the KE, higher the risk, higher the required rate of return will turn into higher the denominator, lower going to be PE multiple. So which one is inversely related? So inversely related is KE, that is required rate of return. 21, answer is C. 22. Now primary difference between P multiple based upon comparables and P multiple based upon fundamentals. Fundamental means future earnings. So now 22. This is PE. Now this is P of comparable companies, where P 0, E 0. So this is based upon historical earnings. Now P 0, E 1. This is known as fundamental. This is based upon future earnings. So what is the primary difference between the P multiple based upon comparables and P multiple based upon fundamentals. Fundamental means keeping in mind the future growth. That is, they take into consideration future expectation, future earnings. Answer is A. 23rd. Now, use of PE and other multiple for analysis is not effective because multiples are based upon historical data and not all companies have positive earnings. Now, analyst is most likely incorrect with respect to both the statements. Now, why? So first, they are not multiples only based upon historical data. There are multiples that are based upon future earnings as well. Now, one of the example is justified or leading multiple, where it is based upon future expectation, it is based upon future earnings. So once this statement is incorrect, then because then we cannot use multiples, so it is not commenting upon only P, it is commenting upon other multiples as well, because not all companies will have positive accounting earnings. Now, for a ratio like price to sale, we don't need earnings. Okay, now I understand that my earnings can be negative, but my sales cannot be negative. Okay, so I understand that you cannot compute PE multiple in case of those companies which are loss making. But if you cannot compute PE, then definitely you can compute other multiples such as price to book, price to sales. There are other multiples as well, or EV by EBITDA. So he's saying that we cannot use other multiples if EAT is negative. We definitely use other multiples such as price to book, price to sales, and EV by EBITDA. So it is incorrect with respect to both the statements. Then 24. Now you have to compute average first. Okay, so now an analyst has prepared a table of average trailing 12-month price to earning, price to cash, price to sales ratios. Okay, so this is for year 2014, 15, 16, 17. Now first you have to compute average. Now what is your average PE, price to cash flow, and price to sales ratio? Average. So now average is 4.9 plus 6.1 plus 8.3 plus 9.2 divided by 4. So this is 7.125. Then average price to cash flow, that is 7.3. Price to sales, average multiple is 1.725. Now in 2018, companies trading at a, this is average of 14 to 17, and now 2018 companies trading at a multiple of 9.2, 8 and 2.5. so companies trading at a higher multiple, with respect to historical averages. So now based upon the information provided, higher multiple. Now if you're trading at a higher multiple, that means people are paying higher price for your stock. That means your stock is overvalued. Answer is A. So now based upon the information provided, analysts conclude that the share is trading at a higher price and hence it is overvalued. Answer is A. 25th. You have to compute PE multiple for the company. Now, okay, so now in this we have to compute leading multiple. Question number 25. So PE multiple is equal to DPR upon KE minus G. Now expected dividend per share 2.7, earnings 5.7. So what is your DPR? 2.7 upon 5.7. Now required rate of return is 0.0835 minus dividends are expected to grow at 0.0275. So if you solve, it is 8.4586. So answer is B. Now, which of the following statement is most correct? Now you have to compute trailing and leading multiple. Question number 26. Now P0 upon E0, this is your leading multiple for alpha and for delta. So current price is 57.32 divided by current last year earnings, that is 3.82. 18.93 divided by 1.35. Then P0 upon E1, 57.32 upon 4.75, 18.93 upon 1.40. Now you have to compute multiples. This is 15x, (14x), 12.06x, 13x, 13.5x. Now based upon trailing PE multiple, this is a undervalued stock, overvalued stock, and based upon fundamental PE multiple, this is undervalued, this is overvalued, this is overvalued. Okay, now let's answer ABC. Now delta has a multiple lower. Delta has the, so A is incorrect. Alpha has the higher trading multiple, so B is correct, C can be correct. Okay, but alpha is having lower multiple, lower leading multiple, so higher, so A is having higher trailing P multiple and lower leading multiple alpha is having. So answer is B. So 26, correct answer is B. 27, which of the following company is undervalued? The one which is trading at a lower multiple. Now price to book, which bank is having the lower multiple? That is these two, because they are having the lower multiple. And now which bank is having the lower PE multiple? PE, or within these two banks. Now the one which is having the lower PE multiple, that is Pioneer. So answer is, which is the undervalued stock? Now the undervalued stock is the one, that is the Pioneer Trust. Question number 28. The market value of equity can be calculated as enterprise value. Okay, now question number 28. So enterprise value is equal to market value of equity, market value of debt minus cash. Okay, now you want to compute market value of equity. Market value of equity is equal to EV plus cash minus debt. Now EV minus debt minus debt and preferred stock plus short-term cash plus cash and short-term investment. So correct answer is C. Now again I repeat, the market value of equity is EV minus debt plus cash minus market value of debt plus cash and short-term investment. So answer is C. 29. Which of the following regarding the calculation of EV is most likely correct? So there are two kinds of multiple, EV by EBITDA, EV by EBIT. So operating income, that means EBIT may be used in case of EBITDA. Now you may think that answer option C is correct. We do use book value, but that way is incorrect. Okay, so now answer C is incorrect. Which is the correct answer? That is B. Now two kinds of multiple exist, EV by EBITDA and EV by EBIT. Now we do use book value of debt in case of market because market value is not available, but that is the incorrect way. So that's why we are not selecting C. The correct answer is A. Now you have to find out question number 30. The appropriate EV by EBITDA multiple is 10.2. Now you have collected the following data. You have to compute value of equity for Rainbow. Okay, now EBITDA is given. The EBITDA is 22 million. Now question number 30. So EV by EBITDA multiple is 10.2. That means EV of the company is having a EBITDA of 22 million. So that means that EV is equal to EV is equal to 224.4 million. Now you want to compute equity value. EV is equal to equity plus debt minus cash. 224.4 equity plus debt. Now debt value is 56 million and cash is 1.5 million. So 56 minus 1.5. So equity is equal to 224.4 minus 54.5 equal to 169.9. So answer is A. 31 plus in case of EV plus the market value of debt. Answer is B. 32. So it is more suitable for the companies, asset based are more suited for the companies where the capital structure does not have a higher proportion of intangible assets. 33. Which of the is most likely a reason for using asset base? So we commonly valued privately held companies with the help of asset based valuation. 34. A disadvantage of EV is it is difficult to obtain market value of debt. 35th. Which of the following is preferable when one is comparing similar companies? So for similar companies, relative valuation is more important, that is the multiple model. 36. Which of the following is considered as the weakness of PV models? Now it cannot be used, incorrect. Small changes in the model assumption can result in large changes. Yes, it is very much sensitive to input. So this is one of the weakness. 36, answer is B. Now 37. Using DCF, using a dividend discount model, you have to compute value per share. Okay. So now first you have to compute KE. Question number 37. KE is equal to RF plus beta RM minus RF. RF is equal to 4.2%. Beta is equal to 1.5 Now it is directly given equity risk premium. So equity risk premium means RM minus RF. So this figure is already given. That value is 5.6%. So if I solve, my KE is KE is 12.6%. Now value earning is 2, dividend payout is 60%. That means D0 is equal to 2 multiplied by 0.6, that is 1.2. Now this dividend will keep on growing at a rate 5.10, and your required rate is 12.6. So now value is equal to D1 minus KE minus upon KE minus G, that is 1.2 multiplied by, what is the growth? Growth is 1.0510 divided by KE. KE is 0.126 minus 0.0510. Now if I solve, answer is 16.816. Answer is B. 38. Which of the following is an advantage of EV by EBITDA multiple? Now A is incorrect, that is an disadvantage. It does not require, this is again a disadvantage. Now it is a proxy for operating cash flows. Now what do you mean by operating cash flows? Now EBITDA is nothing but equivalent to cash profits. So yes, this is one of the advantage with EBITDA by EV by EBITDA multiple, that EBITDA is nothing but a substitute for operating cash flows. We can use this word. Why? Because here we have not deducted any sort of non-cash expenses such as depreciation and amortization. So answer is C. You require market value of debt, that is a disadvantage. Multiple must be positive, that is a disadvantage. So what is an advantage? That EBITDA is a proxy for operating cash flows. Question number 39. An asset with a current market price of 15, intrinsic value 12. So if intrinsic value is 12, we are not going to buy it. It is an overvalued stock. Answer is C. 40. Equity valuation model that has been based on a ratio. These are known as multiple models. Question number 41. 4% required rate of return. Intrinsic value of a 5% perpetual dividend paying with a par value of 100. So question number 41. Now PV is equal to, you will continuously receive a dividend of 5 rupee. Your required rate of return is 4%. So this 5 rupees till infinity. So value is 5 divided by 0.04. So answer is 125. Question number 41. Answer is C. 42. You have to compute using dividend discount model the value of stock. Current dividend means D0. So first you have to find out the growth. 42. Now G is equal to ROE into 1 minus dividend payout ratio. ROE is equal to 0.175 multiplied by 1 minus dividend. This is 3 upon 5. So if you solve 3 divided by 5, this is 0.4 multiplied by 0.175. So growth is equal to 0.07. Now my value is going to be, value or price is equal to D1 D1 is going to be 3 multiplied by 1.07 divided by KE, that is 0.175, that is 0.15 minus 0.07. So if you solve, answer is 40.125. So question number 42, answer is A. Question number 43, which of the following concerning different valuation approach is most accurate? One advantage of three-stage DDM is that it is equally appropriate to young companies and those to young companies entering the growth phase and those companies entering the maturity phase. Answer is incorrect. For growth phase, this is going to be 3 stage. For mature phase, the correct model is 1 stage. A is incorrect. B, it is advantageous to use asset-based valuation rather than forward-looking cash flow for those companies who are having significant intangibles. Again, incorrect. We cannot use NAV method for companies having significant intangibles. So B is incorrect. Now C, the justified forward PE ratio offers the advantages of incorporating fundamentals. Now what is the meaning of this? 43. Now P0 upon E1. So this is known as justified PE multiple. Now the best part with this multiple is that it takes into consideration, it incorporates fundamental. That means it takes into consideration the future profitability. So correct answer is 43. Correct answer is C. 44. A company 1000 rupees par value perpetual bond has a dividend rate of 7 and required rate of 11. Okay. Now the company earnings are expected to grow at. So this line is only for the purpose of confusion. Why? Because preference dividends they always remain constant. They are non-growing. So growth rate, whatever given, that is only for the purpose of confusion. If the price per share for the preference stock is 75, it is most likely. Okay, so now I want to compute the price of preference stock. So intrinsic value is equal to dividend that you are going to get, that is 7 rupees till infinity, divide by 0.11. So what is the intrinsic value? 7 divide by 0.11. Answer is 63.63, and now the current market price is 75. So share is overvalued by 11.36. Answer is A. 45th, a company preference stock that pays an annual dividend of 3.75 is currently selling at its par of 50. If required rate of return increases by 75 basis points, the new price is okay. So now question number 45. So now currently there is a stock which is trading at a company preferred stock that pays a dividend of 3.75. okay, 3.75, and value is equal to 50. You have to compute first the investor required rate. So as of now, the investor required rate is 3.75 divided by 50 equal to 0.075 or 7.5%. Now in the question it is given that if required rate increases by 75 basis points. So what is the meaning of 75 basis point? That is 0.75%. Now revised required rate is equal to 7.5% plus 0.75%. So this is equal to 8.25%. Now what is going to be the revised price? Revised intrinsic value is now dividend, that is 3.75 divided by 8.25%. Answer is 45.45. So answer is A. 46. Which of the following best describes the company's PE ratio? Now compared to the company's trailing PE ratio, the justified PE ratio is okay. So now first you have to compute trailing and then justified PE ratio. So question number 46. Now P0 equal to E0. This is going to be your trailing PE multiple. Now current price is 35. Current earning is 6. So answer is 35 upon 6. 5.833. So okay, so means without numerically we can also get the answer. Okay, so now price is going to remain constant, your earnings are increasing. So if your earning will increase in the future, so multiple is going to be lower. So always, so this is trailing multiple, trailing P ratio. So always leading P multiple will be less than, if the profits are increasing, will be less than trailing PE ratio. Okay, because your earnings are increasing. So now what is given in the question? Now compared to the trailing, the justified PE ratio would always be lower. Okay, now let's solve mathematically as well. Now leading PE ratio, this is equal to DPR upon KE minus G. Now dividend payout ratio. So a dividend payout ratio is 2.4 divided by 6. So that is 40%. KE is required rate of return, that is 0.15, and growth is 0.08. Now if I solve this, this is 5.71. Now your value was 5.833. This is your trailing multiple. Your leading multiple is 5.71x. Now point to be noted, even without mathematically solving, we can compute, we can say that leading P multiple would always be less than trailing, because your profits are increasing, even is increasing. So denominator is increasing, as a result ratio will be lower. So answer is C. 47th. Which of the following will most likely affect a company's financial leverage ratio? So now payment of 9% stock dividend. It is a non-cash transaction. Completion of 1-for-20 reverse stock split. It is a non-cash. Now paying a dividend. The moment you will pay the dividends, your assets will reduce, equity remain constant, as a result of which leverage ratio will increase. So which transaction is going to affect the financial leverage? A and C are non-cash transaction, where the formula for 47th, where the formula for leverage ratio is asset upon equity. Now if you pay a equity dividend, okay, now if you pay a dividend, your asset will reduce, okay, equity will reduce because their profits are reducing, you're distributing them, as a result of which it is going to impact leverage. But A and C, both of them are non-cash. A and C, both of them are non-cash transaction. So answer is B. 48. 48, you have to calculate intrinsic value per share. Okay, now question number 48. Now dividend payout ratio. So dividend payout is going to be 0.6, 0.1 minus G. So G is not given. Okay, so now let's find out G. G is equal to ROE into 1 minus dividend payout ratio. ROE is equal to 0.125 multiplied by 1 minus 0.6, that is 0.4. So 0.125 multiplied by 0.4, this is 5%. So minus 0.05, so this is equal to 0.6 divided by 0.05. So answer is 12. Now what is the next year earning? Next year expected earning is 3. So P0 upon 3 is equal to 12, or P0 is equal to 36. Answer is A. 49. You have to compute intrinsic value. Okay. Now you have to find out using Gordon growth model. Dividend will keep on increasing at infinite rate. Current dividend is 3. Okay. Now question number 49. So intrinsic value is equal to D1 upon KE minus G. Now current dividend is 3. This has to be multiplied by growth. KE, required rate of return, is 0.16, and now I want to find out growth. Growth is equal to ROE, return on equity is 0.15 multiplied by 1 minus dividend payout ratio. So growth is equal to 0.0825 multiplied by 1.0825 minus 0.0825. So if you solve 3 multiplied by 1.0825 divided by 0.16 minus 0.0825 bracket close equal to, answer is 41.90. So answer is C. 50th, you have to compute market cap of the company. Market cap of the company, EV multiple is 3.2. So question number 50, EV by EBITDA multiple is equal to 3.2. Now in the question it is given that your EBITDA is 15. So EV is equal to 3.2 multiplied by 15, that is 48. Now EV is equal to market value of equity plus debt minus cash. So this is 48 plus debt. Now value of debt is 10. Okay, so value of debt plus value of equity as well, value of preference stock as well. So now there are 3 persons who have contributed the money: equity, debt and preference shareholder. So equity plus debt plus preference share. Now preference share market value is 5 minus cash. Cash is 4.5. So now E is equal to 48 minus 10 minus 5 plus 4.5 equal to that is 37.5. Answer is B. 51. If a company reports negative earnings for the just year ended, the price multiple that is least likely to be meaningful is trailing PE multiple. Negative multiples are meaningless. Okay. So now in this case, least likely meaningful is A. Yeah. So now your next year earnings could be positive, your cash flows could be positive. It is specifically given that your earnings are negative. Now earnings are negative, that means trailing P multiple like we computed in case of PVR, this is going to be meaningless. Okay, now 52. Using two-stage dividend discount model, you have to find out the value. Okay, 52. Now next year revenue is 180. Next year profit margin is 15%. So that means next year EAT is equal to 180 million multiplied by 15%. So next year earnings are going to be 27 million. Okay. Now dividend payout ratio is, so this is the total earning. So let's compute earning per share. This is 27 million. In totality 8.1 million shares are outstanding. So per share EPS is 3.33. Okay. Now dividend will grow at 25% for 2 and 3, and post year 3 it will keep on increasing at 5%. You have to find out the value. Okay. Now your DPS for the next year is 3.33. So dividend for next year is equal to 3.33 multiplied by 0.6. So answer is 2. Now create the timeline. 1, 2, 3. Next year you will get a dividend of 2. Then dividend will keep on increasing at 25%. So dividend at the end of year 2 is 2.5. Dividend at the end of year 3 is 3.125, and dividend for 4th year will grow at 5%. This is 3.28125, and so on till infinity. Now first let's compute the value of this particular part. So value at the end of year 3, this is D4 KE minus G. 3.28125 divided by required rate of return is 12, growth rate is 5%. That means this is divided by 0.07. Answer is 46.875. Now revise timeline plus 46.875. Your required rate of return is 12%. Now compute the value of these cash flows. Required rate of return is 12%. Cash flows I can clear over 0, enter down arrow, 2, enter down arrow, 2.5, enter down arrow, and finally 3.125 plus 46.875 equal to, that is 50, enter. Press NPV. Required rate of return is 12, enter down arrow, compute. So NPV is equal to 39.367. Answer is A. 53, using Gordon growth, you have to find out the intrinsic value and you have to tell whether the share is overvalued, undervalued or fairly valued. Gordon growth. So now current dividend is 5, growth rate is 4%. 53. So value is equal to D1. Now current dividend is 5, multiply by growth, that is 1.04 divided by 0.06 minus 0.04. So answer is 260. Now market value is 250. As your intrinsic value is 260, that means one day it will go to 260 rupees. Today it is trading at 250. Now we are going to buy. Buy means share is undervalued. Which date in the chronology of a dividend payment most likely decided by stock exchange? Now holder of record date, that is to be decided by the company. Declaration date decided by the company. Now ex dividend date. So ex dividend date, if in your country settlement system is T+2, then ex dividend date is 1 day prior. It's 1 day prior to your holder of record date, and if it is T+3, then 2 days prior to your holder of record date. So which date is most likely determined by the stock exchange, by the security exchange? That is ex dividend date. 55. Based upon PE and price to cash flow ratio, which company appears overvalued? PE. Okay, now average overvalued. So the company which is having the highest multiple, that is overvalued. So that is company A in case of PE, and price to cash flow again with the highest multiple, that is A. So company with the highest multiple, that means we are paying the highest price, that is overvalued. Answer is A. 56. Which of the following in the dividend chronology can fall on weekend? Okay, now record date has to be a trading day. X date has to be a trading day. That means share market should be open on that particular day. Now my point is which can be fall on a weekend, that is the payment date. Now market is open from Monday to Friday. That means markets are closed on weekend. So ex dividend date and record date cannot be on weekends. Okay, it has to be a trading day. Which can be fall on weekend, that is going to be payment. Answer is A. 57. Expected future benefits to be received from a common share are most likely input for, that is going to be PV models. Now why a stock like Tesla is trading at such a high valuation? Because of future benefits. 58. 58 is important. After 2-for-1 split, so now you're splitting your share into two parts. Which of the following will most likely change relative to pre-split value? Okay, now these are multiples. Dividend payout ratio, price to earning, these are multiples, these are ratios. So these ratio will anyways going to remain constant. Okay, now what will change? That is going to be earning per share. Now for example, 58, if your earning per share earlier was 30, now you have divided one share into two parts. Now what is your EPS? Now your EPS per share is going to be 15. So it has changed. Pre-split it was 30, post-split it will be 15. But what about dividend payout ratio? Now let us assume that in totality your profits are 100, and you decided that I want to give 60% of profit as dividend. So 60 rupees dividend is going to be declared. Okay, so in totality, what is the dividend? In totality, the dividend is 60. So it is not talking about per share. Now price to earning ratio. Price get half, earnings get half. As a result, it will remain to original value. So which thing will change? Which item will change? That is which is on per share basis. Yes, earning per share is going to change. So answer is A. 59. Relative to industry multiple, X corporation EV by EBITDA multiple is, now you have to compute EV by EBITDA multiple. So what do you mean by EV? Market value of equity, preferred stock, debt minus cash. That is 10,000 plus 2,000 plus 6,000 minus 1,000. Divide this by 2,000. So my answer is coming out to be 8.5. Industry value is 8. So compared to industry, your answer is higher. My answer is 8.5. Now 60. Asset based valuation model is most likely applicable for small and privately held companies. 61. You have to compute companies EV by EBITDA multiple. So now market value of debt, equity 55 minus 2.5, this is 52.5 divided by 15. So answer is 3.5. The tax rate given is only for the purpose of confusion. 10 plus 45 minus 2.5 whole divided by 15. So answer is 3.5. 62. Which of the following is least accurate? So it is a dividend paying capacity. A is correct. It increases with increase in the firm's net borrowing. Yes, as the borrowing will increase, there is going to be an inflow. So yes, it is correct. It is significantly affected by the amount of dividends paid by the company. Incorrect. Now in the entire performer, what was the format? EAT plus depreciation. EAT plus depreciation. Then you have to make adjustments for debt, capex and working capital. So it is unaffected by the amount of dividend. Eventually from the business, how much equity holder has earned cash. So this is the distribution. So whatever the cash flow we generated, one part is distributed to equity holders in the form of dividend. So while computing the cash flows, whatever the payment we are making to the equity, we have to ignore that. That means it is unaffected by the amount of dividend. It computes the firm's dividend paying capacity, correct. Increases with increase in firm's borrowing. As debt will increase, there is going to be an inflow. That inflow belongs to equity. Now how much in totality you have earned? How much in totality cash has been generated for the equity? So we are going to ignore the transactions with the equity holder. C is the correct answer. Then 63. Gordon growth is most appropriate for. It is most appropriate for the companies which are in the mature industry. Answer is A. 64th. The best conclusion that fund manager can make is that company's A stock is more attractive than company B because of its. Okay. So now why B is incorrect? B is saying higher, greater financial leverage. So if leverage is more, that means risk is higher. So why it is more attractive? Because of greater leverage. Incorrect. Because of greater leverage, that means the stock is risky. B is incorrect. Okay. Now I'm left with two options. One, lower PE ratio, and second is higher dividend growth rate. So now let's compute PE ratio. So required rate of return is given, dividend payout is given, and you have to find out growth as well. So now let's first find out growth. So growth is equal to ROE multiplied by 1 minus dividend payout ratio. So ROE is equal to, for company A, growth is equal to 0.154 multiplied by 1 minus dividend payout ratio, that is 0.65. So this is for company A. Company B growth is 0.143 multiplied by 1 minus, so this should be 0.35 and 1 minus 0.3. So if you solve This is 0.1001. 0.1001. So growth is same in case of A and B. So C is also an incorrect answer. So correct answer is A. So let's find out PE ratio as well. Now PE ratio for company A. Now PE is equal to dividend payout ratio upon KE minus G. Dividend payout ratio for company A is 0.35. Required rate of return is 0.13 minus 0.1001. So if I solve this, answer is 11.70. This is for company A. For company B, 0.3 divided by 0.124 minus 0.1001. Answer is 12.55. Now why company A is it attractive? Because of lower PE multiple. So correct answer is A. Okay. So friends, with this we have covered this chapter. Okay. So now how we are going to proceed with? So it's very important that you have to revise thoroughly this chapter, solve this 64 question before proceeding to the next part. I think your hand notes would be more than sufficient. Okay, so revise your class notes, solve these 64 questions before proceeding to the next part. Thank you. Hello friends, today we are going to start with reading market organization and structure. Okay, so before to start with, let's have a broad understanding of what we are going to learn in this chapter. So in this, you will learn about the basic stuffs about the securities where you can invest your money, how to place order in the stock exchanges, what is the role of financial systems and the role of what are the main functions of financial systems and the role of regulator. So that means this chapter is going to be like a bit theoretical one. Okay, lot many theories there, and the approach, the strategy for this reading is going to be that I'm going to cover 1 or 2 LOS, and based upon that we are going to solve all the problems and then I proceed to the next one. Okay, so what is the strategy? Cover up 1 or 2 LOS, solve all the practice problem, move to the next LOS, solve the problems, and so on. In this particular chapter, I suggest that going through the reference book may not be required, and I try my level best to cover the theory part comprehensively in the video itself. Okay, so on this note, I'm going to start with my first LOS. So LOS is, so 2 LOS I'm going to combine, LOS E and LOS F. On this LOS, these 2 LOS collectively I'm having 18 practice problem. Practice problem 5, then 30 to 34, and finally 54 to 62. So we cover LOS E and F and then proceed with these 18 practice problem. Okay, now LOS E and F. Compare position an investor can take in an asset. Calculate the leverage ratio, rate of return on a marginal transaction, and the security price at which investor will receive a margin call. Okay. Now, whenever you want to buy or whenever you want to take a position on an asset, there can be 2 positions. Number 1 is long the asset, and second is short the asset. What is the meaning of long? Long means buying the asset today sell at a future date, and in this way you are going to make capital appreciation. Now, for example, I want to create a long position over HDFC Bank. Now, what is the meaning of this? Suppose today the current price of HDFC Bank is 1500. So this is the price at time 0. Today you are going to buy it, and now in the future you are going to sell, and let us assume that after 1 year the price in the market is 1600. So in this way you are going to book a capital gain of 100 rupees. So long the asset, buy the asset today, sell at a future date. In this manner you are going to make the profits. Now whosoever long the asset today, that means which view he is going to have? So he is bullish, he has a bull view, he is bullish on the share. Now what is the meaning of bullish? That means he is anticipating that in the future the share prices are going to increase, and if eventually the prices increases, he is going to make the profit. Now whosoever has the long position, that means he is having a bullish view on the share. Okay. Now second method is short the asset or short selling. Now how this method works? Now before I proceed with this concept, a disclaimer is that in our country this method is not allowed. So we are allowed short selling, but that short selling is not with the help of equity market. That short selling is with the help of derivatives. So the method that we follow in India, this I'm going to discuss in the chapter derivatives. This one method is typically allowed in US. Okay. Now short the asset. What is the meaning of this? In this scenario, you are selling the asset today, and buy the asset at a future date. And in this manner you are going to make capital appreciation. Now for example there's a share ITC, and currently ITC is trading in the market at 240. Okay, so today I will sell. Now what is your selling price? Now today you will sell, your selling price is 240. And now after 1 year, let us assume that ITC is trading in the market for 220. I will buy the share at a future date. Now when I buy, my cost is going to be 220, and I'm going to make a profit of 20 rupees per share. That means whosoever involved in short selling, he is having a bearish view over the share. That means he is anticipating that the share prices are going to fall in the future, and if eventually the share prices fall, he is going to make the profit. So long means buying the asset today, sell at a future date, you are having a bullish view. Short, selling the asset today, buying at a future date, and you are having a bearish view over the share. Now the point is how this short selling works. So how it is possible to sell the asset without having it? Now let us assume that there are two investors. Now two investors is, one is Vikas and one is Akash. Now in this case there are two investors, and now Vikas is having a bullish view over ITC, and today he purchases one share at 240 in the market. So Vikas is having a bullish view, he purchased one share at 240 in the market. Okay. On the other hand, Akash is having a bearish view, over ITC, and he thinks that in the future, ITC is going to fall. Okay. Now, in order to earn extra money, what Vikas does? Now, he has already purchased the share. Today he has buy the share at 180. Today he has buy the share at 240. Now he will lend this share. He will transfer this share, lend this share to Akash. So lend the share to Akash. Okay. Now what Akash will do? Now Akash will sell the share in the market. Akash will sell the share in the market, and by doing so, there is a proceed of, he will receive a proceed of 240. Okay. So he has sold the share and he receive a proceed of 240 from the sale of this particular asset. Okay. Now Akash will transfer this 240 rupees at time 0 itself. Akash will transfer this 240 to Vikas. Okay. So Akash will transfer this 240 to Akash. Akash will transfer this 240 to Vikas at time 0. Okay. Now how much money Vikas again having in its pocket? So now Vikas is again having 240 rupees in its pocket. Now he will invest this money. Again in some bank securities and earn the interest as well. Now from the point of view of Vikas, what is the additional income? Now additional income is, now he is going to earn additional interest on this 240 rupees. Okay. And now what happens? Now Vikas has lent the share to Akash, and now with the promise that tomorrow one day in the future date, you are going to return me this particular share again. So I have lent the share, you have shorted. Now with an objective that one day you are going to return this share to Vikas again. Okay. Now let us assume that after 1 year, ITC is trading in the market. ITC is trading in the market for 180 rupees. Now what Akash will do? He will buy the share. Akash will buy the share, return this share to Vikas, and Vikas in return will transfer the proceed, that is 240, to Akash account. Now in this entire transaction, eventually how much gain Akash makes? So in this entire transaction, he earned 240, he purchased the share for 180. In this way, Akash capital appreciation is going to be 60 rupees. What is the gain? That Vikas make? Vikas is having a bullish view. Vikas wants to own this share for, let's say, for upcoming 10 years. Now by the end of year 1, he is still having his share. And plus he has earned the additional income in the form of interest by lending this money. So it is advantageous to both Akash and Vikas. Vikas earns additional interest on 240 rupees. Vikas earns additional 240 rupees as interest, and Akash is in a position to earn a capital appreciation of 60 rupees. Now point to be noted, in this case, Vikas is having a long-term view over the share. He wants to hold the share for upcoming 10, 20, 15 years. Now my point is, by the end of year 1, he's still having one share plus earned additional income, additional interest over 240. Benefit to Akash. Akash had 60 rupees by the end of year 1. Now my point is, if the share price in the market increases, now let us assume that after 1 year the share price in the market is 300. Now what Akash will do? Again, Akash has to buy the share at 300. Akash will buy the share at 300 rupees, return the share to Vikas, and Vikas in return will transfer proceeds of 240. Okay, now in this entire game, Vikas again earned additional interest, so that is the interest of Vikas. But now Akash incurred a capital loss. So in this case, selling price is 240, buying price is 300, and in this way he incurred a capital gain or capital loss of 60 rupees. So now Akash was short seller. So he's having a bearish view. In order to make the money, share should fall in the future. If share prices increases, then Akash is going to incur the losses. Now important. That means there are two kinds of investor, or there can be two positions: long, short. Long, you are having a bull view, you want the share prices to increase to make profits. Short, you are having a bearish view, you want the share price to fall in order to make the profits. And now my point is, in this entire game, in this entire scenario under the short selling, who can default? Now my point is, if price is 180, so Akash will return the share, and Vikas will transfer 240, correct? But now my point is, if on the contrary, share prices in the market increases, then there's a chance that Akash is going to default. Akash is not going to buy the share and return it to the Vikas. Yes, so there's a counterparty risk, that in the future there's a possibility that if ITC increases, then Akash may default. Now to avoid counterparty risk, so that Akash cannot default, to avoid counterparty risk, now Akash at time 0, along with the proceeds from the sale of assets, has to deposit additional margin as well. Along with proceeds from the sale of assets, has to deposit additional margin with Vikas to avoid the counterparty risk. Now how to compute this additional initial margin? Now in the question they will be provided you with some percentage. Now let us assume that initial margin percentage is equal to 40%. Now additional deposit is going to be proceeds, which was 240, multiplied by 40%. Now if I calculate this, 240 multiplied by 0.4, this value is 96 rupees. Now to avoid the counterparty risk, you have to make this additional deposit with Vikas. And whenever in the future you're going to return the share, he will transfer 240 along with this 96 rupees to avoid the counterparty risk. Now my point is, during this entire year, during this entire period, if any dividends are declared by the company, now for example ITC declared a dividend of 10 rupee during this entire 1 year. Now Akash has the obligation to return this dividend to Vikas as well. So now whatever the benefits of the asset, I have lent you one asset. Now whatever the benefits that asset is going to pay, now if the company is paying any dividend, then you have the obligation to pay me this dividends as well. And now plus there's one more point. Now I'm going to earn interest. So in practical life, Vikas will earn interest not only on 240 but 240 plus 96. Over this amount I'm going to earn the interest. Now Vikas may share one portion of the interest income with Akash as well, and this is known as short rebate rate. So it is not necessary that always there is going to be some short rebate rate, may or may not be. So now I'm going to earn interest. I'm going to earn interest in totality on this additional deposit as well, and 240. This money belongs to you. I'm earning the interest, and whatever the interest, I may share one portion. Now this is the discretion of Vikas. How difficult the asset is. If it is difficult to short, he may not give any sort of interest. Okay. So now if I'm sharing one portion of the interest with Akash, this is known as short rebate rate. So now let's conclude. Finally, this was your LOSE. You can take two kinds of positions: long, short. Long means bullish view, you anticipate share price to increase. If eventually increase, you're going to make profit. Short the sell, that means you're selling the asset with the help of borrowing. You with a view that the share prices may fall in the future. If eventually it falls, then you're going to make profit. Now, what is the benefit for the lender? Lender is going to earn interest. If he's going to share some interest income with you, that is known as short rebate rate. Plus whatever the dividends that the company is going to pay, that is the obligation of borrower to return back to the lender. So this was the concept of long the asset and short the asset. Now at times we buy the asset with the help of borrowed money. Now if you buy the assets with the help of borrowed money, with the help of debt, now debt is going to act as a enhancing factor, magnifying factor. Now whatever the gains are going to be, that gains are going to be an enhanced one. But this is the one side of the picture. This is the one side of the coin. If there are going to be losses in the future, now the losses of the equity, the losses of the investor are going to be a magnified one. Now let's take one simple example. Now example is, there's a person, Mr. A. He buys a share of rupees 100. Buy a share of rupees 100 with two possibilities. Now possibility is share price may turn to 80 or may increase to 120 after 1 year. So now what is the gain or loss? So gain or loss under both the scenario is, here it incurred a loss of 20 rupee and here a gain of 20. Now gain percentage. Gain of 20 rupees over a capital of 100. So what is the gain percentage? Gain percentage is 20%. Loss of 20 over a capital of 100. What is the loss percentage? That is going to be 20%. Okay. So now if I'm buying the money with 100% equity with my own money, I'm going to the volatility, based upon this volatility, I can make a profit within the range of minus 20% to positive 20%. Now same question, same prices. Now you're buying the debt, now you're buying the asset with the help of debt. So now second scenario, you are buying a share of rupees 100. But this time your own money is 60 rupees. So whatever the money that you are contributing as an investor, that is initial margin. So initial margin is 60 rupees. Okay, this is the money that you have contributed, and debt is 40, and debt is at the rate of interest of 0%. 0% interest, best possible scenario. Now you are borrowing the money at 0%. This is the best possible scenario. Now again, there are going to be two scenarios. Share price may increase to 120, may reduce to 80. Now whether the price is 80 or 120, under both the cases you have to repay the debt along with interest. Okay, so now first you have to repay the debt. Now repayment of debt along with interest. So 40 rupees repayment, 40 rupees repayment. Now the balancing proceeds are left for the equity. Now equity left with 40 rupees and 80 rupees. So these are the proceeds left over for an investor. Now my point is, what is your gain or loss? You invested 60 and now you're having 80 rupees in your pocket. So in this case, there is a gain of 20 rupee. You invested 60, you're left with 40 rupees in your pocket. Loss of 20. So minus 20, positive 20 in absolute terms. Perfectly correct. But now my point is, in percentage terms, what is your gain percentage? Gain of 20 over a capital of 60. So gain percentage is 33.33%. Same wise, loss percentage is 33.33%. Now my point is, there are two scenarios in this case. One with zero debt, no debt. So if there is no debt, volatility was minus 20 to positive 20%. With debt, volatility has increased. Now it is acting as a magnifying factor. If gains are there, the gains are going to be enhanced 33%, one side of the picture. But if there are losses, the losses are again going to be an enhanced, that is equal to 33.33%. That means debt is acting as a leverage. Debt is acting as a magnifying factor. Now my point is, you have to compute one ratio. Ratio is leverage ratio. Now leverage. What is the formula of leverage ratio? It is asset upon equity. Now what was the value of an asset? What was the price of the share? The price of the share was 100 rupee. You purchase with an equity of 60. Now if I compute the leverage ratio is 1.67. Now what is the meaning of 1.67? With no debt, volatility was minus 1 to positive 1. But now because you have taken a debt, from the bank, volatility has been increased to minus 1.67 to positive 1.67. Or in simple words, volatility has increased by 67%. Now I can prove this as well. Now if I multiply minus 20 positive 20 by 1.67, you will get minus 33.33%, positive 33.33%. Now what is the meaning of leverage ratio? The meaning of leverage ratio is, because you are buying an asset with the help of a debt. So because you are buying an asset with the help of a debt, now volatility is going to increase. Earlier the volatility was minus 1 to positive 1. Now the volatility has been increased to 1.67. That means volatility has increased by 67%. If there are going to be gains, the gains are going to be increased by 67%. If there are losses, the losses are going to be increased by 67% and equal to 33.33. That means debt is acting as a enhancing factor. Now you have to compute with the help of comprehensive examples. Now you have to compute the investor's return. Now, point to be noted. Now we are going to solve number of comprehensive questions on this. Okay. So now in the question, they will be provided to you with call money rate. Call money rate. So what is the meaning of this? Call money rate basically means interest investor has to pay to the lender or to the bank. Okay. Then one word is written as commission. So commission is brokerage. Now point to be noted. Brokerage is payable, commission is payable at the time of buying, and selling the asset. So it is the commission, the brokerage is payable at both the times, at the time of buying and at the time of selling as well. So it is payable at the time of buying and selling as well. Okay, only these points you have to remember. And then one more word is given, that is initial margin. Initial margin means this is the amount investor has to introduce initially. Now, for example, you are buying a share of ₹100 and it is given in the question that margin is 20%. Now, what is the meaning of margin of 20%? That you have to introduce 20 rupees as equity and bank is ready to lend remaining 80 rupees. So initial margin, this is the amount that investor has to introduce initially. Now you have to compute investor's gain and loss in these scenarios. Okay. Now I'm starting with comprehensive numerical. First is question number 5th. Now investors buys the stock on margin. The interest on the loans and dividends are both payable at the end of the holding period. Following are the transactions. Okay. Now question number 5th. Class, this concept is double star. Both LOS E and F are double star. Very important from the point of view of examination. Okay. So now today you are going to buy 500 shares and the price is 28 rupees and leverage is 3.33. Okay. So now what is the asset value? At what price you are going to buy the asset? So now total asset value that you are going to buy is equal to 500 into 28. So now 500 into 28, that is 14,000. And in the question it is given that leverage ratio is equal to 3.33. 3.33. Now what is the meaning of this? Now leverage ratio formula is asset value upon equity is equal to 3.33. That is 14,000 upon equity is equal to 3.33, or equity is equal to 14,000 divided by 3.33. Equity is equal to 4204. That means when you're buying an asset, you're buying an asset of 14,000. Out of that 14,000, 4204 is introduced as equity. Now what is the value of debt? So debt is equal to 14,000 minus 4204. That means you have borrowed 9796 from bank at time 0. And now you have to compute investors' total return over the period. Okay. Now I want to divide this into two parts. First, time 0. So at time 0, in totality, you buy assets valuing 14,000. So asset value is, you need how much? You need 14,000. So negative. Negative means this should be an outflow. But how much debt you have taken? So you have borrowed 9796. That means eventually from the pocket of equity holder, from the point of view of investor, what is an outflow? Outflow is 4204. So from the pocket of an investor at time 0, what is an outflow? That is 4204. Okay. Now you're holding this share for 6 months. And after 6 months, you're going to sell this for 30 rupees. Okay. So now time after 6 months, proceeds from sale of asset. Now per share you're going to sell at 30 rupees. You're having in totality 500 shares. What is going to be proceeds? Proceed is 15,000. But now after 6 months, you have to repay the loan along with interest. So repayment of loan. Repayment of loan along with interest. So 9796 plus. Now what should be an interest? So you're borrowing the money only for 6 months. Now in the equation it is given that call money rate, that means interest. Call money rate is 5% per year. So you have to pay an interest of 5% per year, but you are borrowing the money only for 6 months. So now what should be an interest? 9796 multiplied by 5%. Now whatever this interest is, this is going to be the entire year I have borrowed only for 6 months. Now divide by 2. So how much you have to repay to the bank along with interest? 9796 multiplied by 5%, divide by 2. So interest is going to be 245 plus 9796. This is equal to 10041. So this is going to be an outflow. Now I am left with 15,000 minus 10041. I am left with 4959. So at time 0, you invested 4204 from your pocket, and now you are left with 4959 after repaying the debt to the bank along with interest. Okay. Now I'm proceeding further. Now there's a word given, commission, that is brokerage. Now point to be noted, brokerage is payable both at the time of buying and selling the share. So now what is the brokerage? Brokerage is 0.05 per share. Now I have to pay brokerage, commission. So what is the commission? 0.05 into 500 per share, that is 25 rupees. You have to pay, that is an outflow at the time of buying, and commission at the time of selling as well. So again you have to pay 25 rupees. Okay. Plus you have also received a dividend of 0.40 per share. So how much dividend I have received? Dividend I received at the end of the holding period. So how much dividend I have received? 0.4 multiplied by 500. 200 rupees. Now after 1 year, I am having 5134 in my pocket, and initially how much money I have invested? That is 4229. Now you have to compute investors return. So investors return is equal to return of an investor is equal to 5134 minus 4229 divided by 4229 is equal to 5134 divided by 4229 minus 4229 divided by 4229 is equal to 5134 divided by 4229 equal to minus 1. Answer is 21.399%. So during this 6 months, how much return I have earned? My return in percentage terms is going to be 21.399%. So answer is C. Now again a quick revision. So it is given that you are buying assets valuing 14,000. Leverage ratio is given as 3.33. Now this means that equity is 4204 and debt is 9796. Now you are going to sell the share after 6 months. So after 6 months, prices have increased to 30. The moment prices have increased to 30, now you have to repay the debt along with interest. Now, but point to be noted, you are going to pay interest only for 6 months. Now the word is commission. Commission is payable both at the time of buying and selling the share. Both at the time of buying and selling the share. And now you have to compute your return. You invested 4229. It turned into 5134. Eventually you have earned during this period, during the 6 months, that is going to be 21.399%. So in this way class, we have computed the investor's return on a leverage transaction. I am proceeding further. Now on this concept, I am going to solve number of questions as well. Now my next question is question number 30. Now the minimum margin requirement is 55%. Minimum margin requirement is 55%. You have to compute leverage ratio. So question number 30. Now suppose the share is 100 rupees and now bank is saying that minimum margin is 55. Minimum margin is 55. Minimum margin 55 means minimum you have to introduce as equity 55 rupees and we are ready to pay only 45 rupees. You have to compute leverage ratio. Leverage ratio is asset upon equity, that is 100 upon 55 equal to 100 upon 55. This is equal to 1.8181. So answer is B. Next 31. A trader has purchased 200 shares of a company at 50 rupees per share. Leverage ratio is 2.5. 6 months later, he sells the shares for 60 rupees. ignoring the interest and the transaction cost, you have to compute the return. Okay. So now question number 31, it is similar to question number 5. So question number 31. Now again, this is, you are going to buy asset value. Now asset value is equal to 200 multiplied by 50. That is 200 multiplied by 50 is equal to 10,000. Now it is given that leverage ratio is 2.5. Asset upon equity 2.5. 10,000 upon equity 2.5. So what is the value of equity? Value of equity is 4,000. Value of debt is going to be 6,000. Okay. Now time 0 and time 6 months. So you purchase an asset value. Asset value is 10,000, but you have taken a debt of 6,000 from the bank. So from the point of view of an investor, there is an outflow. So from the point of view of an equity, there is an only outflow of 4,000. Now after 6 months, you have to repay the debt along with interest. In the question it is specifically given, ignore interest. Now after 6 months, repayment of debt. Now repayment of debt is 6,000, and proceeds, you are going to book the gains. Now proceeds from sale of asset. Now you are going to sell the share for 60 rupees. 60 multiplied by 200. You will get 12,000 rupees. Now you're left with 6,000. Okay. Now you have to ignore the interest, transaction cost, and you have not received any sort of dividend. Now during the 6 months, what is your return? So you invested 4,000. It turned into 6,000 after 1 year. So now my answer is, my return is equal to 50%. So answer is C. Next, question number 32. Now a person purchased 500 shares at 32 rupees per share. Stock was bought on 75% margin. Now 75% margin means 75% introduced as equity and remaining 25% as debt. 1 month later, he had to pay interest at a rate of 2% per month. He received a dividend of 0.5, and immediately after that he sold the share at 28 rupee. He paid a total commission of 10 rupee on the purchases and on the sale of the shares. You have to compute his return after 1 month. So question number 32. So now first, you are going to buy, asset value is 500 multiplied by 32. This is equal to 16,000. Now 75% is the margin. So now 75% margin equal to 75%. That means you have to introduce equity of 12,000. So what is the value of debt? That is going to be 4,000. Now again, time 0 and time after 1 month. So you purchase an asset having a value of 16,000. Outflow, but bank contributed 4,000. So from the point of view of equity, there is an outflow of 12,000 only. Now after 1 month, you are going to sell the share. You are going to sell the share for rupees 28. What is the proceeds? Now proceeds are going to be 500 multiplied by 28 equal to 14,000. You have to repay the debt along with interest. Now the interest is 2% per month, specifically given 2% per month. You have borrowed 4,000. So 4,000 multiplied by 2% per month, that means 80 rupees is interest. How much you have to repay? 4,000 plus 80. So there is a repayment of 4080. You are left with 9920. Now in totality you received a dividend of 0.5 per share. You are having 500 shares. So what is going to be the dividend? Now you received a dividend of 0.5 per share. So dividend of 250. Now you have to pay commission of 10 rupee at the time of buying, commission of 10 rupee at the time of selling. Now you are left with 10160. You invested 12010. Now what is your return? This value divide by this value minus 1. 10160 divide by 12010 minus 1. So return is equal to investors' return is equal to minus 15.40 percentage. Minus 15.40 percentage. Answer is B. Question number 33, double star. Now question number 33, double star. Now an investor believes that the prices will go down in the future, and she decided to short sell 200 shares at the current price of 47. So now when you short sell, you will get a proceeds of 200 multiplied by 47. Now the proceeds are going to be 9400. Now this 9400 you have to deposit with the lender. Okay. The initial margin requirement is 40%. Now initial margin requirement is 40%. That means along with you have to deposit some, you are going to deposit and you are going to make an additional deposit with the lender. Now what is going to be that initial deposit? So first, question number 33, double star. So proceeds from sale of assets. Proceeds from sale of asset is equal to 47 multiplied by 200, that is 9400. So this you have to transfer to the lender, but you have to make, to avoid the counterparty risk, you have to make some initial deposit as well. Now initial deposit is equal to 9400 multiplied by 40%. So if I solve, answer is 3760. Now option A, B, C. Now option A, she will contribute 3760 as margin. Answer is correct. Option C, she will only have to leave the proceeds from the short sale as deposit and does not need to contribute any additional funds. So C is incorrect. Over and above proceeds, you have to deposit 3760 as margin to avoid counterparty risk. Now question number 34. Now before I proceed to 34, we have to cover one more concept. Okay. Now my point is, let us assume today you have borrowed a share, you purchase a share with the help of borrowed funds. Now for example, the share value is 100, equity is 60 and debt is 40. So what was the initial equity percentage? 60% in the total asset value, and 40% has introduced in the form of debt. Now my point is, suppose you have borrowed this money from HDFC Bank. Now what HDFC want? That share price should increase in the market or should reduce in the market. Now if the share prices are continuously, so how it happens? So now whenever you buy the assets with the help of borrowed funds, okay, now you have to pledge this asset with the bank. Okay, so you have to pledge the asset, pledge the share with bank. Okay, and then bank is going to provide this 40 rupees. Same wise, whenever you're going to buy a house with the help of borrowed funds, so one portion you have to introduce as equity, one with the help of debt. Now whenever the bank is going to give you a debt, bank will create a mortgage over that property. Same wise, in this case also, you have to pledge the share with the bank. Okay. Now my point is, if the prices are continuously increasing, you have purchased a share of 100 rupees, 120, 150, 200, 250. Now my point is, in the future, can you default on this money? No, because your shares are continuously increasing. And if you're unable to make the payment to the bank will sell the share and recover the proceeds. So there is no counterparty risk if the shares are continuously increasing. But now my point is, you purchase one share and suppose the share is Yes Bank. That is continuously falling in the market. Now bank is secured till what point? Bank is secured, bank has lent 40 rupees. So bank is secured till 40 rupees. But the moment it breaches the level, it falls below 40, there's going to be a counterparty risk. There's a risk that you may not pay the money back to the bank. Now there's a concept of margin call. Okay. So now to explain the concept of margin call, let's understand this is an example. And in this example, what was my initial margin? My initial margin was 60%. Initial margin means the amount that equity has introduced, that is 60%. And let us assume that maintenance margin is equal to 40%. Now what is the meaning of maintenance margin? So this much amount as equity should always be there. So this is the minimum equity. Okay, so just to avoid the confusion, make it 45. Okay. Now minimum equity that investor needs to maintain always. Okay. So first, if the share prices are increasing, there is no counterparty risk. So Mr. A will default only if share prices are falling. Okay. Now let's take some scenarios. Now my point is, if the share price is 100, equity is 60, debt is 40, equity percentage is 0.6 or equity percentage is 60%, debt percentage is 40%. Okay. Now tomorrow assume that the share price start falling, and now in the market it reaches 90 rupees. Now my point is there's a loss of 10 rupee. This loss of 10 rupee belongs to, now bank has given you the funds 40 rupees. Now bank is least bothered with whether there's a gain or loss. Bank wants its money along with interest. Okay, so if there's a loss or if there's a gain, that belongs to the equity holder. Now in the market, your share price have fallen to 90, there's a fall of 10 rupee. That 10 rupee loss belongs to equity. Now how much equity is left? 50, debt 40. Suppose again there's a fall of 10 rupee, 80, equity 40, debt 40, 70, equity 30, debt 40. Now my point is, you have to compute the revised weights. So now as the prices are falling, all the losses belongs to equity. So weight of debt will keep on weight of debt will keep on increasing and weight of equity will keep on reducing. So now what are the revised weights? Now 50 divided by 90. This is 55, 45. Then 50%, 50. 3 divided by 7, that is 42%, and 58%. So now very carefully, the weight of debt is continuously increasing and the weight of equity continuously reducing because this losses belongs to the equity holder. Now maintenance margin is equal to 45. That means this much equity you have to maintain always. Investor, this much you have to maintain. Now my point is, now my focus is over this particular point between 70 to 80. Now if the price is 80, equity component is 50%, and now if the prices falls to 70, equity weight reduces to 42. Now this is less than maintenance margin. The moment you are going to breach this maintenance, you are going to receive a call from the bank. Now this call is known as margin call. Now what is the purpose of this margin call? The purpose of this margin call is that you have to deposit additional amount with the bank so that this maintenance, this amount, this percentage is going to be maintained. Maintenance margin. Now my point is, you have to find out the price at which you are going to receive a margin call. Again I repeat, if the share prices are continuously falling, the risk of the bank is increasing. Now to safeguard that risk, a bank will demand the repayment of loan. Now when you are going to receive a margin call, first you have to compute this price, and if the prices will reach this level, you have to make the additional deposit so that bring back the amount back to maintenance margin. Okay, now important. So the formula is margin call. Formula is initial price multiplied by 1 minus initial margin. So this is nothing but, the denominator is nothing but, this is nothing but debt per share. Okay, divided by 1 minus maintenance margin, divided by 1 minus maintenance margin. Now in this case, what was the debt per share? Debt per share was 40 divided by 1 minus maintenance margin. Maintenance margin is 45. So if I solve this, 40 divided by 0.55, answer is 72.72. Now important. Now let's understand the interpretation. So numerator is debt, 1 minus maintenance margin, that is 55%. Now bank is saying that my weight in the prices shall not breach 55. If it breaches 55, you are going to receive a margin call. Now at what price you are going to receive a margin call? At 72. The moment it reaches 72.72, you will receive the call from the bank that you have to maintain the maintenance margin. Now for example, if the share price, if share price suddenly reduced to 70 rupees. So it is a price, it is below 72.72. Now if share price reduced to 70, now what is the weight of equity? 42. This weight should be 45. Now 45% of 70. So now 45% of 70. This is equal to, now this much equity should be there. Currently what is the equity? Equity is 30. Now you have to pay 1.30 1.5 rupees to the bank. This 1.5 is nothing. This 1.5 is nothing but repayment of the debt. So now what is going to be the revised value? If the share price reduces to 70, now equity will be 31.5. This is 45%. And debt is going to be 70 minus 31.5, that is 38.5. And this 38.5 is exactly equal to 55%. That means what bank is saying? At any given day, my weight cannot exceed 55. If the weight will exceed 55, you will have to bring it back. You have to start the repayment of the debt, so that to avoid the counterparty risk. So now class, you have to remember only one formula. That one formula is when you will receive a margin call. So margin call you will receive, formula is P0 1 minus initial margin divided by 1 minus maintenance margin. This is equal to debt per share upon 1 minus maintenance margin. If in my case maintenance margin is 45, this is simply saying that debt weight cannot increase beyond 55%. If it increases beyond 55, you are going to receive a margin call from the bank to again deposit the amount and bring it back to the maintenance level. Or in simply, you have to repay the debt so that the weight of debt reduces and weight of equity increases. Okay, now we are solving one problem on this. Question number 34. Currently the stock is trading at 25. You invested $10,000 and you have borrowed additional 10,000. So in totality you are investing 20,000 in a stock. If maintenance margin is 30, at what price you will receive the margin call? Okay. So now in this case, question number 34. In totality, you are investing 20,000, 10,000 as equity, 10,000 as debt. Now my point is, what is initial margin? Initial margin is equal to 50%. Maintenance margin is equal to 30%. So margin call is equal to share price, that is 25 multiplied by 1 minus 0.5 divided by 1 minus 0.3. 12.5 divided by 0.7. So answer is 17.85. Answer is B. Okay. So now class, with this we have covered LOS, E and F. And now I'm going to solve more practice problem, that is from 55 to 62. From 55 to 62. Now what I request you, pause the video here. Okay, pause the video and try to solve question number 55 to 62. Okay, and then you're going to watch the video. Okay, so question number 55. Try your level best to solve question number 55 till 62. Okay. Question number 55. Now our investor borrows maximum amount by the initial margin requirement of 40% to purchase 100 share selling at 60. If investor wants to sell the share when the prices increase to 70, her return before commission and interest will be closest to question number 55. Now what is the asset value? Asset value is 100 multiplied by 60 equal to 6,000. Now initial margin is 40%. Now it will have two components, initial margin 60%, sorry, initial margin 40%, that is 2,400, equity, and debt is going to be 3,600. Now times 0. You want to purchase asset worth 6,000, 3,600 as debt, So equity is going to be 2400. Now time 1, you are planning to sell this asset for 70. You will get 7000. You have to repay the debt along with interest. Interest is 0. So you have to pay 3600. Now you're left with 7000 minus 3600 equal to 3400. Sorry. Now you invested 24, it turned into 34. So in this way, there is a gain of 41.67. Answer is A. 56. Which of the following statement is most accurate regarding a short position of 100 shares at a price of 50? Now today you have short the share. So now if you have short the share, question number 56. So what is your selling price? Now your selling price is 50 multiplied by 1000, 50 multiplied by 100 equal to 5000. Now tomorrow you want to buy this. Now hypothetically, by what time or by what value an asset value can reduce? So maximum. So what is going to be the minimum value of an asset? Now it can fall, maximum it can fall to 0. Now assume that the share price falls to 0, you will buy at 0. Now your gain is going to be 5000. Now this gain of 5000, this is minimum gain or maximum gain. So now under short position, your gains are limited. Maximum you can earn a profit of 5000. This 5000 is possible only if the share prices reduce to 0. So you're going to make a maximum profit of 5000. Answer is B. Question number 57. A trader describes her currency contract exposure as long the euro against the British pound. So what is long the euro? Long the euro means now you're going to buy euro and against that you're going to sell British pound. So now A, B, C. Long means buy the asset. So now this is a forward contract. Now what is the meaning of forward? This we are going to cover under derivatives comprehensively. Okay. Forward contract to buy euros in exchange of British pound at a predetermined exchange rate. That means today you are entering into a contract that in the future you will buy the euros and exchange the British pound. So comprehensively, what forward contract we are going to cover under derivatives. So answer is B. 58. Now you have to compute the investors. Now assuming that the interest and the dividends are paid at the end of the year, the price at which investor sold the stock. So now in this you have to find out the price at which you have liquidated your holdings. So question number 58. Now share purchase 700, purchase price is 22 and leverage is 1.6. So now asset value is 700 multiplied by 22. So 700 multiplied by 22. This is 15,400. Leverage ratio is 1.6. Asset upon equity 1.6. Now asset is 15,400 upon equity 1.6, or equity is equal to 9625. Debt is equal to 15,400. Now debt is equal to 5775. So now at time 0, you have purchased an asset for 15,400. There's an outflow, but debt is 5775. That means net outflow from the pocket of an investor is 9625. Okay. Now you have to repay the debt along with interest. You have to find out the selling price. Assume the selling price to be X. So that is 700X. Okay, you have to repay the debt along with interest. Now this is 4%. You are borrowing the money for entire year. So now 5775 multiplied by 1.04. So this is your proceeds, loan repayment along with interest. This is 6006, left with 700X minus 6006. Okay. Now commission is not given. You received a dividend of 0.6. So dividend 0.6 multiplied by 700. 0.6 multiplied by 700. So this is 420. Okay, commission is not given, so assume it to be 0 and 0. Now in totality you have a return of 12%. So 9625 you have invested, and now during the entire year you have a return of 12%. So if you have a return of 12%, that means in totality you have made 10780. So you invested 9625 on a return of 12%. That means by the end of the year you are having 10,780 in your account. Okay. Now you have to find out X. So now what is going to be X? 700X minus 6006 plus 420 equal to 10780. So if I solve, plus 6006 minus 420 divide by 700. So if you solve, X is equal to 23.38. So at what price you have liquidated the share? That is 23.38. Answer is C. 59. You have to compute total return. Okay. 59. You purchase the share at 50, sell at 55, in totality 500. Margin is 45%. So what is the asset value? Asset value is 50 multiplied by 500. That means 25,000. It has two parts. One, initial margin is equal to 45%. That means equity is equal to 25,000 multiplied by 0.45 equal to 11,250. Debt is equal to 13,750. So now you purchase an asset at time 0. Asset value is 25,000. Debt is 13,750. From the point of view of equity, there is an outflow of 11,250. Now, after 1 year, you have sold the share for 55 rupees. So what will be the proceeds? 55 multiplied by 500. That is 27,500. But now you have to repay the debt along with interest. Rate is 6%. So 13750 multiplied by 1.06. So that is 14575. You're left with 12,925. Okay, so dividend you received 1.80. That is per share. In totality dividend that you received, that is 900. You have to pay commission both on buying and selling. So that is 0.05 multiplied by 500. So commission of 25, commission of 25. Now I'm left with 12925 plus 900 minus 25, 13,800, and how much you have invested? 11275. So what is the return? Return is 22.39%. 22.39%. Answer is A. Then 60th. A trader buys a stock at 64 on margin with a leverage ratio of 2.5, maintenance margin 30. At what price he will receive? He will receive a margin call. Question number 16. Now leverage ratio is equal to 2.5, asset upon equity 2.5. Now you are buying a share of rupees 64. 64. So now equity is going to be 25.6. Debt is equal to 38.4. Now margin call. Margin call is equal to debt upon 1 minus maintenance margin. So if I solve this, answer is 54.85. If the prices will fall below this price, you will receive a margin call from the bank. Answer is B. 61. Opens up an account where he deposits 5,000 rupees. He purchases share, 300 shares, 30 each. Maintenance margin is 30. You have to find out the price at which you will receive a margin call. So 61. Margin call is equal to, now in totality the asset value is 300 multiplied by 30, that is 9,000. This 9,000 has two parts. One, equity is going to be 5,000. Debt is going to be 4,000 in totality. Now debt per share is equal to 4,000 multiplied by 300. So debt per share is equal to 4,000 multiplied by 300. That is 13.33. Now margin call is equal to 13.33 divided by 1 minus maintenance margin, that is 0.7. Answer is 19.04. So you will receive a margin call at 19.04. Answer is A. 62. Again the price at which you will receive a margin call, 500 share, 36, using an initial leverage of 1.66. Okay. So now 62. So asset value is 36 and leverage ratio is 1.66. So asset is 36. So what is the equity value per share? Equity value per share is 21.86. Then what is the debt value per share? 14.3. I think I made a mistake. 14.3. 36 divided by 1.66. This is 21.68. Okay, minus 36. So this is 14.32. 14.32. Margin call is equal to debt divided by 1 minus maintenance margin. Maintenance margin is 30%. Answer is 20.45. So answer is C. Then there's some calculation correct. Okay, so answer is C. Okay, so class, with this we have covered LOS E and F, and in totality have solved 18 practice problem. So now, before proceeding to the next part, revise LOS EF from the notes and solve these 18 practice problem. Okay, thank you. Now friends, in this video I'm going to cover LOS G, H, I and J, and based upon these LOS I'm having practice problem 2, 12, 35 to 38, 40 to 46, 63 to 68. That means collectively in this video we are going to solve 18 practice problem and we are going to cover 4 LOS. Okay, now let's go through LOS G. Compare execution, validity and clearing instructions. Compare market order with limit order. Okay, and then LOS J, that is quote driven, order driven and brokered market. So now these 3 LOS collectively I'm going to start with these 3 LOS. Compare execution, validity, clearing instructions. Compare market orders with limit order, and quote driven, order driven and brokered market. Okay, so now in our country the main 2 exchanges are, that is the main 2 markets are NSE and BSE. Okay, now NSE and BSE both works upon a principle, that is order matching principle. Now what is the meaning of order matching? Okay, so now in the market who is the best buyer? So now first you have to create an order book, and order book would always be from the point of view of best buyer and best seller order book. Now for example, we want to buy a stock like Reliance. Now what is the order book? So now in the order book they are going to be the buyers and sellers. Buyers means who want to buy the shares, and sellers who want to sell the share like Reliance. Now in the market, who is the best buyer? Best buyer from the point of view of seller. Now for example, there are 3 buyers, A, B, C. A wants to buy Reliance at 100, B 90, C 80. So from the point of view of seller, who is the best buyer? Now the best buyer is A. That means in the market, who is the best buyer? The best buyer is the person who is ready to pay the highest price. Okay. Same wise, in the market there are 3 sellers, X, Y, Z. X ready to sell at 110, Y ready to sell at 120 and Z ready to sell at 130. So now who is the best seller? Who is the best seller in the market from the point of view of buyer? Now who is demanding the lowest money? That means who is the best buyer? Best buyer is with the who is ready to pay the highest price, and best seller is the one who is demanding the lowest money. That means currently in the market, best buyer is A and best seller is X. Now for order to execute, either X reduce the price or A increase the price and the moment these prices matches, orders are going to execute. Now this is known as order matching principle. Okay, so now let's create one order book. So we are talking with respect to a stock like Reliance, where there are three buyers, A, B, C. A wants to buy 50 quantity, 70 quantity, 90 quantity at a price of 100, 90, 80. Okay. So buyer's book would always be in the order of descending. Descending means price highest to lowest. Now seller, quantity, price, and let us assume the seller is X, Y, Z. They wants to sell 10 quantity, 20 quantity, 30 quantity at a price of 110, 120, 130. So seller book would always be in the order of ascending, lowest to highest. Now currently in the market, who is the best buyer and seller? In the market currently, best buyer is A and best seller is X. The moment these two prices matches, orders will execute. Either A shall increase the price from 100 to 110 or X reduce the price from 110 to 100. And the moment prices matches. For example, A increase the price to 110. Now moment the prices matches. A wants to buy 50 quantity, A wants to buy 50 quantity, X wants to sell 10 quantity. The moment prices matches, A wants to buy 50, A wants to buy 50, X wants to sell 10. How many orders will execute? Now 10 quantities, the order for 10 quantities will execute. The moment prices matches, 10 quantities order will execute. Now from the order book, X will be removed. What is the current market price of Reliance? Now current market price of Reliance is 110, and from the quantity of A, 10 will be reduced. Now what are the remaining quantity? That is 40. Now who is the best buyer and seller in the market? Best buyer is A and best seller is Y. Now again, A increase the price to 120 or B reduce the price to 110. In this manner, the trading happens in the market. Now, Indian equity market. Indian equity market is based upon the principle of order matching. And as the prices will keep on matching, quantity will get execute. Now let's see a order book of any stock. Let's see a order book of Reliance. So now currently, Reliance is trading at a price of 2053. So this is the price. And this is the order book. Now order book would always be, from the buyer point of view, it is always going to be in the descending order. Descending means highest to lowest, and seller means lowest to highest. The moment prices keeps on matching, orders will get executed. Now this is known as order matching principle. Now when you want to buy a share, you can place two types of orders. Okay, so class, this was the order matching principle. And now let us assume the prices, again I'm changing it to my original example. And now my point is, now the concept was, what do you mean by execution instructions? Now execution instructions can be of two types. One known as limit order and one is market order. Limit order is further divided into four parts, can be further categorized into four parts. Take the market, make a new market, make a market. So this is a take the market, make a new market, make a market, and behind the market. Okay. Now simply you can put two kinds of order in the market. Execution can be of two types. One is going to be the limit order, and second is going to be the market order. Now first one is market order. Now what is the meaning of market order? The meaning of market order is if I place a buy market order for Reliance with 20 quantity. Now what is the meaning of this? The market order means I want to buy 20 units and I'm ready to pay any price, whatever the price it is available in the market, at whatever the price it is available, I'm ready to pay that price. Now my point is, if I place an order for 20 quantity order for Reliance, the order will get executed. The order will get executed immediately. Now that is a market order. Market order means I want to buy the share at whatever the price seller is willing to sell. But how many quantity I want to buy? I want to buy only 20 quantity. These order will get executed immediately. Now, for example, now here if I place in buy order. Now buy order can be of two types. One market and one limit. The moment I press upon market, now it's telling me what is the quantity. Now 20 quantity. And the price gets disabled. Why disabled? Now my order will go to the system, and whatever the price sellers are willing to sell, this 20 quantity will get executed. That means market order gets executed immediately. Now second one is limit order. Now look carefully, limit. Now buy at a preferred price. Okay. Currently Reliance is trading at 2055. And now let us assume that, so in the original example, now let us assume that currently Reliance is trading at 110. Okay, this is the order book from the buyer's point of view. Now let us assume now I want to buy cheaper. Now I place an order. I place an order that I want to buy Reliance at a price, my name is D, at a price equal to 70 rupees. Now the moment you put this, if during the day Reliance touches 70, your order will get executed. If it does not touch a value of 70, then your order may remain unexecuted, or there could be a possibility of partial execution as well. Now limit order. Buy the share at your preferred price. Currently the price is 110 and I place an order for 70 rupees. I want to buy Reliance at 70 rupees. And how many quantity? I want to buy 1 lakh quantity, let us assume. Now first, during the day it should reach at this price. If it is not reaching this price, your order will remain unexecuted. There is no seller, so order may remain unexecuted. Okay, it reaches 50, but seller wants to sell only 2 units. So then in this case it is partially executed. You will be getting only 2 quantity. Now seller is ready, sellers are willing to sell 1,50,000. Now in this case your order will completely executed. Now what is the problem with limit order? Now for example, this is a very good news with respect to Reliance. A very good news with respect to Reliance that, for example, Reliance is becoming debt free. Okay, now if it is a good news, at that time there is a buying pressure. We suggest you go with the market order. At whatever the price the sellers are willing to sell, buy the share. But now if you think that, yes, during the day you think that the prices may decline, then we suggest you go with the limit order. But the problem with the limit order is they may remain unexecuted, or there is the possibility of partial execution as well. Whereas in case of market order, your order will 100% get executed, that too within fraction of seconds. Now in the market you can place 2 types of order execution. 2 types. One, limit. Second, market. Now limit can further be divided into Now limit can further be divided into 4 parts: behind the market, make a new market, and take the market. Now first I'm explaining this from the point of view of buyer. So this is the order book as of now. Okay, so this is the order book. Now if this is the order book, now my point is, now only this particular row is important. For bifurcation, for further categorization, only the first row is important. Now if I look at the first row very carefully, in the market, best buyer is currently offering 100 rupees and he is willing to buy 50 quantity. And in the market, best seller is X, willing to sell at 110, and how many quantities? That is 10. So now from the point of view of buyer, now my point is, there is a new buyer, that is J. Now if J places an order that I want to buy Reliance 10 quantity, or I want to buy Reliance 12 quantity at a price of, so this is the reference point, this 100 and 110, this is the reference point. Okay, I want to buy 12 quantity at a price of 100. Now I put up the same price as the best buyer. Now my first point, will my order get executed? Answer is no. Your order will not get executed because seller is willing to sell at 110. Order will not get executed. But now I become the best buyer along with A. Now to whom we are going to give preference, this we'll discuss eventually. But now I become the best buyer along with A. Okay. So now if you become the best buyer along with A, with the existing best buyer, this is known as make a market. Okay, that means make a market is a price. When you are going to make a market, when you are putting a price exactly equal to the best buyer, existing best buyer in the market. That is, if you put up a price equal to 100, then that is make a market. Now if you put up any price less than 100, this is going to be behind the market. Since your order is not executing, you are not the best buyer behind the market. Okay. And next one is, now I'm ignoring the fractions. Next point is, if I place a value, I want to buy at a price 101 to 109. 101 to 109. My first point. Will my order get executed? No, my order will not get executed because X wants to sell at 110. But no doubt now I am alone the best buyer in the market. Now if you are a new best buyer, then this is a make a new market. So make a market along with A, J is best buyer. Now 101 to 109, J becomes the new best buyer. And now if I put up a price at a price 110 or greater than that, now if I put up a price 110, now my point is, will my order get executed? Answer is yes, my order get executed. So now if your order get executed, now this may be partially. Why partially? Because X willing to sell 10, I want to buy 12 quantity. So now only 10 quantities will get executed. Now if I put up a price equal to 110, my order will get executed. My order will get executed and this will be known as take the market. So take the market, when it will happen? When your order will get executed. will execute. Could be possible that your order will get only partially execute, but the moment if your order will get execute, it will be termed as take the market. Now limit orders can be of 4 types: behind the market, make a new market, and take the market. For this categorization, for this division, only these prices are important. Only these prices are important. Now let's prepare a table. Now let's prepare a table. If a buyer places an order at price exactly equal to 100, which is of the best buyer, which is coinciding with A, then you would be termed as make a market. Less than 100, behind the market. Okay, 101 to 109, your order will not get executed, but now you are the only best buyer. Make a new market. And finally, if you're placing an order at 110, this will be take the market. So now this was from the point of view of buyer. Okay, now let's understand from the point of view of seller. So from the point of view of seller, everything will remain the same. Okay, now my point is, who is the best seller in the market? Now best seller in the market is X. Now let us assume there is a new seller, that is P. Now P places an order exactly equal to 110. Now P is becoming along with X the best seller in the market. It will be termed as, now if a seller places an order exactly at equal to 110, now he is becoming a best seller along with X. That will be termed as make a market from the point of view of seller. Okay, now my point is, I want to sell at any value greater than 110. This will be termed as behind the market. Okay, I want to sell at any value 101 to 109. This will be termed as make a new market. My order will not get executed because A wants to buy at 100 only. And if I place a price exactly equal to 100, it will be termed as take the market. So one from the point of view of the buyers and one from the point of view of sellers. And to divide this into 4 parts, only row number 1 is important. Okay, so now before I proceed further, let's conclude. So Indian Stock Exchange works upon order matching principle. Order matching principle means as the prices get matched, now your order will gets on executing. In the market, the best buyer is the one who is offering the highest price. In the market, the best seller is who is selling the share at lowest price. Okay, now you can place 2 types of order. Market order, these execution orders can be of 2 types. One market, one limit. Market order gets executed within fraction of seconds. Limit order. Now limit order may be executed, may remain unexecuted, partially executed, or fully executed. Now you can place 4 types of orders within limit. Now behind the market, make a new market, behind the market, make a market, make a new market, and take the market. So now from the point of view of buyer, if I put up a price exactly equal to 100, make a market. Price 101 to 109, no quantity will get executed, but now I'm the best buyer, I'm the new best buyer. You are making a new market. Price exactly equal to 110, take the market. If you're putting a price less than 100, this is known as behind the market. Okay, now my point is this is the order book. Okay, so this is the existing order book of Reliance. Okay, and now my point is, I want to buy Reliance and I placed one quantity. I want to buy only one quantity, and by mistake I'm placing a limit order. And by mistake I press the price as 1 crore. Now, for example, so now I want to place a limit order. Now for Reliance, I want to place a limit order, and by mistake if I put up a price equal to 1 crore, now what will happen? Now look, watch very carefully. Now still it is showing 2049. Now still it is showing this price. Now my point is, if you by mistake, if you put up, you want to buy one quantity at 1 crore. Now exchanges are highly efficient. We want to protect unsophisticated investor. X is ready to sell at 110. By mistake you have put in the price equal to 1 crore. Now my point is, your order will get executed at, when seller is available to sell at 110, your order will get executed. Your order will get executed at 110. Now point to be noted, the moment you places an order, and assume that you are a buyer, you have places an order with very high price. Now we will match with this with the seller and the price at which sellers are ready to sell. Now lowest of the two, buyer willing to buy at 1 crore, seller willing to sell at 110. Now lowest of two, at this price order will get executed. So in this manner we are protecting a unsophisticated investor. Same wise. Now Reliance is trading at 110, it's trading at 100, and I am having one quantity and I want to sell. So I want to place a limit order. I place one quantity, and by mistake I put up a price equal to 0. Now I am a seller, and by mistake I put up a price equal to 0. Now you have placed a new order. Now in the markets we are going to protect unsophisticated buyers and sellers both. Investors, we are going to protect unsophisticated investors. Now my point is, buyer willing to buy at 100, sellers willing to sell at 0. Buyers willing to buy at 100, sellers willing to sell at 0. Now we want to protect, new order has been placed by a seller. Now we want to protect the seller in this case. So if we want to protect the seller, maximum of the two. Now maximum of the two is 100. Order will get executed at 100. So now point to be noted, if you are a buyer, by mistake you have put in a high price. So whatever the seller is, minimum of that will be executed. Same wise, you are a seller, by mistake you have put in a price equal to 0. Now maximum of 0 and the buyer's price. Your order will get executed at that particular price. So we are here to protect the unsophisticated. Investors. Now my point is now important. Now there is a new person. There's a new person, that is S. And now S places an order for sell, and S says, I want to sell 130 quantity at a price equal to 85. Now class, this is an important one. Okay. Now seller places an order, I want to sell 130 quantity at a price of 85. So in this case, new order has been by the seller. We want to protect the seller. Okay. A wants to buy at 100. S places an order at 85. Now order will get executed. How many quantity? Now 50 quantity will get executed. 130, 50, whichever is lower. So 50 quantity will get executed at what price? Now 50 quantity will get executed at a price of 100. We want to protect the seller. Now 70 quantity will get executed 90 or 85, whichever is higher. whichever is high. 90 quantity will get 70 quantity will get executed at a price equal to 90. Now we are left with 10 quantity. C wants to buy at 80. C wants to buy at 80. S wants to sell at 85. Buy 80, sell 85. This order will get executed? Answer is no. That means now what is the revised order book? Now revised order book will be like, now the new seller is S. Out of 130, 120 order has been executed. We are left with 10 quantity, and 10 quantities he is willing to sell at 85. Now again, to execute the order, C should increase the price or S should reduce the price for order to get executed. Now in the question, what is testable? So if you place a order like this, then at what price, what is the average price at which selling happen? Now S in totality has sell 120 units, 50 units as a price of 100 each. That means he get in totality 5,000. Here it is getting 6,300. Now collectively how much you have get? 11,300. Now 11,300 divided by 120. So answer is going to be 94.167. So point to be noted. If you are a buyer, if you put up a very high price, then your order will get executed at the price at which sellers are willing to sell. So now there would not be any sort of loss. Same wise, if you are a seller, you put up a price equal to 0, your order will get executed at whatever the price buyers are willing to buy. It has to be within that range. Buyers are willing to buy, and again to protect the losses. So markets are highly efficient. Okay, so now let's conclude. In our country, exchange system is based upon order matching principle. Prices, as the prices of the buyer and seller matches, order will get executed. Buyer wants to sell 50, buyer wants to buy 50, seller wants to sell 70. Now how many quantity will get executed? 50. And as the prices will keep on matching, this process will keep on continuing. Okay, you can place two orders. Execution can be of two types: limit, market. Market order will get executed immediately within fraction of seconds. Limit, there can be of four types: take the market, make a new market, make a market, behind the market. If you place an order exactly equal to 100, make a market. Greater than, now less than 100, behind the market. 101 till 109, make a new market. And exactly at 110, that means you're taking the market. Now by mistakes, if you put up a very high, buying at a very high price, so at whatever the price sellers are available, you will buy the share at that price. Same ways, as a seller, if you put up a very low price by mistake, no problem, at whatever the price buyers are available within that range. Now greater than 85, now greater than 85 A and B, your order will get executed at this respective prices to protect the seller. Okay, now I'm proceeding further. So this was first category, that was, now again I'm repeating. So first we have covered the meaning of order driven. Then execution can be of two types: market, limit. That means LOS H we have covered. Now I'm coming to validity instructions, validity orders. Now on the basis of validity, so now on the basis of validity, there could be n number of order. For example, first one is day order. So it has a validity of a single day. Now for example, today Reliance is trading at 2056, and I places an order that I want to buy Reliance at 2000. Now during this entire day, Reliance has not touched 2000. Now if Reliance during entire day is not touching 2000, your order will get unexecuted. And now day order, this order has a validity of a single day, and the moment this day is over, your order will get expired or your order will get cancelled at the end of day. So validity is of single day. Then second validity is good till cancelled. Now this order will remain in the system, until it get executed, or you yourself going to cancel it. Now for example, I place an order buy one quantity of Reliance at a price equal to 2000. Now assume that during the entire day Reliance has not touched 2000. Okay, this order is still in the system. Now tomorrow also Reliance didn't touch 2000, remains in the system. Now it will remain in the system until it get executed, or you yourself going to cancel it. Now what is the disadvantage of this good till cancelled order? Okay, now for example, now I place an order, I want to buy Reliance at a price equal to a very low price. Let us assume at a price equal to 1800. Okay, or at a price equal to 1950. I place a buy order. Okay, the moment I place a buy order, if I go to my order book, if I place an order, now what will happen? This 1950, this amount has been blocked. Okay, so now I have placed an order. Now placed an order at a very low price. Now if you think that it is not going to reach that level, now what is the drawback? It will remain in the system. Till infinity, until it get executed. But the drawback is, correspondingly, your 2000 or 1950 rupees has been blocked. So good till cancel, it will remain in this it will remain in the system until it get executed, or it is cancelled by the until it will get executed, or it is cancelled by the investor. Good till cancelled order. Now under validity, third order is immediate or cancel. So now this kind of orders, they can either get fully executed, partially executed, or unexecuted. Now for example, I place a immediate or cancel order with execution as market. So now if execution is at market price, then it will going to get fully executed. Now immediate or cancel, for example, now I place a limit order, immediate or cancel, and this is the order book, and I place an order that I want to buy 15 quantity at a price equal to 110. So now in this case, how many quantities will get executed? 10 quantities will get executed, 5 will remain unexecuted, and order will get cancelled. So the moment there's a partial execution, now for remaining, it is going to remain cancelled. Same wise, if I put up a price equal to 109, so if I put up an order immediate or cancel, now there is no execution, and the moment there is no execution, this order will get cancelled. So name is immediate or cancel. There could be 3 types of execution: fully execution, partial execution, or no execution. Fully would be in case of market orders, and partial and unexecuted will be in case of limit order. So either fully execute, partially execute, or they're going to remain cancelled. So immediate or cancelled. The moment you place it, if the order is not executed, it will get cancelled. Day order has a validity of a single day. They will remain in the system for a day. They will remain in the system till infinity. And if they're not immediately executed, they will get cancelled. Now, fourth one is good on close orders. You're good on open orders. Now, for example, yesterday when the market closed, post that there's a quarterly result by SBI, and the results are very fantastic, quarterly results, and where SBI has shown a very good profitability. Now tomorrow the moment it is going to be open in the stock market, there's going to be a buying pressure. Everyone will keep on buying the SBI. Now we can place an order good on open order. Now what is the meaning of this? So typically they are market ones. They are market order with execution as market. Now the moment at whatever the price tomorrow when the market open up 9:15, whatever the price in the market is, the sellers are willing to sell, your order will get executed. Now good on open order. This order will get activated the moment tomorrow markets open up. Okay, so now these are the validity instructions. Validity, day order, good till cancelled, immediate or cancel, good on open order. Now my point is, there is one more type of validity instruction. Next order is stop loss. So important. Now stop loss can be of two types. Stop loss buy order, stop loss sell order. Now for example, I'm having one share that is ITC and I'm already having the ownership, and now share is continuously falling in the market. Okay, now to limit my losses, I'm going to place a stop loss sell order. Point to be noted, I'm already having the share. If you're already having the share, you're incurring losses. To stop that losses from further extending, you're going to place stop loss sell order. Now here you have to provide a trigger price. First, you have to provide a trigger price. Now for example, currently ITC is trading at 200 and now you have to provide a price. The moment it breaches, it falls below 185. Now this is the trigger price. The moment it falls below 85, sell the share in the range of 180 to 185. Now how we place the order? For example, good till cancel, and now my trigger price is trigger 85, limit 80. Now what is the meaning of this? The moment ITC falls below 185, I want to liquidate the holding. At what price I want to liquidate? The range is 185. The range is 180 to 185. Now whosoever buyer is available in the market at this price, at this particular range, your order will get executed. Now this is stop loss sell order. When you place stop loss sell order, when already you are having an ownership and now want to limit the losses from the continuous fall in the share price, you have to provide a trigger price. The trigger price means the order get activated. The order will get activated the moment it breaches 185. And now if there's a buyer in the market within the range 180 to 185, your order will get executed. Now your order will get sell if there's a buyer within the range 180 to 185. Same wise, stop loss buy order. Okay. Now for example, I have short one share that is PVR. So I have short. Okay, short sell. And now my objective is that it should fall in the market. But now the share is continuously increasing. Now you want to limit your losses. Now you will place a stop loss buy order, that is GTC. Trigger. For example, right now, if it goes below, if the share like PVR goes above 1500, so trigger is at 1500, limit 1550. Now I want to buy the share and my buying price is whosoever seller is, my buying range is 1500 to 1550. Now we will search for the seller. If there are sellers at this particular range, your order will get executed. So now name is stop loss. The purpose of stop loss is to stop your losses from further increasing. Now if you already having in position, already you have buy the share, now you will place a stop loss sell order. Same wise, if you have short selling, you have already sell the share. Not to restrict the losses from the upward movement, you are going to place stop loss buy order. In this, you have to specify a trigger price, and the moment it breaches that trigger price, the moment it breaches this trigger price, the order will get executed. Now, I want to buy the share within this particular range, and if it is a sell, then I want to sell within this particular range. So these are basically to limit your losses. Now again, I just have a revision of the concepts which we have covered. Execution. Based upon execution, there can be two types of order: market, limit. Limit further bifurcated into 4 parts: take the market, new market, market, make a market, and last one was behind the market. Based upon validity, there can be a day order, good till, cancelled, then immediate or cancelled, that is IOC, then good on open orders, good on open order, and last one is stop loss. Purpose of stop loss is to limit the losses from further increasing. Okay, so now again I'm coming back. Compare execution and validity instructions. Compare market order with limit order. Now I'm coming to what you mean by code driven, order driven, and brokered market. Okay, now there are 3 types of market. 1, order driven. 2, code driven. And last one is brokered market. Now, code driven is also known as dealer market. Okay. Now first I'm starting with order driven market. Now Indian stock exchanges are an order driven market where there is an order book. The moment price matches, the order will get executed. Okay. Now while placing order, which one is going to be given preference to? Okay. Now which order is going to be given preference to? Now for example, there are 2 buyers. Buyer A wants to buy at 100. Buyer B wants to buy at 90. To whom you are going to give preference? First preference would always be given to prices. So first preference. Now first preference will be given to prices. Now who is the best buyer? In this case, best buyer is A. So preference would be given to A. Okay. Now let us assume that there are 3 buyers. A wants to buy at 100. B wants to buy at 90. C wants to buy at 100. And there's one more buyer, D, that wants to buy at 100. Now my point is, now price of A, C and D are exactly same. Now to whom you're going to give preference? Now second is, that is the display quantity. Now out of this buyer, who has displayed the quantity? Now when you're placing an order, specifically when you're placing a large order, so this we have to discuss eventually. Okay, so when you are placing an order, you have the option to display the quantity, or place an hidden order. The meaning of hidden order is that means you have not disclosed the quantity. Now for example, if I want to buy a stock like HUL, Hindustan Unilever, and I want to buy 50 lakh quantity. Now if 50 lakh quantity, if it has been disclosed in the market, then there's going to be a buying pressure. So to avoid that buying pressure, we typically placed a hidden order. Now these hidden orders are placed with the help of brokers. Okay, so this I have to eventually discuss. So now if you want to buy a large quantity, in this particular case, you may place a hidden order. Now second is whether you have displayed the quantity or your quantity is hidden. Now we will give preference to those buyers whose quantities has been disclosed. Okay, now let us assume that A places where the quantities is displayed, and it is an hidden order. Now in the race there is A and C. Okay. Now third, we are going to give preference to the timing. Now whosoever has placed the order earlier, that order will get executed first. So under the order driven market, first preference would always be given to price. Second, whether you have displayed the quantity or you have placed an hidden order, preference would be given to those buyers who have displayed the quantity. And third preference would be given to the timing. Whosoever has placed the order earlier will get, that person order will get executed first. So now first price, second display quantity, third that is going to be the timings. Okay. Now we have to understand how the Indian stock markets operates. So what are the timings of Indian stock market? So now Indian stock market opens up at 9 till 4 o'clock. Okay. But now it is divided into three parts. 9 to 9:15 is known as open session, pre-open session. 9:15 to 3:30, that is a regular trading session. And 3:30 to 4 o'clock is known as closing session. Okay. So point to be noted. Market opens at 9 o'clock till 4. It is divided into three parts. 9 to 9:15, that is pre-open session. 9:15 to 3:30, that is regular trading session. And 3:30 to 4, that is the closing session. Okay. Now market activity, that means buying and selling. You can buy and sell share only during this particular time frame, that is 9:15 to 3:30. Now my point is, then what is the significance of this pre-open and closing session? Okay, now pre-open. Now my point is, suppose today Reliance closes at, so today the closing price is of Reliance is equal to 2100. Okay. Now point is, tomorrow when it opens in the stock market, open price of next day, is it equal to closing price of previous day in case of stock market? So open price of next day, is it equal to closing price of previous day? So answer is no. Answer is no. Next question. In case of stock market, last traded price of the stock, is it equal to closing price of the stock for the day? So answer to this question is also, answer is no. Now let's understand how we determine the open price of any stock. Now there's a complete new mechanism to determine the open price of the stock, and that mechanism is known as call market, and it is based upon the principle of uniform pricing. Okay, so now let us understand that now during 9 to 9:15, that is known as pre-open session. During this particular phase, no trading activity, there is going to be no trading activity, but you can place only the orders. That means in the markets, we can place order 9 to 9:15. Now during this phase, when you are placing an order, a new order book for each and every stock is going to be created. Now this is new order book for Reliance. Now again, we are going to sort in the descending and the ascending order. Now buyers. buyers will be sorted as per the descending order. Now let us assume there's a buyer A, B, C. A wants to buy 10 quantity, 70 quantity and 5 quantity. Price, he wants to buy at 100, 90 and 80. Okay, so this is the buyers. Now next day buyer placed their order from 9 to 9:15 and there are 3 buyers in totality. A wants to buy 10 quantity at 100, B wants to buy 70 quantity at 90 and C wants to buy 5 quantity at 80. Same wise, there are sellers. Now X, Y, Z, this is quantity and price. Now X wants to sell at 80, 2 unit, 90, 30, 90, 50 units, sorry, 2 quantity at a price of 80, 35 quantity or 60 quantity at a price of 90 and 3 quantity at a price of 100. So these are the buyers and the seller. Okay. Now my point is A wants to buy 10 quantity at a price of 100. Okay, 10 quantity at a price of 100. Now my point is if to a buyer like A, we offer the share at a price equal to 90. We offer the share at a price equal to 90. Will he buy? Yes or no? The answer is yes. Now my point is, if in the market price is 90, then how many total buyers there are? The demand is for how many? Quantity. Now in totality, if the price is 90, then the demand is for 80 shares. Okay. And if the price is 80, then demand is for 85 shares in the market. Okay. So if price is 100, total demand 10, 90, total demand 80, 80, total demand is 85. Same wise, let's understand the supply side. Now my point is X wants to sell 2 quantity at a price of 80. But now if in the market the price is 90, will X will ready to liquidate? Answer is yes. So now my point is, if the price is 90, then in totality there are going to be how many sellers? There's supply for how many quantity? There's supply for 62 quantity. That is Y plus X. Same wise, if in the market prices are 100, then what is the total supply? Total supply is 65 and sellers are X, Y and Z. Okay. Now my point is, if prices are 100, then at this price, buyers are willing to buy 10, sellers willing to sell 65. How many quantities will get executed? Execution will be 10. Buyers willing to buy 80 quantity, sellers willing to sell 62 at a price equal to 90. How many quantity will execute? That is 62. And third, at a price equal to 80, sellers willing to sell 2 units, whereas buyer willing to buy 85. How many quantity will get executed? Only 2. Now my point is, at what price the maximum quantities are being executed? So maximum quantities will be executed here. Now this is going to be the open price of Reliance, and the moment there's 9:15, 1 second, Reliance will open at 90 rupees, and how many quantities will get executed? 62 quantities are going to be executed. Now this is the mechanism through which we are going to find out the open price of any stock, that is known as call market. And call market is based upon the principle of uniform pricing. The moment stock market open up, the Reliance price is going to be 90, and how many quantities will get executed? 62 quantities are going to be executed. This is the way we determine the open price of any stock, and it has no link with respect to the previous year closing. Now my point is, this is the way to determine the open price. Now once the stock is open, once the market is open, now the entire day trading will keep on going on. So this trading will keep on going on as per the order matching principle, as we discussed. Right? It is upon order matching principle. That means based upon demand and supply. Now this is known as continuous market. Now this is known as continuous market. Continuous market means based upon demand and supply, now the share prices are moving. The way to determine the open price, this is known as call market. And call market is based upon the principle of uniform pricing. The moment all the order will execute at a single price, that price is 90, and how many quantity will get executed? That is going to be 62 units. Okay. Now how to determine the closing price? Now what is LTP? Last traded price. Now the moment 3:30, the moment there's 3:30 in the clock, stock market closes. So whatever the trade, but at whatever the price the last trade happens, this is known as LTP, last traded price. So last traded price means this is more or less equal to the last execution which happened at 3:30. Now let us assume that in case of Reliance, that price is 90 rupee. So now LTP is 90. Now how to compute the closing prices? So closing price in case of stock market, this is the average of last 30 minutes trade. Last 30 minutes trade. Now, for example, what is the last 30 minutes of trade? Now, whatever the trade happened between 3 to 3:30, we are going to compute weighted average price of that trade, and now all the derivative contracts. Now what is the meaning of derivative? This we are going to learn under the chapter derivative. Now all the derivative contracts will be settled at this particular price. So now important, how we compute the open price of any stock? The price at which maximum quantities are going to be executed. Okay. So at this price, the share market will open, and post that, based upon auto matching, the market will keep on continuing. In case of stock market, the average price of last 30 minutes, that is known as the closing price, and the significance of this closing price is all the derivative contract outstanding will be settled at this price. Now meaning of derivative, this we are going to cover elaboratively under the reading derivatives. Okay, so now let's conclude. We started with order driven market. Order driven market are divided into three parts: pre-open session, regular session, closing session. Pre-open session, during this you can place the order and we are going to determine the open price. The open price is known as call market, and it is based upon the principle of uniform pricing. Post that, order matching principle will keep on continuing. Market is known as continuous market. And once the market is closed, during this phase, we are going to compute the closing price. That is an average of 3 to 3:30 trade, and whatever the closing price is, all the derivative contract will be settled on that particular price. Okay. Now my point is, this was with respect to order driven market. Now quote driven. Quote driven is also known as dealer market. Now my point is, how a company like HUL works. Now, for example, there is a washing powder, and washing powder, the MRP is the MRP is 120. So now how this company earns money, what is their business model? First, so I'm preparing a very simple business model. Okay, now first HUL will sell this good to a retailer, and retailer will eventually sell this good to a consumer. Okay, so now my point is, when retailer is buying a good having a MRP of 120, so how much money he makes to HUL? Equal to 120, less than 120, greater than 120. Now important, retailer will eventually sell this goods to consumer at a price of 120. Now when he is buying from HUL, how much money he is going to pay? So he is going to pay any value less than 120. Now let us assume that he is paying 100 rupee. And in this particular way, how much dealer has earned? In this particular way, retailer has earned a profit of 20. Important. HUL sell the goods. The good was having a MRP of 120, a face value of 120, but it has been sold for 100. And now retailer will eventually sell this to consumer and at 120. In this way, retailer earned a profit of 20 rupees. Correct. Now my point is, in this entire transaction, at what time retailer has to make this payment of 100 rupees? Now a company like HUL, which is the market leader in the FMCG business. So a company like HUL, does they offer credit period? Answer is no. The moment you're going to buy the goods, you have to make the payments. That means retailer is going to make this 100 rupees payment at time 0. He will buy the goods and eventually will sell the goods to a consumer. And in this way, he will make a profit of 20. And from the HUL point of view, HUL have a sale of 100 and upfront HUL has received 100 rupee. Now same way works the quote-driven market. Now quote-driven market is also known as dealer market. Now for example, this market is only in case of debt products. So this is not in case of equity product. Okay. Now let us assume there's a company, Bajaj Finance, and now Bajaj Finance wants to sell commercial paper, wants to raise money with the help of commercial paper, and that commercial paper has a face value of 1000 crore. Now if you want to raise money, now Bajaj Finance will go to an investment bank first. Investment bank, let us assume that is JP Morgan. Now Bajaj Finance will go to JP Morgan first, that is an investment bank, and Bajaj says that I want to raise money with the help of commercial paper. That commercial paper has a face value of 1000 crore, and over that I'm going to pay an interest of 10%. Now what JP Morgan will, how the JP Morgan will proceed with this transaction? Now JP Morgan will purchase this entire lot, commercial paper with a face value with a MRP of 1000 crore, and make a upfront payment to Bajaj Finance. Now let us assume that upfront payment is 950 crore. Now investment bank purchases commercial paper with a face value of 1000 crore and upfront makes a payment of 950 crore to Bajaj Finance. Now it is the responsibility of JP Morgan now to find investor for this commercial paper. Now, for example, JP Morgan sells this commercial paper further to HDFC Bank and Kotak Bank. HDFC Bank, Kotak Bank, valuing 500 crore each. Now my point is, in this entire transaction, how much money investment bank makes? So now it is buying commercial paper at 950, selling at 1000. In this way, in this entire transaction, investment bank makes a profit of 50 crore. So 50 crore is the profit of investment bank. What is the best part from the point of view of Bajaj? Bajaj will get 950 crore up front. And what will HDFC and Kotak will earn? They will earn an interest of 10% over the period. 10% of what value? 10% of 1000 crore. Now this is known as quote driven or dealer market. Now point to be noted. In the quote driven market, double star, dealer provides liquidity. Dealer provides liquidity to the market. Now they are providing liquidity. They are making payment of 950 crore to Bajaj upfront, and now they have to search for the investor for this commercial paper. Now by selling it for 1000 crore in this transaction, they are going to make a profit of 50 crore. So this is quote driven market. And last market is brokered market. Now brokered. Now what is the role of brokered market? So in this, they are going to be a broker. Now my point is, suppose there's a company. The company name is HDFC Life. Okay, the company is in the business of life insurance and HDFC Life, and one stake is with Standard Chartered. Okay, now let us assume that Standard Chartered is having 20% stake in the company, and now they want to liquidate 10% stake in the company. They want to sell their 10% stake in the HDFC Life company. Now my point is, if you want to sell 10% of your stake, and today if a company like Standard Chartered put an order for 10% of the company value as sell order, it will create a selling pressure on the stock. Now let us assume in totality they want to place an order for, they want to place an order for 10 crore shares. Now if they want to place an order for 10 crore shares, it will bring a selling pressure in the market. Possibility that share will badly fall in the market. Now to avoid that, if you want to place such a large order, now such large orders are placed with the help of broker. Now again, let us assume that in this case investment bank is JP Morgan again. Now what is the role of broker? Now first Standard Chartered will say to the broker that I want to sell 10 crore shares. Now broker will search for the buyers. Now for example, the buyer is A, B and C. A ready to buy 7 crore share, B ready to buy 2 crore share, C ready to buy 1 crore share. So first broker will have to find the buyers for these shares. So he will find the buyers, and now on an agreed date, Standard Chartered will place a sell order, and these buyers will place a buy order. And in this entire transaction, what broker will earn, that is going to be the commission. So now you are finding the buyer for mistake. Now these deals are done with the help of the broker, and eventually broker will earn commission over these transactions. Now point to be noted, if you want to sell large shares or you want to buy large shares, then such large orders will only be executed with the help of broker. So now let's go through one of the news articles. Standard HDFC Life standard share sale. So now there's a news that Standard Life to sell 27.8 million shares of HDFC Life. Now if this is such a block deal, if such a huge number of shares you have to sell, then this is going to be with the help of a broker. Okay, why with the help of a broker? Because so that to avoid the sudden fall in the share prices. So now my point is, we understand there are three kinds of the markets: order driven, then dealer market. Dealer provides liquidity, and dealer market is used in case of debt product, order driven market in case of equity product, and last one is brokered. So what is the best part with the broker? They help in executing large orders. Large orders in equity segment. So these are the three markets. So friends, these are the three markets. And now within order driven, there is one more product. Now order driven, one example is exchanges. Exchanges like NSE, BSE, and now their alternative trading system as well. Alternative trading system as well. Now what is the meaning of ATS? So I don't think that any ATS prevails in the country, but they do prevail in US. Okay, now what is the meaning of ATS? Now the exchanges are highly regulated. So they're highly regulated by SEBI since retail investors are involved. Now over the period, there have been new systems for the transaction, and so over exchange, they are highly regulated, and plus this, eventually we have to learn that when you are trading in the exchange, there is zero or no counterparty risk. No party can default because of clearing houses. So counterparty risk is equal to zero when you are working over the exchanges, but they are highly regulated. Highly regulated. Now what happened during the period? Now people have developed a new trading system where the limited number of buyers and sellers are there, and now they are performing the trading activity. This is known as alternative trading system. So what is the reason of having the alternative trading system? They are less regulated, number one. Okay, and in this they are also known as dark pools. So why they are known as dark pools? Because in this system, whosoever is placing the order, buy or sell order, by default, since they are going to be large transactions, they are going to be the hidden orders. So now within order driven, there are exchanges like NSE, BSE, which are highly regulated. Counterparty risk is zero, and there are standardized contract. Standardized means everything goes with what has been decided by SEBI. So in India, the settlement system is T+2. So if you buy the share, you will become the owner within next 2 days. You have to make the payment. So everything is standardized. Make the payment, become the owner within 2 days. But now if you want to enter into a customized contract, now two persons want to enter into a customized contract. This is possible over ATS. They are less regulated, and yes, they are also known as dark pools because all the orders which are placed in the ATS, they are more or less hidden orders where quantities are not being displayed. So that is why there have been a new system, that is alternative trading. So friends, with this, and now, one more point, and here how we determine the prices. So now, for example, there is going to be a large deal over HUL in the ATS. Mr. A wants to buy 50 lakh share and Mr. B wants to sell 50 lakh shares, but they want to have a transaction over ATS. But now, since there is no liquidity, how to determine the prices? So prices will be determined with the help of these markets, prices prevailing in these markets. So now this is known as, how we determine the price in case of ATS, that is known as derivative pricing tool. Why derivative pricing tool? Because they derive their prices. Now at what price the transaction should happen? So they derive their prices from other exchanges. So the pricing rule is known as derivative pricing. Okay, so friends, with this we have covered LOS G, compare execution validity instructions, compare market order with limit order, described what you mean by code driven, order driven and brokered market. Okay, now I'm moving to LOS I. What do you mean by primary market, secondary market, and how secondary market supports primary market? So now with respect to equity shares, there are two markets, LOSI. One is primary and second is secondary market. Now what is the meaning of primary? Where company is directly involved in selling of the shares. Now for example, one example of the primary market transactions. Now for example is a company Indigo Paints, and now the company promoters wants to liquidate their existing holding, and now company is coming up with an initial public offer, IPO. What is the meaning of IPO? Now here promoters, the owner of the company, will liquidate their holding, will sell their holding, and in return they will be getting the money. So initial public offer, where company is directly involved in selling of the transactions, this is known as primary market transaction. Now one of the primary market transaction is IPO, where shares are liquidated by the promoters and shares are sold to the clients, like they are both the institutional clients and the retail public as well. So they sell both to the anchor, both to the institutionals and to the retail clients. Next one is right offering, a right issue. Now what is the meaning of right offering or right share? Now right offering means where company is selling, now company wants more capital. Okay, for example, they want to repay their debt, now they want more capital. Now they want to raise new capital. So first right would be given to existing shareholders. So now for example, recently there's a company like Reliance, they have come up with a right issue. So what is the meaning of right issue? Company raised new capital. That new capital has been raised from existing shareholder. Now let us assume that in the market Reliance is trading at 1400. Will right issue will come at a price greater than 1400 or less than 1400? This is the shares which are offered to existing shareholders. So now if they want the benefit to be accrued to the existing shareholders, right issue will always come at a price less than the current market price. So right issue, where company is selling shares to existing shareholder. Now there is one more way, that is QIP, qualified institutional placement. Now there's a company Bajaj Finance, recently they issued shares. Now there are two ways. One, to raise money with the help of public. Second is that you want to raise money with the help of institutional clients. Now for example, Bajaj wants to issue shares, and now they want to issue shares directly to institutional clients such as SBI Mutual Fund and HDFC Mutual Fund. Now these transactions are known as QIP. Again, QIP will come at a discount to the current market price. So these are the three prime market transactions. One, with the help of IPO, second, right offering, and third, QIP. So now let's go through one of the articles. Now recently Reliance 53,124 right issue was India's largest ever right issue. That means and it was also the world's largest right issue by a non-financial institution in the last 10 years. So recently they have raised money with the help of right issues. That means money has been raised from existing shareholders. So if I go through this article, now why they are raising money? To make the company debt free. Okay. Now right share will be priced at 1257 per share, and for every 15 shares you are having, one share will be allocated. Now eligible shareholders are allowed to subscribe for one share for every 15 shares. Now this is the date. Okay, and now every share you will bid, it will be available at a discounted rate of it now. However, it is not necessary for shareholder to exercise their rights. So now this is your right. If you want, you can. If you want to ignore, then again this is the complete right with the shareholder. Okay, now okay, so this was with respect to right issue. And now QIP. So now Bajaj has raised 8500 crore, and now so this is a qualified institutional investors. And now who are the investors? BlackRock, Nomura, GIC of Singapore. So they are basically the investors who invested in Bajaj Finance share. Okay, so this is a QIP. Same wise, the issue was at a price of itna per share, a discount of 6% on Monday's closing price. Same wise, Indigo Paints IPO. So this was the one of the IPOs in the country. So how many offered for sale? So promoters are liquidating this much of shares. Their earlier holding is 60%. Post issue, it will reduce to 54%. Okay. Now, primary market transactions. So in the primary market, there are going to be 3 transactions. IPO. Second one is your QIP, and third one was right issue. Okay. Now, whenever the company wants to issue shares, they need the help of investment bank. Now, for example, you're coming up with an IPO. Now, you need the service from investment bank. Now, again, investment bank is, let us assume, JP Morgan, and the company name is Indigo Paints IPO. Okay. Now, investment bank can provide 2 types of services. Number 1, underwritten or underwriting services, and second one is best efforts. Now, in this case, company wants to liquidate how many shares? So these much shares are offered for sale. So let's put up that company wants to sell 100 shares. Now, if you want to sell 100 shares, there should be the buyer for these 100 shares. Now, you need the help of investment bank. Now, Indigo Paints will approach JP Morgan, and now JP Morgan will have to find buyers for these 100 shares. Now, my point is, let us assume that we receive application only for 90 shares. So you want to sell 100 shares, but we receive application only for 90 shares. That means it is an undersubscribed IPO. Now, if it is an undersubscribed IPO, remaining quantity has to be purchased by the investment bank. So in this case, if you're providing an underwriting service, what is the meaning of underwriting? If we are unable to find the buyers for 100 shares, whatever the leftover is, that leftover is going to be purchased by investment bank. Underwriting service. Now, best efforts. What is the meaning of best efforts? First, assume that this company is not in great demand, or the company is not performing well. There are high chances that the IPO may remain undersubscribed. Now, to avoid the significant losses, what investment bank can do? They need not to always provide the underwriting service. They can also find for the buyers based upon best efforts. Now, what is the meaning of best efforts? The meaning of best efforts is company saying, we will try our level best to find the buyers. Now, let us assume that we are able to find only buyers for 70 shares. Now, pay our commission on 70. We are not going to buy the remaining 30. Now, investment bank can provide 2 types of services. Number 1, underwriting. Second, best efforts. Under best efforts, whosoever the buyer, now for example, we are able to sell only 70 quantity. Pay our commission on 70. On this 70 only, we are not going to buy remaining 30. Underwriting, if there is any leftover, that leftover has to be purchased by the investment bank. Now, one more word, within this. That is one more word that is deals with IPO, that is a book building process. So again, more word. Now what is the meaning of book building? So okay, now the issue type is book built issue IPO. Okay, this is book built, and the price is, IPO price is 1488 to 1490. This is the IPO price, and let us assume that company wants to liquidate 100 shares. Now what is the meaning of book building process? So when an IPO opens up, now investors will have to bid. Okay, now investors will have to bid. Now let us assume that for the sake of simplicity, there are 4 bidders: A, B, C, D, quantity, price. Now we are ready to offer the share at this particular price range. This has been decided by the company and the investment bank. Now investor, you tell at what price you are willing to buy this quantity. So from the company has decided this particular range. Now let us assume that A says I want to buy 100 at a price of 1488. Sorry, not 100. 20 at 1488. 30 at 1489. 55 at 1489.5, and 20 at 190. Okay, now we have to decide such a price that the subscription is 100%. Okay, now first, who is the best buyer? So always the best buyer is who is offering the highest price. So now the best buyer in this case is D, ready to buy 20 quantity at a price of 1490. Now point is IPO is subscribed only 20%. We want subscription should be 100. Okay. Now who is the next buyer? Next buyer is C. So now point is, if the price is 1489.5, collectively there's a demand for 75 shares, and C and D are ready to buy. Okay. Now if the price is 1489, what is the total demand? Now total demand is 105. And the buyers are B, C, D. Now how we will decide? Now first of all, no shares are being allocated to A. And now the company has decided that the IPO price is going to be 1489. At this price, the total demand is 105, and company wants to allocate 100 shares. Now there could be number of ways in which this allocation can be made. For example, number one way is going to be random. Now randomly we are going to decide how much share to be allocated to B, C, D, random. Second is going to be, random is also known as lottery system. Second way is pro rata. Now in totality demand is 105, supply is 100 shares. Now for demand of one, we are going to allocate this much share. That means whosoever has demanded 21, we are going to allocate 20 shares. So this is a pro rata system. One way is lottery, randomly you're deciding. Second is on the pro rata basis. Now on this pro rata basis, we are going to allocate shares to B, C, D, and point to be noted at what price IPO will come, that is 1489. Now this is known as indication of interest. That means at what price you are ready to buy the stake. Now IPO will come at 1489 at a price. IPO will come at 1489, and at this price share will be allocated to B, C, D. Now point to be noted, This entire process is known as book building process. Now, what do you mean by secondary market now? Now, secondary. The meaning of secondary is, now you and me are buying the shares of Reliance over the exchanges. Now these shares have already been issued, and now there's only now the investors are changing continuously. This has been issued by the company way back. Now whatever the transactions that we are performing, that is on the secondary market. So whatever the shares that we are buying on NSE, BSE, they are nothing but a secondary market. Now my point is, for primary transaction to be successful, for example, if you want your IPO to be successful, liquidity in secondary market, your secondary market should be highly liquid or there should be illiquidity. Now, if your secondary markets are highly liquid, then it becomes easy for the companies to raise money with the help of IPOs. That means how important the secondary market is. Now, liquidity of secondary market plays a very important role in case of primary transactions. So friends, with this we have covered LOS G, H, I and J. Okay. Now I'm going to solve question number 12, 35 to 38, 40 to 46 and 63 to 68. In totality 80 practice problem I'm going to solve. Okay, now what you have to do, you have to pause the video, try your level best to solve this 18 practice problem, and then you're proceeding with the video. Okay, now practice problem 2. A trader places a limit order to buy shares at a price of 49.94, where in the market the bid price, that is the buying price, the best buyer is 49.49 and bid ask spread is 0.7%. Okay, so now currently in the market the best buyer is the one who has quoted 49.49. This is best buyer, and the difference between best buyer and best seller, that is 0.7%. So that means best seller willing to sell at 49.49 multiplied by 1 plus 0.7%. That means he is willing to sell at 0.7 divided by 100 plus 1 multiplied by 49.49. That is, he is willing to sell at 49.84. Now you places an order, and you places an order that I want to buy at 49.94. Now we have to protect the investor. Already seller is available at this particular price. You places an order for 49.94. Your order will executed at, now the order will be executed at, we want to protect you, will be so order will be executed at minimum of 2. Now order will execute at 49.84. Answer is B. Question number 12. Which of the following is most likely associated with secondary capital markets? Now B is incorrect. Underwriter is primary issue. Book building again primary issue. Answer is A. Now under order driven we have covered one thing, that is the continuous market. So now continuous market. Now opening value is determined, that is known as call market, and call market is based upon the principle of uniform pricing. Now whatever the trading is between 9:15 to 3:30, during that period it is known as continuous market. So which of the following associate with the secondary market? That is the continuous trading. Answer is A. Problem 35. You placed a sell market on open order, a market order that would automatically be submitted at markets when the market will open tomorrow and would fill at the market price. Your instruction to sell the share when tomorrow market will open. Now my point is, we have two types of instructions. One, execution. Within execution there was limit and market. Validity. Validity means when to fill the order. Now you have placed an order to fill the order tomorrow morning. Now my point is your instruction to sell the order at when the market will open tomorrow. This will be known as a validity instruction. So what is the meaning of validity? When to fill the order? Tomorrow morning. So this is a validity instruction. Okay. Next is 36. Okay. Now in this you have to find out what is the best buyer and the best seller. Okay. Now bid size means quantity that buyers want to buy, their prices. Offer size means quantities that seller wants to sell. Okay. Now in the market, who is the best buyer, who is willing to buy? So these are the buyers. Now in the market, who is the best buyer? The buyer is the one who is willing to pay the highest price. Now which buyer is ready to pay the highest price? And that is this buyer. Assume that this buyer is A. Now best buyer in the market is A, who is willing to buy 6 quantity at a price 9.95. Now in the market, who is the best seller, who is willing to sell at the lowest price? Now in the market, let us assume this is D. So the best seller is D, who is willing to sell 5 quantity at a price 10.02. What is the market? What is the market means? Who is the best buyer and seller? Answer is C. Then 37. Now this is the order book. A new buy limit order is placed for 300 at 123.40. The limit order is set to be okay. So now let's understand what is important for deciding. So only these 2 points are important. Okay. Now if I place an order exactly at 123.35, so this is going to be make the market. I have placed an order. So question number 37. So now if you place an order exactly at 123.35, this is make the order, make the market. Price is any value, that is 123.36 to 123.79. This is make a new market. 12380, that is take the market, and less than 123.80 behind the market. Now you have placed an order at 123.40. It is falling within this range. So answer is you have make a new market. Answer is C. 38. Currently the market in a stock is, this is the best buyer and seller. A new limit order, the new sell limit order is placed at this particular price. The limit order is set to be okay. 38. Now you are placing a sell order. So I want to create from the point of view of seller. Okay. Now if you put exactly at 54.71, if this is C, then this is make a market. Okay. Now you are willing to sell at 54.62 to 5, no, this is 3, okay, to itna. This is a make a new market. And if you are willing to sell at a price equal to 54.62, take the market. If you are willing to sell at a value greater than 54.71, that is behind the market. Now you have placed an order 54.62. 54.62 will fall here. That means answer is take the market. Answer is A. So 35th, answer is B. 36th answer is C. 37th answer is C. 38th answer is A. Next. 40 to 46. Okay. You own shares. That means you are already having the shares that are currently trading at 30. Your technical analysis, that means by looking at the chart, your technical analysis of the shares indicate a support of 27.50. That is, if the price of the shares is going down, it is most likely to stay above this particular level. So this is support. Now you're thinking that it is not going to breach $27.5. If the price does fall below this level, however, you believe that price may continue to decline. You have no immediate intent to sell the shares. Right now you don't want to sell, but you are concerned with the possibility of huge losses if the prices declines below the support level. Okay, now which type of order you are going to place? So point to be noted, you are already having the share. Now if you are already having the share, you want to stop your losses. You don't want to sell right now. You want to stop your losses. Now which order you will place? You will place a GTC, good till cancelled. Now a buy order, sell order, you are already having it. You want to protect yourself against huge losses. Now this is going to be good till cancel, stop loss, stop loss, sell order. So answer is B. 41. In an underwriting offering, if the entire issue may not be sold, that means undersubscribed, then it is going to be purchased by, this is going to be purchased by the investment bank. 42. Now you are offering the shares to qualified institutions, qualified investors. Which of the following describe the sale? So this is going to be a private placement. So QIP is also known as private placement. 43rd. Now here you are offering the existing shareholder the right to purchase 2 new shares for every 15 shares. This is an example of right issue. Answer is A. 44. Now which order will get the preference? Now point to be noted, we are talking from the point of view of sell. Okay, so now this is the consider a order driven system that allows hidden orders. There are 4 sell orders, and now to whom we are going to give preference to, which order will get executed first. Okay, first, that is the price. Now who is the best seller? The best seller is who is demanding the lowest price. Now the best sellers are 2, 3 and 4. Okay, now have you displayed your quantity which you want to sell? So in case of order number 2, the quantities are hidden. So now there's a clash between 3rd and 4th. Now I'm going to give preference to time. Now 3rd has been placed at 9:53 4 seconds and 4th has been placed at 9:53 49 seconds. So now based upon this, which order will get the preference? That is going to be order number 3. Earlier orders will execute first. Answer is C. Next, 45th. You have submitted a immediate or cancel buy order for 500 shares at a limit price of 74.25. Okay. So question number 45. Now you have placed a immediate or cancelled. You want to buy 500 shares at a price 74.25. There are 2 sell orders in the market. One 300 shares. So seller is 300 shares at a price 74.30, and second 400 shares at a price 74.35. So there are 2 sellers in the market. You want to buy at 74.25. It is an immediate or cancel, and sellers are willing to sell at 74.30, 74.35. Does order matches? Answer is no. So now how many quantity will get filled? So it is going to be unexecuted. 0 quantity will filled. Now you have to answer. How many shares would get cancelled? So this is going to be no fill. Now how many shares will get cancelled? 500 shares will get cancelled. So answer is A, B, C. Answer is C. Next, 46th. Now today a person submits a sell order 1000 shares at a price of 19.83. Okay, I want to sell. Okay, now you have to compute your average trade price. So point to be noted, we are always going to protect the, now whosoever is placing the order, in this case we are getting a sell order. So now we are going to protect the seller. Okay, 46th. So now what happened? You placed a sell order 1000 quantity sell order at a price 19.83. Okay, whereas the buyers are willing to buy at 20.02, 19.89 and 19.84. Buyers are willing to buy at this particular price. Now to protect the seller, maximum of 19.83 or these values, whatever the maximum value, the order will get executed. Now how many quantities you want to sell? You want to sell 1000 quantity. First order of Mary will get executed. Now you will sell the shares to Mary. How many? 300 quantity, and per share you commanded 20.02. Okay, now I'm left with 700 plus. Next you will sell this good to Anne. How many? 400. At what rate? That is 19.89. Now still you're left with 300. Now you will sell. Now you want to sell 300. Paul is demanding 200. You will sell 200 quantity at a rate 19.84. Now collectively you have sold how many units? Collectively you have sold 900 units. Now point to be noted, here this buyer wants to buy at 19.70, whereas the seller is demanding 19.83. This order will not execute until unless the seller declines reduce the prices or buyer increase the price. So now how many quantity will get execute? 900, and these are the respective prices. Now point to be noted, now you have to solve this, but point to be noted, your answer has to be in between. Now look at very carefully. Your answer, average selling price, has to be in between 19.84 to 20.02. Answer has to be between these two values. Okay, now look at the option. So one option is 19.70. So A is incorrect. Third option is 20.05. Answer is incorrect. Answer has to be between this value. So correct answer is B. Now you can mathematically solve, and when you are going to solve mathematically, answer is going to be B. So let's solve. Now 20.02 multiplied by 300. This is 6006. 400 multiplied by 19.89, 7956. 200 multiplied by 19.84, 3983968. Summation is 17,930 divided by 900. Answer is 19.922. So correct answer is B. So next we have to solve 63 to 68. Now a stop buy order. Now for example, I'm short on PVR, and now I will place a stop buy order. So when a stop buy order will place, when you want to limit your losses on short position. So you have sell the share, you have already short on this share. Now if the share is continuously increasing, your losses are magnified. To avoid these losses, you will place a stop buy order. Answer is A. 64. A trader who owns share of a company currently trading at 100 places GTC stop 90. That means the moment it falls below 90, you are ready to sell at a price 85 to 90. So now question number 64. Limit stop 90. That means trigger price is 90. And the moment it falls below 90, you are ready to sell between 85 to 90. Okay. Assuming that the stop conditions is satisfied, the order becomes executed. Which of the following is most correct? You have already purchased the share for 100. Okay. And now you are willing to sell at this particular price. Now conditions are satisfied. Now what is going to be your maximum loss? In this case, your maximum loss is going to be 15 rupees per share. So now answer is B. Now why C is incorrect? The order will get executed at either 90 or 85. Answer is incorrect. It will get executed at any price within this range, not at 85 and 90. It will get executed. This is the range. This will get executed at this particular range. If there's a buyer for 86, 87, 88, 89, so it will get executed at within this range, not at specific these prices. So C is incorrect. Now the order becomes a market order when the price falls below 85. Incorrect. Now the order will become triggered once the prices falls below 90, and now you want to sell. Between 85 to 90. So your maximum loss is going to be 15 rupees. Answer is B. 65. Which of the following is a primary market transaction? Now a private placement of shares. That means the private placement means QIP. Next, 66. A trader submits an immediate or cancel buy order for 700 shares at 20.25. 700 shares. Now in this, who is the best buyer? Best buyer is buyer number 5, who is willing to buy at this. And who is the best seller? So these are the best sellers, starting with seller number 1, 2, 3, 4 and 5. Okay. Now the best buyer is quoting 20.15. You places an order for 20.50. So could be possible by mistake. Now sellers are willing to sell at, now I want to protect the seller. Sellers willing to sell at these particular prices. Now I want to protect the buyer. Whosoever places the order, we have to protect that. Minimum of this price or the price at which seller wants to sell. So now you want to buy 700 shares. So you have become the market now. You have taken the market. This is question number 66. Now you want to buy 700 at the rate 20.95. You are the best buyer. Now seller 1 willing to sell 200 at a rate 20.2. Now left with 500, 300 at a rate 20.35. Now left with 200 at a rate 20.5. How many quantities I have purchased? I have purchased 700. Now what is going to be my average price? So simple, it has to be between 20.2 to 20.5. Now let's eliminate. B is incorrect, C is incorrect, so correct answer is A. It has to be in between 20.2 to 20.5. So answer is A. So class, please solve yourself the numerator and divide by 700. Answer is going to be A. Okay, 67. Now you want to place a very large block. Now you want to sell a very large block of stock for her client. Now this is going to be with the help of investment bank, and it is known as brokered market. Now broker will search for the buyers. 68. Now it's a quote driven. Quote driven means it's a dealer market. Which of the following statements best describes her currency exchange transaction? Quote, you're dealing with the dealers. So here the counterparties are dealer. Answer is A. Okay, now she will pay commission. Answer is incorrect. It is going to purchase the entire lot and then it will sell. So there will be no commission. Commission is in case of brokered market. The currency exchange transaction will take place in organized exchange. In case of organized exchange, it is going to be an order driven market. So C is incorrect, B is incorrect. It is specifically given quote driven market. So in quote driven market, who are the counterparties with whom you are dealing, that are going to be the dealers. Answer is A. So friends, with this we have covered LOS E, F, G, H, I, J, and collectively I think we have solved 36 practice problem. So in totality we are having 70. Out of that 70 we have solved 36. So it's very important that before proceeding to the next part, a thorough understanding of all these LOS, all these practice problem, and then you are proceeding to the next part. Thank you. Now friends, next LOS is explain the main functions of financial system. People use the financial system for following purposes: to save the money for the future, to borrow the money for current use, and to raise equity capital. Now my point is, one of the part of financial system is banks. Now in banks, the depositor deposit their savings. Depositors deposit their savings and bank offered them some sort of interest. For example, interest is 6%. Okay, and further banks are going to lend this money to borrower at a rate, let us assume 8%, and this entire transaction bank is going to earn 2% as net interest margin. Now this is the way how banks work. Now my point is, what are the objectives or what are the functions of financial system? Now the main functions of financial system: people or depositor are able to save their money for the future. Same wise, borrower are in a position to borrow money for their current use. Now people use financial system for following purposes: to save money for the future, to borrow money for current use, and to raise equity share capital. Now my point is, now company wants to grow. So first way is to borrow money. Second is to raise equity capital. Now the main function of financial system is the achievement of the purpose for which people use the financial system. So my main function is that people are in a position to use the financial system for these purposes. Now my point is, my second main function is the discovery of equilibrium interest rate. So discovery of equilibrium interest rates in the economy. Now what is the meaning of equilibrium interest rates? Now it is the rate of return, it is the rate of interest in an economy where aggregate savings, that means aggregate deposits, is equal to aggregate borrowings. Now in an economy, if rate of interest are too high, in an economy, then depositors will willing to deposit their money. So depositors will willing to deposit their money in the bank. However, borrower may not be willing to borrow at a high rate of interest. Same wise, if in economy rate of interest are too low, Borrowers are willing to borrow at that rate, but depositors may not be willing to deposit the money in the bank. Now, the main function of financial system is discovery of the rate of return where aggregate savings equal aggregate borrowings, so that people are in a position to save money for the future and people are in a position to borrow money for their current use. Third one, allocating the capital to its most efficient uses. Now, what is meaning of this? Now, our investor is having a limited capital. Okay, now we are having a limited capital. Now, we should be in a position to evaluate. Now, for example, there are two options. One, to invest in a bond market, for example, in a bank FD. Second, to invest in share market. Now, investors should be in a position to well evaluate the risk involved in both the asset classes, the expected return, and based upon their risk appetite, based upon their return objective, decide where they want to invest their money, or how much allocation to the bond market or how much allocation is required in case of share market. That means allocating capital to its most efficient uses. Now, in totality, there are going to be three functions of financial system. Number one, achievement of the purpose for which people use the financial system. That means they are able to save the money for the future, they are able to borrow the money for current use. To facilitate the discovery of rate of return where the savings is equal to the borrowing. And third, allocating the capital to its most efficient uses. Now, characteristics of a well-functioning financial system. What are the characteristics are required to achieve these functions? Number one is operational efficiency. Operational efficiency means in the country the transaction cost to be less. Now, if there are high transaction costs in the economy, it will make the markets inefficient. Second, there should be a sufficient liquidity in the market. Now, for example, if you and me are buying a share like Reliance. Now, even if we are having a share like in the quantity we are having 10 lakh, 20 lakh, again our markets are liquid enough that if we want to liquidate our positions, we will get the money. So now there should be a sufficient liquidity. Operational efficiency means transaction costs should be low. Timely and accurate information on the prices and volume of recent transaction. Now, what is the current price of the Reliance? This data should be available timely and accurately. And last one is informational efficiency. That means whatever the price is, that price reflect all the information about the available information about the assets. So these are the required characteristics of a well-functioning financial system. So now we have three functions. We have three functions of the financial system. Number one, it is able to fulfill the needs of the people. Second, discovery of rate of return where aggregate savings is equal to aggregate borrowings. Third, allocating the capital to most productive uses. Now, what are the characteristics? Transaction cost to be low. That means operational efficiency is required. Prices should reflect all the available information. Informational efficiency is required. There should be a liquidity in the market. And timely and accurate information about recent trades. So these characteristics are required for a well-functioning financial system. Now, in the financial system, in the stock market, in the financial system, there are going to be four types of investor. Now, this is a testable one. Number one, trader. Number two, hedger. Number three, investor. And number 4th, arbitrage. Arbitrage. Now, who is a trader? Now, who is an investor? Who is investing in a stock with a long-term horizon? Who is investing in a stock with a long-term horizon? Now, he has thoroughly understand the business of the company. He thoroughly understands the business. He has conducted the thorough comparative analysis, and based upon that, he has invested in a company. Now, how long he is going to hold that investment? He is going to hold that investment. He is having a long-term horizon. Now, those persons are known as investor. Now, trader. Who is the trader? Now, trader is a person who on regular basis, he is going to buy and sell the shares. So now, investor, today they are going to buy it and they are going to hold this investment for a longer term. So they are known as investor. Now, who is the trader? Now, trader, they typically perform technical analysis. Technical means on the basis of charts, they identify which stock is under and overvalued, and their objective is very short term, 1 month, 2 month, 1 day, 2 day. Today they are buying one share and selling. Could be possible they are selling at the same day itself. So now their investment horizon is very short. Their only objective is to earn the profits. Okay, their only objective is to earn the profits in the short term because of short term movement. Now, hedger. Hedger wants to protect against risk. So hedger is a person who is going to reduce the volatility or protecting against any sort of risk. Now, point is, today suppose you have purchased a insurance. Now, if you have purchased a health insurance, tomorrow if you are not feeling well, you are sick, then all this expense are going to be bear by. Now, all this expense are going to be bear by insurance company. Now, you would be known as hedger. So you have protected yourself against a risk by paying a premium to the company. You are known as hedger. And last one is arbitrager. Arbitrager, they want to trade on market inefficiency. That means they try their level best to find out mispricing, and on that mispricing they are going to trade upon. So now I'm going to start with buyer. With the word trader, the moment word trader is given, hint in the question, it is given that buy or sell. That means they keep on buying and selling the security. If you keep on buying and selling the securities, you are nothing but a trader. Okay. Now, hedger. Now my point is, my company is involved in export of goods. So my company is in India, and recently we have exported the goods to an American company where in totality the shipment value is $1,000. So now we ship the goods, invoice value is $1,000, and now party is saying that we are going to make you, the credit period is of 90 days, and we will make you the payment after 90 days. Okay. So now after 90 days, I'm going to receive $1,000. And now my fear is that suppose today $1 is equal to 72 rupees. Okay, now at time 0, I'm anticipating that I'm going to receive 72,000 rupee. Now for one or the other reasons, if dollar depreciates, then instead of 72,000, I'm going to receive 70. Now for one or the other reasons, if dollar depreciates, then I'm going to receive a lower value. My fear is depreciation of dollar. Now to protect against this particular risk, today I enter into a contract with a bank that after 90 days, I'm going to sell $1,000 for $1,000 at $1 equal to 71 rupee. So now today we have entered into a contract that after 90 days I'm going to sell $1,000 at a rate $1 equal to 71. Now my point is, after 90 days I will receive 1,000, and 1,000 this I'm going to sell to the bank, and bank will pay me 71,000. Now my point is, let us assume after 90 days. After 90 days, if in the market $1 is equal to 80 rupees or $1 is equal to 65 rupees. Now whether the $1 is equal to 65 or $1 is equal to 80, I'm going to convert them $1 at 71 rupee. Now these transactions are known as derivative transactions. So what is the meaning of derivative? Where you are entering today in a contract, but delivery would be in the future. So now if you have to receive a payment, and against that you enter into a future contract, this is nothing but you're hedging your risk. Same wise, there's a company, PepsiCo, and they are in the business of manufacturing of chips, potato chips. Now one of the key input is potato. Now today Pepsi enter into a contract with the farmers that you are going to supply us potatoes at a fixed rate of 20 rupees per kilo. Now my point is, if tomorrow in the market 1 kilo is for 50 rupees or 1 kilo is for 30 rupees, 10 rupees, 5 rupees, 2 rupees, whatever the price in the market, you are going to supply me at 20, and this I'm going to use as my input. Now my point is, in this case Pepsi is an example of hedger. If you are protecting against yourself against any risk, then you are nothing but hedger. Investors, if your investment horizon is long term, and arbitrage trades upon market inefficiency. Now my point is, recently there's a company that is India Bulls Housing Finance. Okay, so this company comes up with a convertible debt. Now what is the meaning of convertible debt? For example, it is a convertible after 5 years. So for first 5 years, the investors will keep on receiving a continuous interest. And they will keep on receiving the interest at the end of year 1, at the end of year 2, 3, 4 and 5. And on the 5th year, they will be converted into equity shares of the company. Okay. Now my point is, let us assume that currently one convertible debt is equal to is trading in the market for 100 rupees, and against one convertible debt you're going to receive in the future 5 equity shares. So now my point is, if you buy this convertible debt, what is your cost of equity? Now your cost of equity works out to be 20 rupees per share. And if in the market equity share is trading at 30 rupees per share, now can you make a arbitrage gain, a risk-free profit? Answer is yes. We will buy convertible debt. We will buy whatever is cheaper, we are going to buy that. So we are going to buy convertible debt. By buying a convertible debt, in a way we are investing in a equity, and we are investing in an equity for 20 rupees. And at time 0, I'm going to sell this equity share. I will be involved in short selling. And now by entering into this transaction, I'm making a risk-free profit. So these transactions comprehensively we are going to cover in fixed income. Now one more example of arbitrage. Now one more example of arbitrage is, suppose currently in one market onion is available at 1 kilo equal to 20. This is Kalkaji market, Kalkaji vegetable market. And in Okla vegetable market, 1 kilo is for 50 rupees. Now point is, can you make arbitrage profit, risk-free profits? Answer is yes. Now to make the risk-free profit, you will buy cheap, you will buy from Kalkaji market at 20 and start selling in the Okla market for 50. In this way, you are going to make a gain of 30 rupees. That means arbitrage trades upon market inefficiency. Okay, so there are four types of people who invest: trader, hedger, investor, and arbitrager. Now I am jumping to my questions. Question number 1. So now a person has designed a sophisticated forecasting model which predicts the movement in the overall stock market in the hope of earning a return in excess of a fair return of the risk involved. He uses the prediction of the model to decide whether to buy, hold, and sell. Now important word is to decide whether to buy, hold, or sell the share. Now my point is, this person would best be categorized as hedger, investor, or trader. Now he is involved in buying and selling of the goods. So now if you are buying and selling both, that means you are nothing but a trader. Answer is C. Then question number 11. Which of the following is one of the main functions of financial system? Now in totality there are going to be 3 functions of financial system. Now one of those functions is determining an equilibrium interest rate in the economy. Now this is going to be depend upon demand and supply of the money. So question to answer 11th is A. Next 13. There is a young person is young and has substantial wealth. Significant portion of his stock portfolio consists of emerging market stocks that offer relatively high expected return at the cost of relatively high risk. He believes that investment in emerging market is appropriate for him given his ability and willingness to take risk. So now he's keep on investing within the markets. His investment horizon is long, keeping in mind his willingness and ability to take risk. Now it is most likely hedger, investor, or trader. Now in this case the person is going to be an investor. Since he is holding with a long-term horizon, he is going to be an investor. He is very bullish in the emerging stock market. He consistently buys in the emerging stock markets. So he is the investor. Now question number 40. Now a person owns a manufacturing company in US. Her company has sold goods to a customer in Brazil and will be paid in Brazilian real in 3 months. That means you are going to receive payments after 3 months. She is concerned about the possibility of BRL depreciating more than expected against the US dollar. Therefore, she is planning to enter into 3-month future contract on the BRL. The seller of such contract generally gains when the BRL depreciates against the dollar. Now my point is, in this particular case, Smith is nothing but the hedger. Now she is protecting herself against the depreciation of BRL. Now answer is A. Next, question number 15. Which of the following is not a function? In totality there are going to be 3 functions. Which of the following is not a function of financial system? Now allocate the capital efficiently. This is one of the purposes. Facilitate borrowings by the business. This is one of the purposes. Now what is not one of the functions? Answer is to regulate arbitrage profits. This is not the function of financial system. Question number 49. Now, the economic equilibrium interest rate in a well-functioning financial system is most likely determined by the demand and supply of the money. Answer is C. 16.9. Now, operational efficiency. Operational efficiency means the transaction cost is low. Answer is B. And then question number 70. Accounting standards and reporting requirements that produce meaningful and timely disclosure are most critical for achieving which of the following efficiency in a well-functioning financial system? Now, there should be a proper financial statements. There should be a proper disclosure. In a way, they are one of the required characteristics. That is going to be informational efficiency. Answer is B. Operational means transaction cost is low. Allocational means allocating the capital to the most effective use. Informational means the information, whatever the price it is trading, that price reflect all the available information. So in the annual report, in the accounting standards, we are going to get more details. So informational efficiency it is going to promote. Answer is B. Class, there's one more. Question number 28. Now, J works for a hedge funds. He specializes in finding profitable opportunities that are the results of inefficiency in the market for convertible debt, bonds that can be converted into a predetermined amount of company's common stock. S tries to find convertibles that are priced inefficiently relative to the stocks. The trading strategy involves simultaneously purchase of the convertible bond and short sale of the stock. The above process is known as arbitrage. Arbitrage means you're going to make risk-free profit. Now class, what is the meaning of securitization? Securitization is going to be covered under chapter asset-backed security. And this process is nothing but an arbitrage. Okay. So with this, we have covered LOS A and LOS K. Now friends, I'm moving to my next LOS B. Describe the classification of assets and markets. Now first classification is financial asset versus real assets. So now financial assets means you are investing into. Now financial assets means you are investing into bonds, into the debt market, into the equity market. So these are the financial assets. Now real assets means you're investing your money to purchase real assets, tangible assets such as land, gold, silver. So this is financial versus real. Then debt securities versus equity security. So if you invest in debt securities, for example, you are having an FD with a bank, in this case, you are going to receive a fixed rate of return. Whereas if you want to invest into the equity shares, now your claim is going to be a residual. So now, debt securities versus equity securities. In debt securities, you are going to receive interest at fixed rate. Whereas in equity, you are going to have a residual claim. Now, equities is more risky in comparison to debt. Now, within equities, there can be two types, one public and private. Public means investing in the listed stocks, such as a stock of Reliance, TCS. Private means investing in an unlisted company, such as Byju's. Now, again, which one is more risky? Public securities are more risky private securities are more risky. Private are more risky in comparison to public. Now, derivatives. Physical derivatives versus financial derivatives. Now, what is the meaning of derivative? We are entering into a contract today at a fixed price, and this we have to honor in the future. Now, there can be two types. Physical derivative. Now, for example, PepsiCo enter into a contract with the farmer that in the future they are going to supply potato at a fixed rate. Now they physically want the asset, they physically want the potatoes. So these are known as physical derivative contract versus financial derivative. Now we do have derivatives on stocks as well. So there's a derivative of TCS, there's a derivative of Reliance. This we have to study eventually, but those are known as financial derivative. So in case of physical derivatives, there is a physical settlement. They want the physical delivery of the goods. Whereas in case of financial derivatives, there is only net settlement. So this we eventually learn in the derivative chapter. Now there are two markets, one spot, one future. Spot means current market, current price. We want the delivery right now. Future means we want the delivery in the future at a defined date. Same wise, there can be a primary market, secondary market. Primary market means where the company is involved with the issue of the shares. Secondary market means where the investors or the traders are exchanging the shares. So this is known as secondary. Then money market versus capital market. So this terminology is with respect to debt. Now if you want to raise money for a tenure less than 1 year. So if you want to raise the money for a tenure less than 1 year, it is known as money market instruments. If you want to raise money with the help of debt for a tenure greater than equal to 1 year, this is known as capital market instruments. Now, for example, whenever the government borrows money, so there are two instruments. One is bill, treasury bill, and second is bond. Now, bonds have a maturity of 1 year to 40 years. On the contrary, bills are one having a maturity of less than 1 year. Now bills are known as money market instruments having a tenure of less than 1 year. Bonds on the other hand are known as capital market instruments where the maturity is more than 1 year. Then last, traditional investments versus alternative investments. Now traditionally you can invest in, earlier people used to invest in equity, debt, convertible debt, ETF, mutual funds. So these are the traditional ways of investing. Invest your money into equity, debt, convertible debt, ETFs, mutual fund. But now over the period of time, new investments are coming into the market, alternative investments. Now you can invest your money into real estate. Point to be noted, real estate is a part of alternative. Real estate, then commodities like gold, then hedge funds, private equity funds. Now private equity means, here the meaning of equity is investing in listed company. Private equity means investing in a company where the shares are unlisted, such as Byju's. Now private equity fund. Then there's one more word, that is securitize debt. So now what is the meaning of securitized debt? This we will learn comprehensively under the reading asset-backed security. But only as of now it is important that it is an alternative investments. So now what are the traditional investments? That is equity, debt, convertible debt, ETF, mutual funds. What are alternative ways of investing? Invest your money into real estate, commodities, hedge funds, private equity, and securitize debt. Comprehensively covered under the alternative investment reading. Okay, so now I'm moving to my LOS C. Now describe the major types of securities, currency, contract, commodity, real estate that trade in the organized market, including their distinguished characteristics and major subtypes. Okay, so in our class LOSC we are not going to cover in detail. So I'm having the respective chapters where we are going to talk in detail under that respective chapter. Okay, so now what are the different categories of derivatives? So future, forward, option, swap, insurance, credit default swap. Names are more than sufficient. Then commodity. Under commodity there is a gold, silver, crude oil. Then pooled investments. Pooled investment means mutual fund, ETF, asset-backed security. Asset-backed security means securitized debt, and hedge funds. Now equity. Equity can be of common equity, that means equity share capital, preference share capital, and warrants. Now there is no difference between warrants and equity share capital. So warrants and equity share capital are exactly the same. Only thin line of difference is the warrants are freely transferable. Now, for example, I want to transfer 100 rupee notes. So 100 rupee note is freely transferable. Now whosoever is having that 100 rupee note, he is the owner of that. Same wise, warrants are not registered. So warrants are freely transferable shares. Whosoever is having the certificate, he is the owner of the company. On the other hand, equity share capital are registered shares where company is maintaining a proper record of the shareholder. So in simple words, common equity is nothing but, warrants are nothing but equal to common equity. Then fixed income securities, we can invest our money in bonds, notes, commercial paper, repurchase agreements, and convertible debt to be covered comprehensively under the heading fixed income. Okay, so as of now, only the names are more than sufficient. Now my LOS D. Now whenever you are trading over exchange like NSE, BSE, now point is, can there be any scenario of counterparty risk? Now for example, today I bought one share of Reliance at 1800 rupee. Now is there any possibility that I've purchased, I'm not going to make the payment, or whosoever is the seller is not going to deliver the goods? Now whenever you are dealing over the exchange, the counterparty risk is zero. No party can default here. Now because of which there's a zero default risk because of clearing house. Now clearing house will ensure that there are going to be a zero counterparty risk. Now for example, the moment you place an order, your broker is going to block 1800 rupees. And the moment seller place an order, he ensures that in his demat account he is having the share. And the moment the deal happened, that share got freeze. Now because of clearing house, there is no counterparty risk while dealing in the share markets. Okay, so no party can default here, neither the buyer nor the seller, because of clearing houses. Okay, so friends, with this we have covered LOS B, C, in limited fashion LOS C and D. Now I'm proceeding to my question bank. So now few questions we are unable to solve as of now. Okay, so once the respective chapters are over, then we will be solving those questions. But as of now, I have to skip some questions. Okay, so now I'm jumping back to my question bank. So now question number 6. So question number 6, we are going to solve this after derivative. Okay, question number 7 after derivative. Question number 8 after derivative. Now question number 9, what do you mean by dark pools? So now dark pools are exactly similar to exchanges, but they are having less restrictions. They are also known as alternative trading systems. And why they are known as dark pools? They are known as dark pools because they don't display the orders. So now you have to answer A, B, C. Dark pools are described as they are the trading venues similar to exchanges that exercise little regulatory authority over their subscribers. So dark pools are nothing but alternative trading system. Question number 10. Now a university endowment fund is mandated to hold some of its values in alternative investment. Now where you're going to invest your money. So now convertible preference shares are a part of traditional investments. ETFs are a part of traditional investments. Now you're going to invest your money into real estate. Answer is A. Question number 16. Investor mainly invests in the stocks of publicly traded company. He wants to increase the diversification. Friends recommended him investing in real estate. Now real estate is an example of alternative investments. Question number 17. You want to invest into 90-day commercial paper. Now it is going to be a 90-day commercial paper. Commercial paper is a sort of a debt. Now it will be a capital market, money market. Money market means less than 1 year. Capital market means 1 or more than 1 year. So answer is going to be B. Then question number 18. Oil and gas exploration and production company announces it's going to offer 30 million shares to the public at this particular price. Now this transaction is in the primary market or the secondary market. Shares are directly issued by the company. So this is an example of primary market. Answer is B. Now consider a mutual funds that invest in fixed income. Now which is going to be least likely to be the part of this fund? Now answer is warrants. Warrants are nothing but equity. So answer is A. Now question number 20. A friend has asked you to explain the difference between open-ended and close-ended funds. Okay. Now this again we are going to cover under portfolio, but there are two kinds of mutual funds. One, open-ended, and one close-ended. Okay. So open-ended, close-ended. Now what is the meaning of open-ended? Okay. So now, for example, there is a mutual fund scheme under which asset under management is around 10,000 crore. That means in totality, they have gathered 10,000 crore from the investor and they have invested in the market. And in totality, they have divided this asset under management into 1,000 crore unit. Now per unit is having a value of NAV of net asset value of 10 rupee. Okay. Now my point is, now for example, in those companies where the fund has invested money, tomorrow let us assume that they performed well. Okay. And now the market value is continuously increasing. And now let us assume that NAV after 1 year is 11 rupee. Okay. And now you want to decide that I want to invest more into the scheme. Now open-ended. Open-ended means if you want to invest more, you have to come to mutual fund office. Okay, and then let us assume that you want to buy 100 units. Now you have to pay 1100 to the mutual fund, and in return mutual fund is going to give you 100 units. Okay, open-ended. Now you want to invest more. Come to mutual fund and mutual fund is going to issue you additional units. In the same manner, if you want to liquidate, if you want to redeem, now for example, I want to redeem 1000 units. If you want to redeem 1000 units, come to the mutual fund office and mutual fund company is going to pay you per unit 11 rupees. Invest more or redemption. In both the cases, you have to visit mutual fund office. Okay. Now close-ended. Now the meaning of close-ended is that, now one of the example is ETF. Now, for example, SPI Nifty 50 ETF. Now, what is the meaning of ETFs? First, they are going to be traded over exchanges. Second, since it is an ETF, it is going to replicate some index. That index is Nifty 50. And which mutual fund company has created this? That is the SBI Mutual Fund Company. Okay. Now my point is, now let us assume that after 1 year the NAV is 11. After 1 year the NAV is 11. I want to invest more. Now if you want to invest more, go to the exchange, place a buy order. Same wise, I want to liquidate. Go to the exchange, place the sell order. That means in the close-ended fund, you are not coming to the mutual fund office. You want to sell, go to the secondary market and place the sell order. If you want to buy more, go to the secondary market, go to the exchange, place the buy order. Now this is known as close-ended. Now point to be noted. Now a close-ended mutual fund may or may not trade at their NAV. Why? May or may not trade at their NAV. Why? Because it will be dependent upon the liquidity in the market. Now for example, if there is no demand or there is no supply, so it could be possible that they are not trading equal to their NAV. Open-ended, you want to buy more, you want to sell, come to the mutual fund office. Close-ended, go to the exchange, go to the secondary market and they liquidate or buy more. But may or may not be you're getting your exact NAV. Now why? Because it is dependent upon demand and supply. Now let's take one of the example. Now one of the example is Bharat 22 ETF. So this ETF is by ICICI company, ICICI Prudential. And now if I visit company's website, it is having a NAV of per unit is having a fair value of 36.841. Okay, and now if I go to money control, Bharat 22 ETF, however they are trading in the market at a price 36.75 at a price 36.75. So now they may or may not be equal to NAV. They are going to depend upon demand and supply in the market. Okay, so this was open and close-ended. Now you have to solve question number 20. Now close-ended are unavailable to new investor. Answer is incorrect. Now in the secondary market, you can go to the secondary market and buy the additional units. Incorrect. When investors sell an open-ended, they can receive a discount or premium to NAV. Incorrect. In the open-ended fund, you are always going to get exact NAV. Even B is incorrect. Now C. When selling shares in an open-ended, you sell back to the fund. That means you first sell back to the mutual fund company. Whereas investors in a close-ended fund sell the shares in the secondary market. So correct answer is C. 20. Answer is C. 21. This is to be covered after derivative. Now 22 after derivative. 23 after derivative. 24 after derivative. Now 25th. Now Standard & Poor depository receipts. So what is the meaning of depository receipts? We have already covered. They are basically now you are investing in the depository means shares and S&P means index. Okay. So now S&P depository receipts is an investment that tracks S&P 500 stock market index. Purchase and sell during a average trading day would be described as now first. So now there are two words, pooled and active. So it is exactly replicating S&P 500. So word active is incorrect. Now pooled means instead of investing in a single stock, you're going to invest in group of stocks. So here you're investing in a portfolio of 500. So answer is either going to be A or B. Now this transaction is going to be happen over the exchanges. Now primary market, secondary market. It is a secondary market transaction. Answer is B. Question number 26 to be covered after derivative. 27. Which of the following about the ETFs is correct? Okay. Now ETFs are not backed by any asset. Incorrect. Mutual fund eventually has to invest the money, so they are having the assets. Okay, so A is incorrect. Now the trading cost of ETFs are substantially greater. Incorrect. Since they are replicating an index, they are passive funds, the transaction cost is not higher. Now the correct answer is the investment companies that create ETFs are financial intermediaries. For example, in our case, SBI ETF mutual fund. So that is created by the SBI mutual fund company. So answer is B. 27. Correct answer is B. 29th after derivative. Sorry, 39. Now Jim White has short 100 shares of a company at 42 rupees per share. So question number 39. Short. So that means in this case your selling price is 4200. Okay, total selling price 4200. He is also simultaneously placed a good till cancelled, stop 50, limit 55 buy order. Okay, now since you are involved in short selling, now there is a fear that in the market if the share price increases, then To protect against that loss, you have placed a stop buy order. Now the trigger price is 50, and you want to buy at a price 50 to 55. Okay, so this is the case. Assuming that the stop condition specified is satisfied and order becomes valid. Now what is the maximum possible loss? So now in the worst scenario, you are going to purchase the stock at what value? You are going to purchase the stock at 55. Now in totality you are going to purchase 100 shares. So now your purchase price is going to be 5500. So what is going to be the maximum loss? Now maximum loss is going to be 1300. So answer is B. Now 47. A financial analyst is examining whether the country's financial market is well functioning. She finds that the transaction costs are low and trading volume are high. So liquidity is there and they are at low transaction cost. So now in such a market, trader will find it easy to trade because liquidity is there, and their trading will make the market trader will find it easy to trade and their trading will make the market more informationally efficient. So now if there would be high number of players, transaction cost is less, volumes are high, that makes the market more efficient. Answer is C. Now 50th, you want to invest in alternative. Which of the following will most likely to be included? Now ETFs, convertible bond, they are the part of traditional. Securitized debt. What is securitization? We are going to cover under asset-backed security. Now a close-ended fund is trading at a premium to its NAV, trading at a higher value. Now why this could be the scenario? A belief that portfolio securities are undervalued. Now in whatever the portfolio that you have invested, now those companies are undervalued, because of which people are ready to pay a higher NAV, a higher price than the NAV. 52, after derivative. 53, after derivative. 54, which of the following will provide liquidity to its client? Now liquidity are provided by the dealers. They make an upfront payment, 950 crore by JB Morgan to Bajaj Finance. They make an upfront payment. That means they provide liquidity service to their clients. Answer is B. So friends, with this we have covered LOS A till K. Now I'm left with only LOS L. Now friends, I'm moving to LOS L. Describe the objectives of market regulation. Now that means what are the objectives of regulator? So now in our country, the regulator for listed company is SEBI. Regulator for banks is RBI. Okay. Now you have to describe the objective of market regulation. Number one objective is to protect the unsophisticated investors. Okay, now how to protect unsophisticated investors? Number one, now SEBI is going to ensure that no one is involved in insider trading. So prevent insiders from exploiting the other investors. Same wise, now SEBI will ensure that all the listed companies are preparing their financial statements in accordance with IFRS. So that information gathering is less expensive. Same wise, now to evaluate your performance better. Now there's a law in the country that every listed company has to come up with quarterly statements. You have to present investors presentation. You have to present annual report. Now these are the ways with which we want to protect an unsophisticated investors. So protect unsophisticated investors. First, prevent insider trading. Then promote common financial reporting. Promote IFRS so that information gathering becomes less expensive. Now to ensure that financial markets are fair and orderly, plus to minimize the agency's problem. Now for example there is some dispute between brokers and the brokers and the clearing house. Now if if there are some sort of conflicts, to minimizing that conflicts is again the objective of regulator. Now there is a lockdown in our country. So the moment there was a lockdown, now people are unable to repay the debt to the bank which they have taken, okay, because everything is now under a complete lockdown scenario. Now RBI says that to minimize the issues between the banks, and the people, now between the borrowers. Now what banks recommended that they're going to offer a moratorium of 90 days. So now minimizing agency problem is one of the objectives of regulators. Then establishing minimum standards of competency. Now for example, I'm a mutual fund company, and now if I want to show my results, so now CFA Institute will say, or SEBI will say, that you are going to follow GIPS. So they are the standards. This we are going to learn in ethics, that how mutual fund companies are going to present their results, so that to the investor you're showing a true and fair view. So establishing minimum standards of competency. Then last one is ensuring that the minimum level of capital, so that market participants will be in a position to honor their commitments and be more careful about the risk. Now in our country, so this you will eventually learn tier 1, tier 2 capital. So this is the requirement in case of banks. So now in case of banks, they're required to maintain such minimum level of capital. Now why that minimum level of capital is required? Now you are involved in lending business. Now for one or the other reasons, if borrowers are unable to repay the money, to protect the depositor, there's a requirement of minimum level of capital. Same wise, now the banks are not allowed. Now you are getting deposit from the depositors. Now banks in the country are not allowed to invest the money into the stock markets. They are not allowed to invest the money into the derivative markets. So now requiring minimum level of capital to honor their commitments. Plus we have to make them sure they are more careful about their risk. Okay. So these are the objectives of regulators. Now I'm going to solve problems on this. Question number 3. Which of the following regarding the objectives of market regulation is least accurate? Okay, now promote fair and orderly markets is one of the objectives. Ensure that systems are in place to prevent fraud. So these two are the objectives. Now set standards to ensure that all the agents are acting in the market are skilled. Now this is not the objective. Only the objective was to ensure that they are the minimum standards of competency. Now for example, you have to present your skills, you have to present your results in accordance with JIP standards. There is no requirement that the agents acting in the market are going to be skilled ones. So there's a minimum requirement, minimum standards for competency. Okay. Now question number 4, answer is question number 3, answer is A. Question number 4, which of the following is least accurate? Again, number 1, act to level. Now financial regulatory bodies act to level the playing field for market participants. Now what is the meaning of option number A? To ensure that there is no insider trading. Act to level, that means all of them are acting with the same knowledge. Act to level the playing field for market participants. Now for example, if you are having any price sensitive information with respect to a stock, now am I allowed to trade on this? Answer is no. So now act to level the playing field, that means all the players, all the market participants are trading with the same information. Now if you are having any price sensitive which is not available in the public domain, you are not allowed to trade on that particular share. So this is one of the objectives, correct. Now defining minimum standards of competency for agents, correct. Now same wise, you are required to clear some NSC examination if you want to become a broker. So minimum levels of competency, correct. Okay, this is the requirement. Now require that the regulated firms, for example banks, maintain optimum level of capital. Answer is incorrect. So there is not an optimum level. They require that they are going to maintain a minimum level of capital. So whether they are maintaining optimum, yes or no, we are least bothered. we are going to ensure that they are going to maintain minimum level of capital so that they are going to honor their commitments. So correct answer is C. Which word is incorrect? That is the optimum. Instead of optimum, it should be minimum level of capital. Now 48. The government of a country whose financial markets are in early stage of development has hired you as a consultant for the financial market regulation. Which of the following is least likely to be included? Okay. Now minimizing agency problem, one of the objective. Ensure that financial markets are fair and orderly, one of the objective. Now ensure that the investors in the market will achieve a return at least equal to risk-free. Now this is not going to be my objective, and there have been the times when stock markets have delivered a negative return as well. So now ensuring that they will get at least a risk-free rate, this is not my objective. Anyways, equity markets are subject to market risk. So in the time of crisis, yes, there could be possible that they are going to deliver a negative return. So they will keep on giving a return equal to risk-free rate. This is not my objective. Okay, so friends, with this we have comprehensively covered this chapter. Okay, now in totality we were having 70 problems. Out of this I have skipped in totality 11 practice problems. So those 11 practice problems are problem number 6 to 8, then problem number 21 to 24, 26, 29 and 52, 53. So in totality we have skipped these 11 problems. This you have to cover once derivative, alternative and fixed income chapters are over. Okay, so as of now you can safely skip these 11 practice problems, and once we complete this derivative, alternative and fixed income units, again we will be jumping back to this and solving these 11 practice problem. Okay, so with this we have covered this chapter. I think your hand notes would more than sufficient. I suggest that going through the reference book would not be required. Go through all the LOS, practice this segments, practice this 59 questions well. Okay, and then proceed to the next reading. Okay, thank you.